Hello and welcome to the first trade on Yahoo Finance for this Thursday, June 4th. I'm Alexis Christoforous, along with my co-anchor, Brian Sazi. It was another mostly peaceful night on the streets of America with protests and some arrests, but nowhere near the violence that we saw earlier in the week. Later today, the first of three planned memorial services will take place, remembering George Floyd in Minnesota. Late yesterday, three more police officers were charged in connection with his killing, and the officer seen kneeling on his neck had his charges upgraded to second-degree murder. Overnight in New York City, police were out enforcing that 8 p.m. curfew, and there were scattered arrests. At least two officers were shot, and one was stabbed in a confrontation with a suspect in Brooklyn. It's unclear, though, if that was connected to the protests. Meantime, in Washington, peaceful demonstrators marched on the Capitol while troops and police watched. It came hours after President Trump, in a TV interview, again said the nation needed, quote, law and order. But the retired Marine general, who was once the president's defense secretary, offered a stunning rebuke of his former boss. James Mattis wrote in The Atlantic, quote, Donald Trump is the first president in my lifetime who does not try to unite the American people, does not even pretend to try. Instead, he tries to divide us. We are witnessing the consequences of 3 years of this deliberate effort. We are witnessing the consequences of 3 years without mature leadership. And he called on Americans to unite without the president. The markets, of course, have been focused much more on the latest economic data than what's happening on the streets of America. Taking a look at stock futures right now, they are lower across the board, snapping a several-day winning streak. Dow futures off 125, S&P futures down 18, and NASDAQ futures off about 18 points. This morning, the big economic data, jobless claims. We found out another 1.8 million Americans applied for unemployment benefits in the latest week, and Emily McCormick has more on that. Emily, of course, this report comes a day before the big monthly jobs report tomorrow morning. What can you tell us?
Absolutely, Alexis. So today's report marked the 11th straight week that we've seen new unemployment insurance claims greater than the 1 million mark. But it was at least the ninth straight week that we saw the level of claims fall on a week-over-week basis. So to restate that headline number, we saw weekly initial jobless claims total 1.877 million for the week ended May 30th. This was slightly above expectations, but still a drop from the prior week when claims were at 2.126 million. Now, the new number we got today was the first time we were below the 2 million mark since mid-March. Altogether, today's report brought the total number of new claims filed since the week ended March 20th to more than 42.5 million. By state, we saw California with the greatest number of new claims last week at 230,000, followed by Florida with 206,000. But most states did see new claims fall relative to the prior week, and most states' new claims were well below 100,000. And then turning to continuing unemployment claims, those were higher than expected at 21.5 million for the week ended May 23rd. 20 million was the number that had been expected. This was also higher than the revised 20.8 million continuing unemployment claims for the prior week. And it does show that millions of Americans remain unemployed and are still filing new unemployment insurance claims, even as the early stages of reopening in the country are underway. Alexis?
All right. And Emily, we're going to start things a little earlier here tomorrow morning. I want to make sure everybody tunes in beginning at 8:29 a.m. Eastern. That's because we want to bring you that government unemployment report right when it comes out at 8:30 Eastern live. We'll be dissecting that report, breaking it down for you. So be sure to join us tomorrow on the first trade beginning at 8:29 a.m. Eastern. Emily, before we let you go, want to get in an earnings report, and that is Michaels. I know a lot of people staying at home now, baking, crafting. I'm curious how Michaels did in the latest quarter during the pandemic.
Well, we did see Michaels actually posting weaker than expected results. We saw the company swing to a loss for its most recently reported quarter, really saying that it saw this drop in sales because of the fact that it had to close its stores during the pandemic and because of social distancing measures. So we saw those same store sales down by more than 27% in the reported quarter. Michaels did give an update on its store reopenings. It said that it had fewer than 500 stores opened as of May 2nd, but that number did jump to about 1,000 out of a total of near 1,300 stores as of today. It does expect all of its stores will be open again by the end of the month. And taking a look at that stock now, we do see it down 10.5% in pre-market trading, adding to losses of 43% for the year to date through yesterday. Alexis?
Oh, big losses there. All right, Emily McCormick, thank you.
All right, let's bring in Oscar Williams-Groot for a look at what's happening overseas. Oscar, the ECB out this morning with I would call it pretty hardcore new bond buying program. And I think for many EU watchers, Christine Lagarde has reduced concerns about her leadership here. She really stepped up.
That's right, Brian. You're referring, of course, to her early performances where she wobbled slightly, not meeting market expectations. But as you say, today they've actually met and somewhat exceeded expectations with their pandemic emergency purchase program, which is the big bond buying drive in response to COVID-19. They announced 600 billion euros of additional spending under the program, almost doubling the entire envelope to 1.35 trillion. Now, the market had been expecting 500 billion of additional stimulus, so they've really met and exceeded the expectations. Lagarde also said that the program would be extended until at least June 2021 and could be extended again if necessary, really saying that they will do whatever it takes to get this pandemic under control. Lagarde, in comments just in the last hour, said that the economic impact of the crisis appears to be bottoming out, but she noted that the recovery still looks tepid. I also just want to mention quickly Germany. Overnight, they've announced a 130 billion euro package to support their economic recovery. This comes after a 750 billion euro package announced in March to help the economy weather the lockdown that country has seen.
Yeah, Oscar, the stimulus is certainly flowing around the world. But switching gears, HSBC making some waves this morning.
That's right. Both HSBC and UK-based Standard Chartered are in a lot of hot water this morning for coming out in support of China's controversial security law that is trying to impose on Hong Kong. This law, of course, would criminalize any dissent on Beijing and allow Hong Kongers to be extradited to the mainland. It's provoked huge protests and been condemned internationally. However, HSBC and Standard Chartered have both put their names towards it. We've had politicians across the political spectrum today coming out condemning the banks for their support. The head of the Foreign Affairs Committee here in the UK Parliament said that the banks were supporting an authoritarian state and has signalled that they will get representatives from both banks to come defend their position. Meanwhile, Lord Adonis, who's the former Education and Transport Secretary here, called it utterly disgraceful that HSBC had put its name to this law.
Oscar, what's the latest on this takeover? LVMH, we know, was going to buy out Tiffany before the pandemic. Has anything changed there?
Well, LVMH this morning have all but confirmed these rumors that the deal is on the rocks. As you said, yesterday we had these reports that LVMH was getting cold feet about this takeover. Today, in a pretty brief statement, the board said that they're considering recent market rumors, LVMH confirms that on this occasion, it's not considering buying Tiffany shares on the market. So they're not saying they're completely walking away from the deal, but essentially they are saying we're having second thoughts. Now, they blamed the pandemic and its impact on the global economy for this pause. Tiffany shares are down about 1.5% in the pre-market, following yesterday's more than 2% slide on the initial reports.
All right, Oscar Williams-Groot there in London. Thanks for that. And stay with us. Got a lot more show ahead, including the CEO of Lamborghini. What are they up to? What does their new car look like? We'll talk about it right after this. Welcome back to the First Trade. Healthcare workers, we know, have been on the front line of the COVID-19 pandemic, and many of them are paying the price. More than 600 nurses worldwide are known to have died from COVID-19, which has infected at least 450,000 healthcare workers. That's according to the International Nursing Federation. And they are part of the growing number of people who have contracted the virus. We are now close to hitting 6.3 million confirmed cases worldwide, according to Johns Hopkins University. That has resulted in more than 386,000 deaths around the globe. Here in the U.S., there are over 1.85 million confirmed cases, with more than 107,000 deaths. And as the number of COVID-19 cases continues to grow, albeit at a slower pace here in the U.S., people are criticizing the comments and actions being made by the White House on how President Trump and his administration are handling the situation. Our editor-in-chief, Andy Serwer, is joining us now. Hey, Andy, good to see you. I know you talked to one influencer about this very same subject. What did they have to say?
That's right, Alexis. I talked to Chase Koch, who is the son of Charles Koch of Koch Industries. Chase is possibly an heir apparent of this company, and obviously Koch Industries is one of the biggest private companies in the world. The family is very, very wealthy. And I asked him about the government's response to the coronavirus epidemic, some positives, some negatives from Chase Koch. Here's what he had to say.
I think there's some really great things that the administration has done, and some things that probably have room for improvement. I would say on the thing that is really, I think, positive would be on the medical side and on the health system. A lot of regulations that have been holding innovations back for some time were opened up, like telemedicine, right? Nurse practitioners being able to step in and act as doctors where they didn't have that ability before, and so unlock more capacity to help more people. So I think there's some in telemedicine as well, doctors working across state lines that weren't able to do that before. So my hope is that those aren't temporary, options for the health system, and that can stick into place, because we've been able to help so many people through the health system and the rollback of those regulations. I would say on maybe an area that I would have thought about it differently was the government making decisions in terms of what is a essential business and what's a non-essential business. I would have thought about it more from the government as a framework of how do we keep folks healthy and safe, but try to push down the decisions to business leaders. And if they demonstrate that they can keep people healthy and their data looks good from a business standpoint, then let them make more of those decisions. So more of a bottom-up approach instead of a top-down approach.
Maybe not so surprising, Alexis, to hear someone from Koch Industries asking for a more pro-business approach, maybe a more libertarian approach. That sort of matches some of the thinking that you've heard previously from his father, Charles Koch.
Yeah, I'm curious if Chase's politics are similar to his father's, or does he have different thoughts there?
He actually does, Alexis. An interesting sort of distinction there, because while I just said that it sort of matches some of the thinking of Koch Industries, he's a lot more, dare I say, even progressive, but certainly more inclusive. He talked a lot about what happened with the protests that have been going through this country over the past week or so. And he talked about a lot of work he had done in terms of civil justice. And I think that he sees himself as being much more bipartisan or nonpartisan, not wanting to weigh in so much when it comes to Republican and libertarian politics that his family is so famous for.
Yeah, a little less political. All right. Well, thanks, Andy. And you can catch the full interview with Koch Disruptive Technologies President Chase Koch tonight on Influencers with Andy Serwer. That is tonight at 5 p.m. Eastern here on yahoofinance.com. All right, Lamborghini's manufacturing facilities in Italy are back online after being shut down for nearly 2 months because of the pandemic. During the lockdown, Lamborghini used its facilities to produce face masks and face shields for healthcare workers. Joining us now is the chairman and CEO of Lamborghini, Stefano Domenicali. Stefano, great to see you. Thanks for being with us. Your cars are beautiful and they don't come cheap. I think the base price is about $200,000. So given the lockdowns, given the economic crisis we're having right now, what is demand like for your supercar luxury cars?
Well, Alexis, first of all, it's great to see you too. I mean, I think that what we can say today is that the first signal that we received from our customer, from our market, that no orders has been canceled. So I think that is an incredible sign in this moment where we are living a unique and unreal situation. Therefore, what I can say is that, our customers are very loyal to the brand. And for us, that was very, very important because in this period when we, locked down the company, we wanted to use this time to stay more close to them. I said to my people, we need to move from a customer centricity to a customer and give them information and giving them, all what we are doing. That's why also we launched the car on the digital platform in order not to waste, this time. Therefore, that is a great opportunity for us to let's say, to restart once again with the same kind of situation what we had before the lockdown. And of course, now that all the dealers are back to operativity, that we're going to have 100% of our dealers fully open next week, we're going to see what will be the momentum of the future. I'm expecting, Alexis, that at the beginning we're going to have a lower pace because that's normal. When you have a restart situation, when you have wearing masks, when you have not really the right environment, when you have to share and show what you like, will be, slowing down a little bit. But I'm pretty positive on thinking that, as soon as this momentum will fade away, we're going to have back on trace, the numbers of orders in terms of intake orders that we used to have in the last months.
Stefano, how has this changed how you manufacture? How has the COVID situation changed how you manufacture a Lamborghini?
Well, Brian, I would say that on our side, we didn't change anything on that respect. What we had to change was the protocol we had to respect in order to allow the people to work safe in this moment. So we used the time when we were closed to work together with our workers in order to have the social distance, each post of the assembly line, to keep the distance, and in the canteen, to make sure that everyone was wearing masks or are wearing masks and gloves and protection. So the things has changed in terms of respecting the protocols, but without having a really, a bigger effect on the production. We were using the first weeks of production, to at a little bit slower pace because we want for all the workers to feel safe and to make sure they were getting used to the new system working. But in terms of supply chain, in terms of other things, we didn't change so much. We're going to be full production, in the next week in order to, try to recover the delay for the customer that are loyal, that are waiting for the cars to be given to them.
Stefano, I was fascinated to learn you're diversifying and recently entered the world of esports with the Real Race. And I think the prize is actually getting to test drive a real live Lamborghini, which has got to be pretty cool. Tell us why enter esports? Why do that now?
Well, because, the digital platform on which we are very, very strong, it means that we are close to our young generation customer. It's something that in this moment is really very, very, very full of activity. And when we are talking about sportivity, when we are talking about something that is close to the young generation, we need to be there. But I always said that we are strong because we use the language of the young generation customers as, let's say, an appetizer to think that we are not producing the digital cars, we are producing real and physical cars where you want to drive and touch. Therefore, this is something that wants to give a more, getting ready for the moment where you can really drive the car on the track, in the city, around the world, because that's really the reason why you buy such a car.
Stefano, I remember speaking of city about almost 2 years ago, we were driving around New York City when it was okay to drive in a new Urus. And we were talking about the future production of a Lamborghini. And you told me a hybrid is coming. And yes, you're open to an electric car. Well, you've come out here with the hybrid. You've released that out into the market. What about the electric car? Is it still 5 to 7 years away?
I think so, Brian. I think that if we're talking hybridization, we are already in our full future portfolio, in this direction. There's no doubt about it. In terms of full electric cars, we need to be different from the others. Therefore, I don't see that coming in the short term. That's for sure.
Stefano, are you joining us from Bologna, from your headquarters there?
Correct. This is my office.
It was amazing. I know you got back up and running about 2 months after the lockdown in early May. And just a few days later, you released an update to one of your Lamborghinis, I guess a rear wheel drive. Tell us about that car.
Well, Alexis, you are pretty well informed. I'm very happy for that. And yes, it's right. We just launched thanks to the technology of augmented reality that we did together with Apple, the launch of the last model of the Huracan family. Huracan two-wheel drive Spider is the perfect car for young generation because it's two-wheel drive. You have a different way of having fun with the car. It's a lot of connectivity tools inside the car because this is really the things that you don't you need when you're driving the car, above all for the ones that are really loving the brand. And well, it has been already a great success in terms of attention. Now it's really looking forward to the cars around the world because we are starting the shipment now and really looking forward, as I said, once, to see real cars back where it belongs. That is the street, that is the track, that is the place to enjoy our life because we are pretty lucky that, we are producing this marvelous jewel.
Yeah, these cars were made to drive for sure. Before we let you go, just give us a feel for what things are like there on the ground. I mean, I know Bologna, northern Italy, was a hot spot at the peak of this virus. What are things like now?
Well, Alexis, now we can see the light after the tunnel. That is a great thing, to be honest, because I have to say, I'm an Italian, proud Italian. I have to say that to stay in a lockdown situation as we did for 1 month in the house without having the chance to get out, believe me, it is really difficult. It's something that when I was doing that, I said that is not really something that I think that I'm living. It's like a nightmare. Therefore, the behavior of the people was really extraordinary. Now, I think that step by step, we are going in the right direction. We need to stay prudent, of course, but I see life coming back again. And I really hope that the borders will open soon in order to go back to our normality, because we are a people that loves to stay together. We don't have to forget that.
I think we're united in that. We feel the same way over here in the U.S. Stefano Domenicali, Chairman and CEO of Lamborghini, a pleasure. I expect a test drive when I see you in person next time, okay?
Alexis, deal done.
All right, thanks so much. And stay with us. We're getting closer to the opening bell here on The First Trade. We'll be back right after this. We are back here on the first trade, and we've got stock futures lower across the board. Let's check in with Jared Blickery. Jared, it looks like the S&P 500's 4-day winning streak may be in jeopardy here.
Yeah, a little bit of a pullback here, especially after the jobs data and some of the other data that came out at 8:30. We do have stocks under a little bit of pressure here. Just looking at the Wi-Fi interactive world map, we can see that we had some strength in Asia just a little bit early on, but broad weakness in Europe. In London, the FTSE is down about 0.8%. The DAX and CAC 40 also down, but under 1%. In the the S&P 500 futures, as you noted, under a little bit of pressure here. And here's what happened after the jobs report. We got this dip, and I'm trying to draw it. There we go. But we did come back up and pare some of those losses. Now, looking over the last 5 days, we came off a critical level here. 3130 is longer-term resistance. We haven't seen that level in quite some time, and it's kind of the last holdout for the bears. So not necessarily that we have to go down from here materially, but probably taking a little bit of a pause. Let's take a look at some of our other markets, because we do have some interesting things going on in bonds and also the US dollar. Now, bonds are staging, at least the yield is staging a comeback here. If I can get a chart of the 30-day, no, it looks like my charts are all out of whack here. Anyway, we do have bond yields climb to their highest level that we've seen in several months. And we also have the US dollar index reversing some of its losses over the last 5 days as well.
All right. Even though we can't see the chart, I believe you, Jared. And crude oil is pulling back a little bit today, down nearly 1%. We're going to talk more about in a little bit. Stay with us. So the opening bell coming up on the first trade. And we have another day of trading underway on this Thursday morning. We saw stock futures coming under some pressure here for the first time in about 4 days. Looks like the Dow Industrials are going to start the day down about 90 points. Let's bring in Mike Ryan. He is America's CIO at UBS Wealth Management. We also have with us Jared Blickery and Brian Sozzi. Good morning to you all. Mike, I'm curious what you think the market, what has been driving this market lately, because it doesn't look like it's been the pandemic or the civil unrest we've been seeing in this country. So what's sort of been driving the momentum?
Well, first of all, Alexa, if you think about it, since March 23rd, the markets have kind of pivoted, and we've seen markets are up. The S&P 500 is up almost 40%. And I think a lot of people are seeing a disconnect between what the markets are doing, what the real economy is doing. But I actually think what you're seeing is the markets are actually reacting rationally And what they're responding to is this extraordinary policy deployment. So think about this, between what the Fed has done and what we've seen elected officials do through fiscal policy, this is the largest mobilization of government resources, certainly since the Second World War, and arguably ever in peacetime. So that combination of just extraordinarily accommodative monetary policy and increasingly muscular fiscal policy is allowing people to sort of look past this sort of void we're seeing right now in terms of the pandemic-related downfall in the economy and that bridging process that we see into 2021. So I think we're looking through this year in terms of both the economy and earnings and into normalization in 20 and 21.
Mike, it's not just the U.S. With fiscal stimulus, monetary stimulus. Look what the ECB did this morning. That is just extraordinary policy. And do you think that we were asking a lot this week, is the market overvalued? But in light of this stimulus, do you think the market is undervalued? And we could appreciate 10 to 15% into year end, even despite all those things we're seeing in the country and even with COVID?
Look, there's certainly prospects that we could see a further melt up in markets. I certainly wouldn't be dismissive of that. But I would make the argument that markets are now undervalued relative to what we've seen in terms of both the policy measures and where markets are repriced. I think the markets have accurately reflected the extraordinary policy reflex response we've seen, again, both by central banks and federal governments. I think what's going to be required now for markets to continue to grind higher is we are going to have to see some progress on three fronts. One, we are going to have to see that the war against pandemic is yielding some meaningful and sustainable results. In other words, that we've not only bent the curve, but we're actually starting to see that the caseloads continue to decline. So that's one thing we're going to need to see. Secondly, we need to see that there was enough of the commercial infrastructure that was preserved through this dark period that the economy restart can happen quickly enough. One of the concerns we always had was that when you have these kind of shocks, unless you have a massive policy response, which you're going to wind up seeing, is a concern then that you destroy a lot of the commercial infrastructure. So the view here is that I apologize for that dog in the background. You can tell we're all working from home now.
I thought that was my dog for a second.
So the issue here is that we need to see the economy is going to work through that transitional period. And maybe the last thing is, I think we are looking also for some pharmacological progress.
I think your dog is agreeing with you, Mike. That's
dog's bullish.
I'll tell you, that little dog doesn't agree with you very much, Lexus.
It's okay. We've had babies crying and dogs barking, so that is a symptom of working from home. Where are you putting client money to work right now? I mean, is it primarily in U.S. equities, and if so, what sectors?
Well, first of all, we are actually taking an approach where we do have exposure in credit as well. We think that the equity markets probably run ahead of the credit markets, and that we do see some opportunities in credit, both investment grade and high yield. In terms of our sector positioning, we've actually increased our cyclical exposure because while the market has run higher, there have been some laggards, and we think there's going to be some catch up now. So we do have a moderately cyclical bias. The three sectors we're focused on right now is going to be communication services, it's healthcare, but also industrials. We just recently upgraded our industrial exposure. So again, it's a little bit of a mix between defensive and cyclical, but we're coming increasingly cyclical. And we also have a preference for mid-cap stocks in this environment.
All right, Jared, I want to get over to you. Before the opening bell, we talked about how the 4-day winning streak for the market was in jeopardy. What do you see moving us early here in the morning?
Well, we have discretionary. Consumer discretionary is the only sector of the 11 in the S&P 500 in the green right now. Outperforming is staples, also in materials and industrials. That's a continuation in terms of industrials and materials over trends we've seen over the last few days. The laggards, real estate, energy. We have crude oil down about 1.5%, despite OPEC, at least the Saudis and the Russians, agreeing to extend the production cuts for one more month. But just looking at the NASDAQ heat map, we can see FANG stocks, the big cap stocks, under a bit of pressure, except for Amazon. That's carrying the discretionary sector. Sorting by performance, we're going to see some travel stocks up there. The airlines are really catching a bid this morning. China is going to be reopening U.S. flights with China, not only for their own carriers, which they've already done, but ours as well. And also the federal government is easing some of the restrictions on the travel on the airlines in terms of the points that they have to serve. So in other words, they're going to be able to cut some costs. But it looks like the chip stocks kind of underperforming. Broadcom here, we see it down 2%. That is the laggard in the in the NASDAQ 100. They reported earnings after the bell yesterday. Microchip down as well. Even Zoom Technologies it's down today, still up 6% over the last 5 days, and year to date still up 223%. But just looking at the sector action, once more, we can see industrials, discretionary materials are in the green right now. And I just wanted to point out something kind of bigger picture. We have this interesting stat that comes from LPL Financial. We are on the best 50-day rally ever. All right. And so what does that mean going forward? Do we get a sell-off? Actually not. Going 3 months, 6 months, and 12 months, the outlook looks pretty good. The median return over 3 months is 6%, 6 months is 9%, 12 months is 19%. But as I said earlier, kind of taking a pause here after we hit that resistance level on the S&P 500, Alexis.
Mike, you just heard what Jared was saying. The market, no surprise to you, I'm sure, is in major rally mode here. Do you think what we're seeing on the street is fear of missing out?
I think that's a bit of it, Brian. Remember, we're seeing this massive rally, but it comes after an extraordinary sell-off. You think up until March 23rd, this was the most significant and sustained accelerated sell-off we've seen in history as well. So it's not terribly surprising that we're going to get a fairly sizable bounce back from here. So I do think what you are seeing now is that there are some people who have been caught off sides here, people who are looking for perhaps that we'd see a secondary outbreak or that the impact of the pandemic on the global economy would be sustained for a longer period of time. So I think there's been some unwinding of that initially. I think what you are starting to see now is people who thought that the recovery would play out in a much more methodical fashion, people who were sort of waiting for entry points and now being forced in. So you're starting to see increasingly now that people are looking at, looking through again this transitory period and focused on what we'll see in 2021 and 2022. So to me, I think there is a little bit of this anxiousness right now of people who missed the first part of this route on the sidelines for us.
Mike, tomorrow we have the May unemployment report. It's going to be a market-moving report, and we're expecting another horrific number. But is the market basically discounting this now because economies are starting to reopen? It is such a backward-looking number.
Yeah, Alexis, I think employment reports are always important. If you go back, I would argue it's probably one of the most important economic releases we get each month because it's relatively comprehensive and it gives you a snapshot of things that are happening in terms of demand for labor and also in terms of what's driving the economy and also cost. So it is a pretty comprehensive measure, and it's one that's also tends to be relatively timely. I think we have to take most of the high-frequency economic data we're seeing right now with a bit of grain of salt because the facts on the ground are changing so quickly. And as you just mentioned, it is backward-looking, and what we're seeing right now is the pandemic slowly unwinds, and as we start to see the reopening, the dynamics in terms of the economy are changing so quickly that you can't capture that with monthly employment data.
If Mike, do you think if the headline number comes in better than expected, the market does rally? And I ask that because we've seen a stretch over the past week and a half where economic data has come in much more, I think, much better than a lot of people expected, and that has been the fuel to this rally.
Yeah, I think you're right, Brian. First of all, look at what we're seeing in terms of the ADP numbers, the ISM numbers, and certainly even the personal income numbers. When we saw above consensus reads there, what you saw was as a response. Again, there had been this expectation that this recovery process was going to be a long, drawn-out affair, that it would happen in incremental doses. And what you are seeing is the quicker there's a bounce back, people are starting to talk less and less about L and even more or less about U, and perhaps even that this may be a really, really deep V recovery where things bounce back much more quickly. And I'll go back to one of the things I said before, Brian. Part of what allows for this recovery was preserving the commercial infrastructure. And I can't emphasize that enough. One of the worst things that could have happened is if policymakers had done nothing. And what we would have seen then is we would have seen bankruptcies, defaults, we would have seen liquidation of assets, we would have seen business failures. And then to restart the economy is incredibly difficult because you have to go through the process of new business formation, raising capital, establishing credit lines, entering into contracts, hiring workers. That takes an awful long time. So the more of the infrastructure we're able to preserve, the more of an economy there is to bounce back as we reopen. I'd also argue one other thing that's probably constructive here, which I think people didn't appreciate early on, was the fact that this economy has a staggered story, that we're not trying to reset everything at the same time. What we are seeing is regions that were less affected are starting earlier. And that's important because we're getting critical information about what works and what doesn't work. And that information can be applied across the rest of the economy. So that real-time processing information means we're finding out that there are certain types of businesses and services we can open earlier than we would have thought because the infection rate is not spiking in those instances.
All right, Mike Ryan, America's CIO at UBS Wealth Management. Pleasure. Thanks for being with us.
Thanks, Alexis.
And stay with us. We're going to take a deep dive into the oil pits with John Caruso on the other side of this break. All right, let's talk a little oil here. We've got crude oil down more than 1.5%, 36.66 a barrel. It looks like Saudi Arabia and Russia have agreed to keep deep production cuts in place into July, but the rest of OPEC Plus is not yet on board. And that just as hopes are growing that reopening economies could push a big increase in demand for oil. Let's talk about this now with John Caruso. He is a senior asset manager at RJO Futures in Chicago. John, good to see you again. So is extending these cuts enough to boost the price of oil?
Well, I think you've got to kind of take a look back and look where we were and in terms of how far we've come. The price since the July contract low, we've rallied more than 100% right now. So I'm actually in the camp that believes that we could see a 3 to 5% correction, a little bit of a setback from here. We are seeing some softness in the market this morning. Perhaps a little bit of a buy the rumor, sell the fact type setup in the market. I think the one thing you want to really keep an eye on is compliance going forward. We do know that there's the Saudis and Russia's, there's a handshake agreement to extend the cuts through July. But from what I've seen, compliance of the 9.7 million barrel cuts per day back in May was only running at about 74 or 75%. So there was some cheating going on in the market. I really think you need to watch that going forward, and you're going to see that in the weekly inventory numbers.
John, you know me, you've been on enough. I'm always looking out for oil price spikes somewhere, but I think I finally have a case to be made that maybe we do see an oil price spike this summer, early fall. Look at the market, look what the stock market's doing. FOMO, rip-roaring rally. Why hasn't oil caught up yet?
Why hasn't it? I'm sorry?
Why has it not caught up yet with the market rally? Just the broad market rally in stocks. Clearly the market is saying something.
Sure, absolutely. Well, I'll tell you what, I mean, this reopening of the economy, it's happening very slowly. I can tell you just from, being here in Chicago, that there's still a lot of downtown that is still very quiet right now. A lot of offices haven't reopened. So you're not getting that commute to the bigger cities every single day. So the demand side of the equation is still very much, there's a lot of question marks hanging around demand going forward. We have certainly seen a big step forward in terms of the supply-demand fundamentals with the production cuts. Slowly, the economy seems to be coming back online. But if you look back at yesterday's inventory numbers, we did see some softness in the products. We saw some bigger builds than expected in the products, and that certainly is a factor with demand.
John, looking back at how we emerged from the Great Recession, does that tell you anything what might happen with oil as economies start to open up?
To be quite honest with you, I mean, going forward, after perhaps a 3 to 5% correction here in the near term, going forward, we actually are going to be pivoting to being very bullish on oil. I do think you could see oil run up into the mid 40s at some point over the summer. There is a gap in the market up at 42 that I do think the market's going to likely close at some point from July to August. So, you know, after perhaps a small correction here in the market, we're going to be looking at becoming more bullish on the price of crude going forward.
But John, do you think that fundamentally the pandemic has sort of shifted oil markets going forward?
Sure. There's no question about it. You know, until we start to see lower viral loads, we actually have seen lower viral loads, but everybody's kind of awaiting, are we going to see that second wave hit us in the fall time again? So there's still a lot of question marks in terms of where demand is going to be a year from now. But I do think over the course of the next couple of months, it's not going to shock me to see the price of crude oil reflate into the $40 level.
And John, longer term, I think the pandemic has showed us that we can get our work done at home. We can get it done at home. What's the longer run outlook for oil, do you think? Maybe we're taking less public transportation. Maybe we're driving to the work less. Certainly, maybe we're taking Uber and Lyft less.
Sure, absolutely. The game has completely changed going forward. You know, we're going to be monitoring those developments going forward. You know, I do know that in the back half of this year, OPEC is likely going to be tapering these production cuts. I believe after July, they're expected to fall back to 7.7 million barrels per day through the end of the year, and then lower it even beyond those levels out into next year. So, you know, there's a lot of question marks in terms of demand. Like you had mentioned, you know, the game has certainly changed in terms of transportation. And there's a lot to certainly be looking forward to in from that regards.
All right, John Caruso, Senior Asset Manager at RJO Futures there in Chicago for us. Good to see you again.
Thank you so much.
All right, stay with us. When we come back, we're going to take a look at how office buildings are re-strategizing amid the pandemic, and we're going to hear from Arianna Huffington on that and many more right after this. There are now over 1.85 million confirmed cases of COVID-19 in the U.S. That's according to Johns Hopkins. And that is changing the way we think about the conventional office space. Akiko Fujita joins us now for more. Akiko, as part of your series, you spoke with some big names in the commercial real estate space about how they're changing everyday business. What did you find?
Yeah, Alexis, it's interesting. We've talked so much about the tech companies like Facebook and Twitter making this more permanent shift to work from home. But the reality is most companies are looking at a more fragmented workspace. So we're talking about some visits to the office with staggered hours, some work from home, and yes, still a lot more Zoom calls to come.
So the first thing when they step out of the lift is they're going to notice that the doors are open, so they're not going to have to touch a door to come in.
Americans returning to work face a dramatically new office experience.
You've got 3 chairs here. How many did you have before?
We would have had 6 before.
There's less furniture here and fewer desks.
What we do down these line of workstations is we take out every other workstation, and then people will be able to maintain that safe distance.
And there's plenty of reminders to keep that distance, as we learned firsthand. Cushman & Wakefield calls this the 6 feet office.
2 of the areas we're really focused on is maintaining that social distance while we're in the office, also just reducing the number of touch points.
Employees here use keys instead of their fingers. They stand in marked corners. They're required to walk clockwise around the office to avoid congestion.
The overarching approach has been, how do we create these safe environments with a limited amount of time and a limited amount of capital to make them accessible for everybody?
Other offices are turning to tech, installing thermal imaging cameras to check temperatures and air filtration systems. WeWork expects employees to stay closer to home now. It's launching software to help clients find locations nearby.
This technology that we're that we put together and we're rolling it out gives enterprise companies the ability to map out their people to our various locations. If you have 4,000 people, they don't all have to be in 1 or 2 locations.
What does that mean from a business standpoint from WeWork? On the one hand, you're saying there's an opportunity of more businesses coming in, but just as equally, you've got to have a lot of businesses that may not have the same footprint they did pre-COVID.
Net, we have greater demand today than the members that we've lost. Enterprise is about 46% of our business today. We expect that number to grow to about 70 to 75% of our revenue over the next 12 months.
But companies like Facebook and Twitter see remote work as more permanent. That's altering the definition of the office.
Do you think we're seeing a permanent shift in the way we actually look at the workplace?
I absolutely think we're never going back to exactly where we were. And in many ways, that's a good thing. I think there's going to be much more of a hybrid future of working from offices and working remote.
Huffington expects that to lead to a shakeup of C-suite roles. Mental health now a priority with employees working in isolation.
Who takes on that role of ensuring that part of the equation?
The heads of HR departments are now the most important executive in the company other than the CEO. The health and wellness of employees has now been moved to the front burner.
The changes giving new meaning to business as usual, with our workplace changed forever.
Now, Cushman & Wakefield did a recent survey looking at all of their properties globally, but also speaking to their tenants. And they found that 50% of those in the workplace plan to use this, what they call this total workplace ecosystem. So the fragmentation of a little work from home, a little work from the office, more online. What I thought was interesting about all this, in my conversation with WeWork, they said, look, we're going to have to start thinking about headquarters no longer being a thing. So those big office spaces we're seeing here in Midtown Manhattan, more and more people are not going to want to take the train into work. And so now you're seeing these companies also looking at the suburbs to see if they can lease out some office space there.
Yeah, it sort of really puts WeWork though up on its head, doesn't it? I mean, their whole strategy just sort of gets upended with not a lot of people needing to be in one place at one time. But I'm curious about cost. Who's going to be burdened with that? Is it the landlord? Is it the company themselves? Is it a shared cost to outfit the space the right way?
Yeah, it's a shared cost, but that's why you heard Cushman & Wakefield there say, we're trying to come up with solutions where people feel comfortable, where people are safe, but that don't have a very high capital cost. Because when you think about it, yes, there is still that potential for a second wave, but how long is this really going to last until we get that vaccine? And so what you're seeing a lot of companies say is that they don't want to make these huge investments because ultimately they think that there's a possibility this may all go back to where we used to be once the vaccine's in place.
Well, we are holding out hope for that. Akiko, thanks so much for that reporting. Fascinating stuff. All right, let's check in with Jared Blickery for one more check of the markets here in this 9 o'clock hour. Jared?
Yeah, we got a mixed market underway. Dow is down just slightly here, about 10 points, trying to fill the gap. The NASDAQ up 16 basis points. Biotech is outperforming, and chip stocks have come from being the early laggards to early leaders. S&P 500 down just nominally about 2 points there. Here's the two-day price action. You can see we just kind of dipped into yesterday's midday range, and now we're trying to fill that gap right there. Over the last 15 days, we are up 10.7%. And year to date, this gives us a picture of the resistance level at 3130 that we just hit yesterday, which may indicate we may be due for a slight pullback here. Also, I want to get to the bond market because it is staging a breakout, at least in terms of yields. And we can see this on a 3-month basis. This nice rounded bottom that we have here, we still want to see it close above 80 basis points. That's this level right here, but some constructive motion for risk markets right now. Finally, U.S. dollar index. That is up right now, breaking a 5-day losing streak. Might have to watch out for a false breakdown here because the U.S. dollar is famous for that. And just look at the NASDAQ heat map here. It is kind of a mixed market, but the FANG stocks are in the green, Alexis.
All right, thanks very much for that, Jared. Also want to tell you today that the trade deficit widened. U.S. exports and imports both posted their largest monthly decreases, on record amid the coronavirus-related shutdowns around the world. Coming up on the first trade, can the electric truck company Nikola become the next Tesla after going public? We're going to speak with Nikola's CEO coming up after this.
All right, welcome back to the first trade. I am, of course, joined by my co-anchor, Alexis Christoforous, and you're seeing the market come back off the worst of today's session. You're seeing the ECB come out, major new bond buying program, and no doubt about it, FOMO, or fear of missing out, has gripped Wall Street. But before we dive into the markets here, let's get right to Inez Ferre for a look at some stocks here. Inez, you're on the retail beat right now.
I am, Brian, and I want to show you what's happening with eBay hitting a record high of more than 6% after the company raised its guidance for the current quarter. eBay saying that business is performing significantly better than expectations that it shared in the last earnings release. It increased its range for its earnings per share. Taking a look at Michaels, that stock is down more than 7% after a disappointing first quarter. Same-store sales were down more than 27%. The company reported a net loss compared to a net income a year ago. Michaels introduced curbside pickup and same-day delivery. Its e-commerce grew by 296% during the quarter. It does expect all of its stores to open by the end of the month, but year to date, the stock is down 47%. And then just taking a look at Twitter slightly under pressure, but also I wanted to show you, besides Twitter, also Boeing. That's the next stock I was going to. Boeing, more than 4%. Best performer right now on the Dow today. Amazon said at least 12 Boeing 767 jets converted to cargo from its air transport services group to meet the surging demand for online orders. And one of the new aircrafts joined Amazon's air cargo operations back in May, with the remaining 11 joining in 2021. And Amazon has really broken out from that 150 level that it was hanging out at for a while. You can see over the last 15 days, that stock really rallied. Brian?
Yeah, it is. I guess folks aren't knitting and buying fake flowers at Michael's. Tough quarter for them. We'll talk about it.
Back to soon.
Let's stay on the markets here and bring in Megan Horniman. She is Director of Portfolio Strategy at Verdence Capital Advisors. Megan, good to see you again. And as I mentioned at the top of the show, the markets are coming off the worst of the session. As you take a step back and you study these markets, you look at valuations, do you think the market is simply getting frothy?
I think in the near term, you definitely could see a period of consolidation. If you look at some of the technicals in the market, whether it's the low put to call ratio, which tends to signal some complacency entering the market, or it's some of those momentum indicators that are signaling overbought conditions, we have had such a significant run off of the bottom. Some of these US indices, for example, are up 40, 50, 60% from the lows, and the NASDAQ has actually entered positive territory for the year. Now, what history does show us is that when you have such a steep decline like we saw in March, you do tend to see a pretty big momentum rally after that. However, you do tend to see, once you get into these types of levels, that there is room for some near-term consolidation as people look at valuations that are at heightened levels.
Megan, where might we see that momentum coming from in terms of sectors? Are you going to start to see a rotation out of the cyclicals and maybe into, I don't know, defensive plays, maybe elsewhere outside of U.S. equities, perhaps?
So you have seen some of that momentum shift, or that style shift in recent weeks. Actually, you've seen some of those sectors that didn't participate in the beginning of this rally start to participate in this. So there is some positive signs that we are seeing the breadth of the market a bit better. We think that rotation can continue because people will be looking for value where people have left that behind. So we think that'll continue not only within the U.S., for example, in the small and mid cap space, the value space, but also internationally as well.
Megan, I've got market melt-ups on my brain this week. I'm looking for them. I'm seeking them out. And I look at what Zoom did yesterday. Came out, beat big. The stock pretty much went up in a straight line. To me, that's somewhat of a market melt-up. Where are you seeing pockets of overvaluation? Is it stay-at-home stocks? Is it those 5 big cap tech stocks that have essentially powered the market off to the lows?
Yeah, I think it's definitely those big cap stocks that came off of the lows so strong and made up the majority of the start of this rally. That's called a momentum play, and it's dangerous to follow that because that can quickly shift when sentiment shifts. So we're waiting for a better entry point into some of those areas before we would feel comfortable adding there. But you have to remember as well, this melt up is being driven by a couple things, and really 2 in particular. The first one is that the Federal Reserve is pushing investors into the equity market. When you have about 90% of the stocks, in the Russell 1000 paying a dividend higher than the 10-year bond yield, that's the Federal Reserve's doing what they were set out to do, and that's to push people into risk assets. The other factor is that when we came into this pandemic, the one thing was really unknown was the human element and the emotion on how they would return to the economy. So while a lot of the economic data is backward looking, we can look at things like air travel, turnstiles in New York City, public transportation. We can look at the amount of people, their weekly gas demand, and we can see that appetite that consumers are as far as going back out and re-entering the economy. And that's a positive, and that's what the equity markets are holding on to right now. Now, once we start getting the real hard data in June and July, that may test the sentiment as well.
Megan, how important is tomorrow's May jobs report to this market? Again, because it is backward looking, how much of it are you really, looking at in terms of trying to guide the way you're going to be looking at your portfolio?
So right now, the backward-looking data, while it's important, we're more focused on the forward-looking data. So things like today with the continuing claims, that was discouraging because you did see that tick up. While the number of jobless claims came down, you did see that continuing claims tick up. So that's a bit more important. Some of the other underlying forward-looking labor market indicators that we'll look at is in some of the business surveys. So while an unemployment report is always important to look at, we're really going to be focusing on some of these other forward-looking economic or labor market indicators to see what the impact on the economy is.
Megan, given the stimulus we have seen that has been pumped into this market, do you think we break through the February highs before year end? Or maybe even earlier? Look, the S&P 500, 7.6% away from those February highs now.
It's certainly possible. I mean, I think when we were looking at the depths of the lows in March, that if anybody had to foresee that we'd see a 50, 60% rally as quickly as we have out of those lows, I think some people would be surprised at that. So I think it's definitely possible, but there's going to come a time where the underlying fundamentals need to support these valuations. And that's what really is going to be tested in the coming months, because as I mentioned, we'll start to get some of the hard data from when these states started to reopen.
What about some possible headwinds in addition to, we know, the ongoing pandemic? How much of a threat is the trade tensions we're seeing between the U.S. and China, and how is that sort of part of your thinking when it comes to the market?
So there's several things, I think, over the next couple months that are a risk to the market. As I mentioned already, from a technical perspective, it's signaling the market's a bit complacent and overbought at these times. You mentioned the U.S.-China trade tensions. That's always a concern. That's been a concern for quite some time now, even before the pandemic. Yeah, there's also seasonality that comes into play. So these are risks that we think could go into the summer months. And the other thing is sometimes it's just a valuation correction. You can't foresee that. You just have to be careful that you're not going into that valuation correction buying the most expensive stocks. So we're sitting back right now, patiently waiting for a better entry point, and we think you could see that in the coming months.
Market, Megan, 10 seconds here. Jobs report comes in better than expected. What's your first instinct? Buy or sell?
I would stay where you are. I wouldn't buy, though, because the valuations are too high at this time. I would wait to see if there's a bit more of a pullback in the market.
All right, let's leave it there. Megan Horniman, Director of Portfolio Strategy at Verdence Capital Advisors. Always good to see you. We'll talk to you soon. All right, do stick around. Much more ahead on the first trade. Las Vegas is back open in business, sort of, kind of. Stay tuned. All right, welcome back to the first trade. It's a big day in Sin City. This morning, many of the big casinos along the Las Vegas Strip are reopening for the first time in months after getting the all clear from the governor and local officials, and it couldn't come too soon. Las Vegas has a whopping 33.5% unemployment rate because so much of its economy is in fact tied to tourism. Let's talk about it and the reopening with Steve Hill. He's the CEO of the Las Vegas Convention and Visitors Bureau. Steve, good to see you. What does this reopening of Vegas mean to your business, but to the city more broadly?
Morning, Brian. You know, it's a great day here. We are excited to welcome our visitors back, welcome people back to their jobs, which is a critically important part of this as well. And it is a great first step. In fact, it's a bigger first step than we thought we were going to be able to take. There's been a lot of demand to come back to Las Vegas. We've missed our visitors, they've missed us, and it shows.
What are you hearing in terms of tourist interest? Are people planning trips there? Are they approaching those trips differently? What's your feeling about, you know, how folks are going to feel about walking back into a casino and then staying in those hotels?
Yeah, I don't think it's unexpected that we're basically seeing our visitors in three groups. There's a group who are coming back today, who can't wait to get back and are excited to do it and are willing to do it in the face of the economic crisis, the health concerns. They trust us. They have peace of mind that Vegas is a safe place to be. The next group is ready to come back, but a little bit more in a wait and see mode. And we need to do this right over the next month, 6 weeks, to show that group that it is both safe and a great time to come back to Las Vegas. And then we have others who are just really not considering returning for 3 to 6 months, somewhere in that range. So we know that it's going to be a ramp from where we are through the rest of this year and into the early part of 2021. But the opening has been really larger, had more demand than we would have originally thought.
Steve, what does demand look like for bookings in the convention center? I know you have CES coming back in the mix here, but do you see businesses renting space out? Is that starting to come back?
Well, it actually, at some level, has just been put on hold. Interestingly, we are going into the next 12 months with the largest schedule that we have ever had. Now, that will look different. It will, it's somewhat questionable as we enter into August and early September, whether some of these shows can actually happen. But our customers also want to come back here at the convention center. They'll just have to come back in a somewhat different way, maybe bigger spacing between displays, larger aisle sizes. The social distancing will have to be a part of large meetings, and we'll evolve through that over the next several months.
Steve, we see the civil unrest in our country right now. Are you over the killing of George Floyd? Are you concerned that might impact demand from tourists on top of the pandemic? Are you hearing that they don't want to travel right now or be in places like Vegas where many people can come together at once because of those protests?
Well, it was a concern. And what we've seen from a booking pattern and a cancellation pattern, that really has not manifested itself. The city, the industry, not only respects the right of the protesters to protest peacefully, we support that. And our police department here has worked with the protesters to make sure that we offer them that opportunity to do so and do it in a way that allows us to bring our guests back to Las Vegas as well.
Steve, speaking of the police, what does that police presence, what will that look like when people start coming back?
Well, they're certainly visible around the protest areas, and they'll be visible anyway. But it will be in response to what's happening on the ground. We have a lot of experience with really large 300,000 people on the Strip for New Year's Eve, for an example. And there's a very visible police presence there, but there's also a sense of customer service around that. So while that presence is there, they understand how the correct way to deal with our guests, to deal with whatever is going on the Strip.
Steve, how different will the gambling experience look like? I've seen images online, table games spaced further apart. What do the restaurants look like? What are you seeing and hearing?
Well, for the most part, the social distancing dictates what the casino floor, what a restaurant will look like. So that is either, for example, with slot machines, every other slot machine being turned off or potentially removed from the floor, spacing between table games, both in terms of the tables themselves, as well as limiting the number of players at each of those games. So, capacity between 25 and 50% of what it normally is will be kind of the standard for a while.
All right, we'll leave it there. Steve Hill, CEO of the Las Vegas Convention and Visitors Bureau. Good to see you. Good luck. I know it's a big day for you out there.
We appreciate it. Thanks for having me.
All right, do stick around. Much more ahead on the first trade. Big day for electric automaker Nikola. It will debut on the NASDAQ. And we have the founder, Trevor Milton, coming up next. Welcome back to the first trade. Let's take a look at one of the companies we're watching on yahoofinance.com and on our trusty app. Chinese electric car maker NIO is on the rise after it revealed it had record deliveries for the month of May, and the company received an upgrade from Goldman Sachs. Inez Ferre is back with the details. Inez, this company's still not making any money, but at this point for them, any news looks like good news.
That's right, Brian. And at the end of April, they secured $1 billion from Chinese entities. So certainly the stock has been rallying over the last couple of months, but you can take a look at the numbers for yourself and you can take a look at the stock, what's happening today. It's up more than 4%. And this NIO announcing that it delivered 3,436 vehicles in May. That represents a 215.5% growth year over year. Now, the bulk of those deliveries were their ES successes. That's That's the company's 5-seater electric vehicle. The ES8 is relatively new. That's a 7-seater SUV, and those were 751 vehicles delivered. But as I mentioned, the company secured at the end of April $1 billion from state-owned entities, and it's showing also that the electric vehicle market in China is rebounding. It received some recent upgrades, including Goldman Sachs, JP Morgan, Merrill Lynch, who all upgraded the stock. Goldman Sachs increasing its price target on NIO to $640, and also saying it's the first time a domestic premium auto brand has had a waiting list. So you can look at what the stock has done year to date. It's up 46%. You can see right here around the heart of the pandemic, around end of March and April. That's when you saw the stock go below $3 a share. But right now it's rallying today on these latest delivery numbers, Brian.
All right. Thanks so much, Nez. Staying on the car beat, electric and hydrogen-powered automaker Nikola has officially combined with Vecto IQ Acquisition Corporation. The combined company shares will trade on the NASDAQ under the new ticker symbol NKLA. Here with us now is Nikola founder Trevor Milton. Trevor, big day for you today. One of your early investors at ValueAct, Jeff Ubben, has called you a potential $100 billion valuation company. How do you get there, and why does that sound? How can you achieve that?
Yeah, it's a big day today. Obviously, we're traded on the NASDAQ finally. So today is our first day on the NASDAQ in KLA. And to answer your question, how you get there is because we vertically integrated the entire supply chain. It's very similar to Amazon. You know, when Amazon, when you buy something, they handle everything from the warehousing of it to the packaging of it to the shipping of it to the delivery of it, the whole thing. And that's what sets Amazon apart from everyone. Nikola is very similar. In the trucking world, everything's split up. And so when you buy our truck, you get the truck, you get all the fuel with it. It's all zero emission. And then you end up getting all the service, warranty, and maintenance also. So by vertically integrating that whole supply chain, we make 5 times more revenue than our competitors per truck sold.
Trevor, I know a number of companies are trying to come out with these all-electric trucks. You got Tesla, Daimler, Freightliner. Yours, though, is the only one that's hydrogen-powered. It's a hydrogen-powered big rig. I know you had some big-name clients lined up pre-ordering some of these, including Anheuser-Busch. Given the pandemic, though, have those orders changed? Are people pulling out of those orders, or are they saying we need a little more time before you actually deliver the truck? What does demand look like right now?
No, I'd say it's probably gone up. The reason that we've seen so far is that people have kind of correlated the sicknesses around the world with a lot of emissions. And you've seen all the countries actually double down on their emission requirements and say, this is a huge part of the problem, so we need to fix it. So Nikola offers both actually hydrogen trucks and also battery electric trucks. So we compete with Tesla and Daimler, obviously. Not just compete, I would say that we are the very first OEM in the world with a full production Class 8 zero emission semi-truck coming to market. So next year, our trucks come off the assembly line, and we're the first company in the world with a full production line on our semi-truck. So we beat everyone to it. And then we have our hydrogen truck coming the year after. So I think that's why there's been so much excitement about Nikola is we don't just cover one part of the market. We essentially allow people to have either option, both battery electric for up to 300 miles and then hydrogen for over 300 miles of range.
Trevor, the last number I saw on Nikola, you had 14,000 pre-orders representing close to $10 billion in revenue. What's the latest number?
You know, that was actually quite a while ago. We stopped taking orders for a period of time. It was ultimately what happened was fleets were being told they were going to be 5 years out, and that's just too far to plan. So once we hit about $10 billion in orders, we were just making people mad. So what we did is we just kind of put a stop to counting the numbers. If we were to open all those order books up right now with all the people that have said, hey, we want these trucks, you would see a much, much, much higher number than that. But it just ultimately just made people mad waiting that long.
You know, Trevor, hydrogen-powered vehicles have never really caught on in the passenger car space. Do you think, why is that, first off? And do you think that might change over the next decade or so?
Yeah, so in the passenger car, it's a little more difficult because the cost of a fuel cell is pretty expensive. And so you don't have like a economic return on that. And so it becomes more of a philosophy or a belief to own a hydrogen vehicle on a passenger car level. They are awesome. I think the cost will come down eventually. But what Nikola solved was the economics on the trucking. When we first started, hydrogen was $16 a kilogram. We can now produce it for well under $4 a kilogram. So we've cut, you know, it's 1/4 of the cost now than it was just a few years ago. And we're now cheaper to operate per mile than diesel. And I think that's the key why. And with a semi truck, you're making that money back on a daily basis. So people, if there's a, you know, X amount of premium on the truck over a period of a few months or a year or whatever it may be, they can have all their money back already. It's a return on their investment. And it's because that vehicle makes them money. That's why it's been so successful finally.
Trevor, people close to you know you as a person of great faith. You know, what have you told your 350 employees about the unrest, the social unrest sweeping the country? But importantly, what are you building in terms of diversity as you scale this company up? You're in a very unique position, a lot of orders, really key business. But how are you building that into the DNA of the company?
Yeah, from day one, you'll see that. Nikola was founded that way from day one. Around the employees are family, and when you have family, you don't look at them any different than you know. My family's my family, regardless of who they are, right? And I think that's what's amazing is that there is no difference between anyone inside of Nikola. We have an enormous amount of diversity here. Probably one of the highest women to men ratios in the entire automotive industry, which I'm really proud of. Hard part is you can't, you know, there's so many people out there looking for great diversity inside a culture. It becomes harder and harder to maintain that culture. And I think that's what's cool about Nikola is from day one, we've just been a mix of everything around the world. And we just treat everyone like family. I mean, here at Nikola, there's nothing's tolerated ever. Someone's ass would be out the door so fast if they ever discriminated or harassed someone. It wouldn't even take 2 seconds. I don't care who they are, how long they've been here, they'd be gone. And for me, that's one of the things that I think people here at Nikola know is I mean, when we have company barbecues, I'm the one flipping the burgers for everybody. You got to serve your people. If you don't serve them, you can't love them. And I think that's a big thing. I mean, I'm a big believer. I mean, you know, faith is a huge part of my life. And you truly can't love people unless you serve them. And so I serve my employees every day, and they know that. And that's one of the reasons why you see such good morale here at Nikola.
That's certainly good to hear. Trevor Milton, Nikola founder, good to see you, and good luck on the road ahead. We're looking forward to staying in touch. I think you're doing some very important stuff.
Thanks. Big day today. Couldn't be more excited. First day being traded on the NASDAQ in KLA. So wonderful. Thanks so much. Bye, guys.
All right. Do stick around. Much more ahead on the first trade. We'll look at some potential changes in voting come November. Stay tuned. All right, welcome back to the first trade. To start today, the market was in the red pre-market, but now it's in the green. Let's check in with Inez Ferre for a close look at these rallying markets. Inez?
And Brian, take a look at the airlines up double digits this morning. Look at American Airlines up more than 26%. You've got United that's up more than 8%. Delta up more than 11%. China says that foreign airlines blocked from operations in the country due to COVID-19 will now be allowed to resume operations. Part of the reason why you're seeing this rally with the airlines. Also looking at Royal Caribbean, that stock is relatively flat right now. Royal Caribbean said it's offering senior notes and convertible bonds that mature in 2023. The proceeds of the offerings will go towards general corporate purposes, which may include repaying debt. Year to date, the cruise liners are really suffering. They're down more than 56% for Royal Caribbean. And then just taking a look at Twitter, that stock slowly under pressure. Twitter CEO Jack Dorsey says that he is going to give $3 million to Colin Kaepernick's organization, Your Rights Camp, to advance the liberation and well-being of Black and brown communities in the U.S. And you'll recall that Jack Dorsey not too long ago said that he would be donating $1 billion towards different causes. This is one of those causes, and he's been very transparent about it, putting all those charities that he's donating to in a Google document on Twitter for everybody to see.
All right. Thanks, Inez.
Thanks.
All right. Well, we know that state primaries are continuing, but they're looking a little bit different this year. Due to COVID-19, more and more voters are opting to mail in their ballots. And of course, the big question now is, what does this mean for the November 3rd presidential election? Here to talk about it with us is Bradley Tusk of Tusk Ventures. Bradley, good to see you again. So what do you think this means? Will mail-in ballots mean that more people will be voting come this presidential election?
I hope so. I mean, interestingly, the election that has the least problems with turnout is the presidential election. Where we really run into problems is local elections, state elections, where all of a sudden, like for example, you remember last year when Amazon tried to put 25,000 new jobs in Queens and they were chased out of town, the city councilman who led the fight against them had 12,000 votes total cast in his primary. So, you know, what tends to happen is people really at the extremes on the left or the right end up controlling the process because they show up to vote. Presidentials tend to have the best turnout, but yeah, I think with mail-in, you know, if you look at the states that have done it successfully, like Colorado and Washington and Oregon, they've seen increased turnout.
We know that President Trump has come out pretty vocally against mail-in ballots, saying that fraud is rampant there. We're leaving the door open for a lot of fraud. Some people say that's not true. What do you think about that? Where do you stand?
I think every form of voting is flawed, to be honest. You know, I'm a big proponent of mobile voting and have spent a lot of time and money trying to move that forward. And yet we're still in the infancy of it. And while I think, you know, we can do small groups of people in certain states, that's what we can handle right now. A lot of the experts love paper ballots, but for those of us who remember 2000 and Bush v. Gore, you know, paper ballots ended up changing the entire presidential election in the wrong direction. And voting machines have problems all the time, especially any of us who vote in New York City know that, because you just end up waiting in line forever to use them because they're always broken. So every form has problems. I do think the president is exaggerating it, but he is generally prone to exaggeration.
Bradley, we haven't spoken to you since the protests begun. Curious on, in your political circles, what are people saying about Joe Biden's response over the past week?
Yeah, I think it's been fine, pretty well. I mean, I think what we're all realizing is if Biden went on vacation today and came back the day after Election Day, I'm not sure the results would be any different whatsoever. Re-elections for president are always a referendum on the incumbent. And in this case, because the incumbent is such an outsized personality for better and for worse, and because we're in the middle now of a recession, a global pandemic, and massive civil unrest, I'm not really sure. People either voting for Trump or against Trump. I don't think that much Biden does either way is going to make a difference.
I'd love to get your take on President Trump and what he's been saying lately about social media platforms, in particular Twitter. They sort of have this tug of war going on, very public tug of war going on right now. What do you make of that? And might that hurt Trump come time for voters to vote?
Yeah, I don't know if it'll have a big impact on the election because it's a pretty obscure topic. But as a venture capitalist, I actually would like to see Section 230 repealed. Section 230 is the federal law that gives platforms like Twitter and Facebook immunity so that if you or I posted something really crazy, they're not liable for anything that we say. If that protection were removed, and what's interesting is both Trump and Biden support removing that protection, I think in a way it would really allow new social networking startups to come about, to innovate. Right now, it's just impossible to compete with the monopolies like Facebook. But if they have to do more than just give you a quick dopamine hit, provide a better value proposition to the customers, I think there's room for a lot more innovation in the space. So I would love to see Section 230 repealed.
Bradley, how impactful is it to President Trump's re-election chances that now we're seeing retired military folks like General Mattis speak out against him?
Yeah, I mean, I think it's two things. One is there are a lot of people who, for example, in 2016, either voted for Trump because they just didn't like Hillary or they stayed home. And I think that uncertainty is going away more and more. But what was even more interesting to me is last night, my 11-year-old asked me, well, if Trump loses, will he leave office? And I was thinking about it. And when you think about where coups succeed around the world, it's because you have the military. And if Mattis in some ways is reflective of how military leadership, even though he's ex-leadership now, thinks about things, in some ways it's even less about how that might affect the election in November and more around Trump not trying to contest the outcome of it.
You know, Bradley, how important is the Black vote in this particular presidential election now with all of the civil unrest happening just months before we're going to be going to the polls? Trump is not hugely popular with Black voters, although he did get a slice of that pie in 2016. So how important are they this time around?
I mean, very important. That's why Joe Biden is the nominee. And if you look at the handful of states that are swing states, there are really big African-American populations in Ohio and Pennsylvania and Florida and Michigan and Wisconsin. And so turnout's going to make a really big difference. Some people would argue that the lack of Black turnout in 2016 is why Hillary lost all of those states kind of in the upper Midwest by pretty small margins. And had she focused more on turning out Black voters, she would have won.
All right, let's leave it there. Bradley Tusk of Tusk Ventures. Always good to speak with you.
Yeah, thank you, guys.
Talk to you soon. Bye. All right, and do stick around. Much more ahead on the first trade. We'll dive into the current state of the U.S. housing market. All right, welcome back to the first trade. Let's take a look at another company we are watching closely here at Yahoo Finance. AMC is in focus after the movie theater chain said that it may not be able to survive beyond this summer. Nez Frey is back with the details. And Nez, no more movie theaters. Come on.
I know. Look, this the 8K filing that this company filed is really eye-opening. So the company said that because of COVID-19, all theaters worldwide were temporarily closed. And it also said we are generating no revenue from admissions, food and beverages sales, or other revenue, which represent substantially all of our revenue and cash flow from operations. Also saying that because of regulations, because of shelter in place and just uncertainty surrounding COVID, we cannot predict when or if our business will return to normal levels. Year to date, the stock is down 28%. It had rallied in the last couple of weeks. You'll recall when there was a rumor that perhaps Amazon could be buying out AMC. But look, movie theaters have a couple of problems that are going on. One of them is that they rely heavily on high capacity. So if you have social distancing and if you only have 25 or 30% of capacity at your theaters, that's not going to work for them. Also, there aren't many releases to begin with right now because so many of them have been pushed out. And you want to see the highest density places like New York and Los Angeles opening up movies. So a lot of issues because of COVID-19. Already theaters were having problems before this, but this has only accelerated those problems.
Inez, thinking of this, and now I'm just envisioning Netflix's stock chart in my head. No wonder why the stock's up so much. Yeah, we've all been home watching Netflix at home, but if there are no more movie theaters, Netflix, Disney Plus, those are big winners.
That's right. And movies are now going towards streaming. And that is a new model for these companies to just go direct to streaming.
All right, Inez Ferre, thanks so much.
Thank you.
There's some good news out of the housing market this morning. Realtor.com has released a brand new report showing housing is starting to rebound at least a little bit. Let's talk about it with Danielle Hale, chief economist at Realtor.com. Danielle, take us through this data a little bit. What stands out to you?
Yeah, so there are a couple of good indicators in May compared to April. One, we're starting to see prices come back. In April, they were up less than 1%, and this month they're up 1.4%, and they strengthened throughout the month of May. So when we look at the weekly data, by the end of the month, prices are up on a year-over-year basis of 3%. So that's definitely good news for owners and sellers in the market. For potential buyers, we're starting to see the trend in new listings. And when I say new listings, I mean homes that are just hitting the market slow down. So the declines are slowing. Basically, we were seeing half the number of new listings in April compared to last year. Now we're down only about 20% by the end of May. So that's definitely an improvement, a sign that we're moving in the right direction. Still got some ground to cover to get back to a more normal spring, summer housing market, but we're moving in the right direction.
Danielle, how confident are you that housing bottomed out in April, especially with the threat of possibly a second wave of the coronavirus? You know, how quick do you think the housing market will be to fully recover?
I think there are a lot of indicators showing that the summer is going to be a good period for the housing market. I think we're going to see some of the buying that would have happened in the spring shift into the summer. I think the fall is a little bit more of an open question. So we could see the housing market slow if there is, in fact, a second wave of infections, especially if there need to be additional shutdowns in the market. Often the housing market is not directly impacted by these shutdowns, but what we see is that buyers and sellers tend to take a pause when the overall economy shuts down. They choose to stay home as well. And that means we see a slowdown in housing activity, even though it's not necessarily regulated as such.
Danielle, what markets do you see things getting worse or staying the same or just not improving?
You know, we do see where COVID cases have been highest. We do see the biggest impact as far as, you know, sellers not bringing their homes to market. So areas in the Northeast and the Midwest, Philadelphia, Buffalo, Providence, that's where we've seen the biggest drops on a year-over-year basis in new sellers coming to the market. You know, but other parts of the country have fared a bit better so far against COVID, and so their housing markets have been less affected. So those are areas in the South primarily at this point.
Are you seeing any evidence, anecdotal or otherwise, that people in highly dense areas in cities like New York, Chicago, LA, where the pandemic was worse at its height, do you see people wanting to leave those areas and they're fleeing for the suburbs or rural areas, especially when you consider when we sort of get back to business, if you will, a lot of companies will still be working remotely. So how important is it for these people to be right in a city to get their jobs done?
That's a great question. So nationwide, not a whole lot of data to support that hypothesis yet. But think about it. People don't usually make home purchase decisions on a whim. So I think that's something we're going to see evolve slowly. If you look at the data for large cities specifically, and I'm thinking in this case, New York and Washington, D.C., you can see some evidence of an increase in preference for the suburbs. And in New York specifically, when we look at people who are shopping from New York, but looking at metros outside of New York, we saw an increase in the East Stroudsburg, Pennsylvania metro. So that's an area in the Poconos. So more New Yorkers are looking to the Poconos and also to upstate New York and Albany. So there's some evidence of a shift. It's very small at this point. I don't think it's a huge reversal of trend, but people are looking for affordability. They're always looking for space. They just make compromises to stay in the city because that's where they usually need to be to have a good job. But if that changes, if companies are more flexible going forward, then certainly I think we'll see home buyers shift their behavior as well.
Are there some cities where you're seeing things really flip, where things were hot and prices were high and there was a lot of demand, and there simply hasn't been now during this pandemic? Is there one city or a couple of cities that sort of stick out to you?
I think the cities in the Northeast where the COVID cases were most widespread are where we've seen the biggest problems as far as year-over-year listing declines. Like if I mentioned nationwide in April, we saw the number of new listings coming to market roughly half where it was the previous year. In the May data, Philadelphia is still at that level where they're seeing half the number of new listings come up for sale this year compared to last year. But what we've seen in some of those markets that have made some good progress is that the sellers come back. As the COVID cases improve, the sellers come back to the market. Nationwide, we're seeing that, and I expect to see that in those markets that are hardest hit as well.
Danielle, what are some of the biggest changes to the buying process as a result of COVID-19? Listen, I watch enough home rehab shows on TV to know that there are large crowds at these houses, but how is that going to change?
There can be. I think a big change is that people are getting more comfortable doing more of their search online. So, the technology has been there to do, virtual tours and to look at listing photos. And now people are using it a lot more often in the process to whittle down their list of properties. We did a survey that found that a majority of buyers still prefer to go out and see a home in person before they actually purchase it, which makes sense given how it's such a huge part of their total net worth and their investment portfolio. But they are getting more creative at using these online tools to get them further down the process. And the other thing to think about is that the process is taking longer. So as a buyer, you should be prepared for maybe a bit more extra time into the process, especially on the financing side. And as a seller, it might take buyers a little bit longer to find you. And then once you find your buyer, it might take a little bit longer to get to the closing table as people have adapted to working from home to combat the coronavirus.
So it's fair to say that the pandemic has made buying or even selling a home harder.
I think that's fair to say, especially if you're buying and trying to use a mortgage. That process has become more difficult. Lenders have adapted to not only the working from home and general uncertainty related to the virus, but also the overall economic uncertainty. So they're being a bit more conservative, and buyers who are trying to get a mortgage are certainly going to experience a little bit more difficulty as far as more detailed underwriting, probably more verification to make sure they're dotting all the I's and crossing all the T's and lending to people who are qualified to pay back the mortgage.
All right, we'll leave it there. Danielle Hale, Chief Economist at Realtor.com. Always good to see you.
You too.
All right, stick around. We'll have much more on the markets straight ahead on the first trade. All right, welcome back to the first trade. Apple isn't letting store looters get away with its stolen iPhones. The company is disabling these stolen phones and displaying warning messages directing individuals to return the phone to their local store. Our tech editor, Dan Halley, is here with us. Dan, well, I guess these iPhones won't be counted in Apple's latest quarter.
Yeah, it's interesting. This is a piece of software that's installed on display devices that Apple has in its stores. They're the ones that are really out on the tables when you go into an Apple store. And it's basically set up so that if they do leave the premises or they are stolen, they can just kind of flip a switch, completely lock out the iPhone, similar to if your own phone was stolen, how you can lock it via iCloud. This is the same idea. They're able to lock it and then display a specific message saying, we know this has been taken from a store. Please return it or we'll contact authorities. It's really a way for Apple to kind of ensure that its products don't just walk off at any point in time. But in this particular instance, obviously with different reports of looting at Apple stores, they had to close down some of their own stores as a result. This is really them kind of trying to make sure that they can get those products back without perhaps contacting the authorities in certain instances.
So Dan, if these phones are really being tracked by local authorities, what are the consequences going to be for the looters? So they know where they are, what happens then?
I think that's probably up to either law enforcement or Apple if they want to press charges. It's basically right now, if you look at some of the images that are circulating on Twitter of some of the phones, it's basically saying, look, this is an Apple phone. It's now disabled. Please return it to XYZ store. So in Philadelphia, there was someone who put up a photo of one of the phones that had been stolen, saying, please return it to the Chestnut Street store, ASAP. But it didn't say anything about, potentially being arrested for it. So it's kind of up in the air as to what Apple would do at this time.
Dan, you follow Apple very closely. Given everything that's going on in the world, do we get those new iPhones later this year?
That's a great question. Kind of the way that we discussed, COVID and the coronavirus outbreak and how Apple would not likely launch on time just because the optics would be so bad. If we still had military camps, military medical camps set up and things along those lines, with stores opening, states opening, New York is about to open. New York City is about to open, kind of the last real hot spot in the U.S. That hasn't gone through a reopening yet. It looks like they may still launch on time, but I don't know if we're going to see kind of an in-person, Apple launch that we normally see. It would be hard for them to launch a device like this that's so important virtually. But, they're holding their WWDC, Worldwide Developers Conference. That's going to be virtually this year, and that's an incredibly important event as well. So at this point, it seems like we may get them on time, maybe a few weeks late, simply because of the issues in the supply chain that the pandemic caused originally. But I don't see COVID being a reason for them, at this point at least, from a practical perspective. As far as the protests go, it's unlikely that they'll be running until September. But I do think that, Apple is well aware of their standing in the world, does speak out on certain social issues. So far, we haven't really heard much outside of Tim Cook specifically referring to the events to employees.
All right, Dan Halley, thanks so much. All right, let's get back to Inez Ferre for a close look at some stocks. Inez, a company called ZoomInfo is going public today. That has nothing to do with Zoom, right? Inez, I think you're muted.
Here we go. Okay, yes, nothing to do
Friday.
with
Hang in there.
almost Friday. Nothing to do with Zoom, but ZoomInfo is a cloud-based platform for sales and marketing teams, providing information on companies, on individuals. I do want to show you that ZoomInfo has priced its IPO at $21 a share. It's not trading yet. It will begin trading on the NASDAQ. The company is not profitable yet. Its top line doubled from 2018 to 2019. Its net loss widened, though, though, to 78 million in 2019 compared to a net loss of just over 28 million the year before. And CEO Henry Schuck will be on the move later this morning after the stock opens. Also, taking a look at Gap, that stock is up more than 1%. Gap will be reporting its earnings after the close today. Simon Property is suing Gap for more than $65 million in rent and other charges. Back in April, you'll recall that Gap said that it would not be paying its rent due to COVID-19. So now Simon Property suing over that money. Brian?
Pay your bills, Gap. All right, Nez, we'll check back with you later.
See you soon.
And do stick around. On the Move is coming up next with Senator John Kennedy. They will discuss the action on Hong Kong and the ongoing protests across the country. And of course, they'll have their eyes on all things markets. And don't forget, tune in here at 8:29 a.m. Eastern Standard Time tomorrow for our Yahoo Finance special report on the May jobs report. We'll have the numbers and all the analysis you need to know.
And good morning. Welcome to Yahoo Finance on the Move. I'm Adam Shapiro along with Julie Hyman, and we appreciate your being here on what looks like we could have a bit of a rally in the markets right now. The S&P 500 up about 4 points. The Dow is up more than 100 points. Earlier this morning, the Dow and S&P were in negative territory. NASDAQ is up over 10 points. We're going to talk more about this, but of course, we have to hit the headlines driving these markets. Initial claims for unemployment, 1.87 million. That was lower than the week prior, but since this lockdown hit the economy the last 11 weeks, 42 million people have filed for unemployment benefits. Continuing claims fell to 21.48 million. The high mark was about 25 million. Also, some data to pay attention to. The trade balance was a negative 49.4 billion last month. So we're going to keep an eye on that as we head towards the Labor Department jobs report. That comes out tomorrow. We're going to talk about all of this with former Labor Department economist and Rutgers University professor Bill Rogers in just a moment. The Chinese government is going to allow foreign airlines to resume flights to China on a limited basis. The U.S. yesterday threatened to block Chinese passenger airlines from coming to the United States. A Senate Banking Committee hearing underway right now on the crisis in Hong Kong, a review of U.S. policy tools. They're going to look at potential U.S. responses to the Chinese government's crackdown on autonomy in Hong Kong. Louisiana Senator John Kennedy is going to join us in the next 2 hours. The European Central Bank expanding its emergency bond buying program. We're going to break down the numbers for you with a report from London. But right now, coronavirus cases worldwide, testing positive, 6.5 million, the number of dead, 386,000 plus. In the United States, we have 1.85 million people testing positive, with the number of dead now exceeding 107,000. We want to turn our attention back to the economy and putting people to work. Tomorrow, we get the Labor Department numbers, but we got the initial claims for unemployment. And Bill Rogers is a labor economist, Labor Department economist, former, and Rutgers University professor. He is joining us now. It's good to see you.
Adam, great to see you as always.
Are we missing anything in these numbers where, we can all guess that the unemployment figure for May is going to be around 20%, or could it even be worse?
Yeah, this is that challenge again where the unemployment insurance claims, right, are the leading indicator, and tomorrow we're going to get what's the labor market's lagging indicator. Be that as it may, I think if we focus on today's UI claim number, still very high, but from a standpoint of we compare it to previous weeks, it's starting to get smaller, or the amounts of people filing is getting smaller, which does suggest that in the middle of May, 19 states had reopened or moved to reopen. In the last week, pretty much all states are now reopening, and they're moving in some kind of stage or phased opening. So in New Jersey, Governor Murphy, serve on his commission, Restart Commission, he just announced that we're going to be moving to stage 2 as long as we continue to hit our health indicators. Now for tomorrow, I agree with you, tomorrow the unemployment rate, the official unemployment rate could be close to about 20%. But again, because of the way people are answering the questions, or particularly what were you doing over the last 4 weeks? Well, my business was closed. I've been laid off. So they may say, I'm not working. So we make sure you look at the employment population ratio, the share of people who have a job, because that could either be going down because of continued losses, but it could also be starting to rise back up because there is some opening going on.
Bill, I want to ask you about stimulus and the interplay between stimulus and employment, because there has been a thought among some members of Congress, for example, that they should pull back on this stimulus or end the existing stimulus because it's an incentive for people not to work. In some cases, they're making more than they were at their pre-existing jobs. How are you thinking about that and getting people back to work in terms of whether stimulus is indeed a disincentive? Yeah.
So the stimulus has been and will continue to be very important. Why? In particular, because this was a consumer or consumption-driven recession or downturn, and that in order for consumption to return to previous levels or near previous levels, we actually have to have more confidence. Workers have to have more confidence that they can go into their workplace and be safe. Consumers have to have more confidence that they can go to those, instead of shopping online, that they can go to their favorite stores like they were before the pandemic, and we're not there yet. And so as a hedge, that's what this. And I'm not going to call it. I'm not correcting you, but it's other people. A lot of people are saying stim. I'm calling it relief. Right, we're still in the relief phase, and now moving into the recovery phase. So this relief is providing that bridge to the recovery, and until we start to see that confidence in workplaces, that confidence consumers have, that's when I think you can start to pull back some of the stimulus. The HEROES Act does a nice job of acknowledging that, hey, let's have some triggers that we'll start to pull back when we see the economy actually getting better. And I would like to see that type of movement. And then the other part of what you call stimulus, but again, relief, we know there's another wave coming, and it's not the COVID wave coming. It is the wave of state and local governments. Right? And my Governor Cuomo, many other governors have already been talking about the major hits that their budgets are going to be taking, and they can't print money. They have to balance budgets, and this is not a time for raising taxes. So you're going to see cuts, and these are cuts that will have a disparate impact on women and minorities because that's where many workers with those backgrounds are concentrated.
And Bill, Ines Ferre here. And speaking of women and minorities, African Americans and Hispanics have been particularly hit hard by the pandemic. Do you expect unemployment for those sectors, for African Americans, for Hispanics, to be as high in this next jobs report? And what can be done to remedy that?
Yeah, I do think that we'll continue to see increases that in tomorrow's report. Why? Because during the survey, between the survey week in April and in May, there were about 14 million more people who did apply for unemployment insurance. So we will get a spiking up, and as similar to previous recessions, previous downturns, it's those jobs at the lower part of the ladder or upper in the middle part of the ladder that are hit first, and they have a higher concentration of minorities and women. So we probably will still see some more movement. The hopeful piece is that because UI claims are trending down, and there's some other data, not necessarily government data, that is suggesting we may have bottomed out, and as long as we can again grow and improve confidence in the workplace and in the buyer place, we'll start to see those leisure, hospitality, retail, those will come back. And now the hope will be that women and minorities who are represented in those occupations and industries will get pulled back just as quickly as their white counterparts or their male counterparts.
Bill, it's Brian Chung here. Obviously, just looking at the unemployment headline number isn't enough either. We want to know the types of jobs that have been lost and whether or not, as hopefully if we bottom out, whether or not those jobs will come back. So when we look at those lower income jobs, which has really been the focus of this particular recession, because on one hand, a lot of people have lost their jobs, but then secondly, a lot of people that are in those lower income jobs are actually still being required to risk their lives to go out to work. How are you kind of parsing through that when you look at the jobless claims numbers every Thursday morning, but then also the BLS report that we expect tomorrow?
Yeah, with the jobless claims, it's really difficult because you don't see that data right by race. I mean, the most filtered out we can see is by state. So you really are relying on the Friday jobs report to really look across race, ethnicity, gender, and industry. And then you also have a different report that comes in a few weeks, and that's the state picture. The other statistic that I focus on, and unfortunately you don't get breakouts by race on it, but I think connects to your question, and that's the U6 unemployment rate, or many people call it the real unemployment rate, right? It's those people who are, it adds those people who are working part-time but want to work full-time, and it also adds those people who stop actively searching, but if offered a job, they take it. I think you actually may see more of a spike up in that number tomorrow, more so than in the official unemployment rate. And my reason for that is that you have on one hand, individuals who still could be losing their jobs or are getting moved from full-time to part-time because those companies or businesses aren't getting enough revenue. But then you also have the reopening that's going on too, where businesses, either because of the government sort of saying how we're staging this, 25% threshold, 50%, right, that they may not be able to, can't bring people back full-time right away. So that U6 unemployment rate is going to also be another really important indicator to watch. And
Bill?
Yes.
Bill, apologies, it's Julie here. While we have you, I also want to ask you, because I know one of the areas of your research has been African-American unemployment. Given what's going around the country with the Black Lives Matter protests right now, I want to take the opportunity to ask you what economic policies you think could be instituted to fight systemic racism, especially at a time when we have seen that Black unemployment rate tick back up.
Right. I have two pieces that I've written recently, one in the conversation that hopefully maybe your viewers would go check out, or also a piece that just came out in Barron's this morning. But in terms of policies, we have to have a two-pronged approach. One is we have to get back to enforcing anti-discrimination laws. We also, particularly at the EEOC, their budgets have been gutted, but they've been really squashed over the last few years. And the Me Too movement actually did help to bring some revenue back to that agency, but they have tremendous backlogs in terms of people filing grievances with their employers. So that's the number one in terms of race and gender, and actually any disadvantaged a group person who feels that they've been discriminated against. But then the economy, right, has changed so much to where you have many whites, right, who are now feeling the same kind of economic anxieties that have been historically in many Black families. In New Jersey, our ALICE population, where ALICE stands for Asset Limited Income Constrained and Employed, it's basically families who don't have enough resources to make ends meet in their community. That number has risen to almost 40%. And now, if African Americans make up 12% of the population, a larger share of that ALICE population are low and moderate income whites. Again, above poverty, but they've shifted down. They've had difficulty with rising childcare costs, rising healthcare costs, stagnating wages, and that's what I think has been interesting about the protest. To me, this time they seem to be much more diverse, and it's also probably capturing a bunch of people who have lost their jobs, and so they're feeling that same anxiety, and the sort of middle class has been shifting.
Bill, it's always good to see you. Bill Rogers is a labor economist, former chief economist at the Labor Department, and a Rutgers University professor. All the best to you, my friend.
Peace. Thank you, Adam.
We're going to head over to London to take a look at what steps the European Central Bank is taking to not only boost employment, but to stimulate the economy there. And it starts with over $1.5 trillion in bond buying at this point, correct?
Not quite, Adam. 1.35 trillion in bond buying, but I mean, close enough, in the same ballpark. When we're playing in trillions, it really becomes pretty hard to keep track of it. And this comes after the facility, the Pandemic Emergency Purchase Program, was almost doubled today by 600 billion euros in additional purchasing power. The ECB didn't fluff its lines this time. You remember that Christine Lagarde earlier in the year came in for heavy criticism for saying it wasn't her job to close the spreads, leading to fears that she perhaps wouldn't stand behind the Eurozone economy in the way that we needed during this pandemic. The 600 billion euro increase we saw today was actually 100 billion more than the market had expected, and the reaction has been incredibly positive. The market taking this as a sign of her own sort of Mario Draghi, whatever it takes moment, a sign that actually Lagarde will backstop the economy. The euro is trading up 1% against the dollar and about 0.7% against the pound, a sign of just how much investors like what they've heard from Lagarde this morning.
Oscar, do investors like what they're hearing from Germany and the efforts to stimulate the economy in the largest economy in Europe?
Yes, well, this is, again, another massive stimulus package that was agreed late last night by the German government, the various parties getting together there to agree 130 billion euros worth of stimulus. Now, this comes just months after a 750 billion euro package to support the economy that was announced back in March. But whereas that package was all about sustaining the economy through the shutdown and the worst of the pandemic, this new package is more about the bounce back, trying to spur a recovery. Now, parts of this stimulus include 50 billion euros for addressing climate change, innovation, and digitization, further 25 billion euros in loans and grants to small and medium-sized businesses to help them bounce back from this shutdown, and also a VAT cut to try and stimulate spending. As I said, this was agreed late last night for a coalition, and it really shows the changing times in Germany, which once prized its black zero, the sort of balanced budget, that is now throwing hundreds of billions of euros at its economy.
We will catch you later, Oscar. I want to turn our attention back to the United States and the economy. Here on deck is Tim Chubb. He is the CIO at Gerard. Good to see you. I want to start with this. You say that a lot of industries are still on life support and may be delaying the inevitable. And yet, markets, not at this moment, but markets have been driving higher. Is there a disconnect?
Yeah, I think to an extent, when you look at the price performance of the S&P 500 coming off the March lows, we're now, 40%, hard to believe, from that period of time. I think, what we've seen, you really can break companies down in three categories. Those who have had maybe pulled forward demand, like a large, grocery store chain, for example, who has likely seen a lot of stockpiling take place, or software as a service company, or a lot of reoccurring revenue. close to 100% of the revenue is reoccurring, where demand really hasn't been shaken at all. I think the next step down is the companies that have seen, demand delayed, like a medical device company that specializes in surgeries that are elective, and then there's been companies with demand destroyed. And I think when you look at, over the last several weeks, the market has lacked serious breadth. It's really been those secular growth stories, those stay-at-home names that have really been moving the market higher. And what we've seen within the last week or two in particular, and again, the case today, has been those companies with demand that's been completely destroyed over this period of time, like an airline, for example, starting to catch up. And so I think once we settle out a little bit, those secular growth names will return to the forefront. And I think the economic reality of just what the economy may look like later this year or even in early 2021 will begin to take focus, and this rotation to some of these value names may be short-lived.
So Tim, it's Julie here. It's good to see you. So just to put a fine point on that, the broadening of the rally that we have seen lately might not last. We might see some of those names that you're talking about, the airlines, the other beaten down names where demand has been raised, they're going to come back down.
Maybe not come back down, but potentially consolidate in the short term. I mean, I'm not a technical analyst, but I think it's very difficult from a fundamental perspective when we still are facing such a wide range of economic outcomes later this year to really understand how consumer confidence is going to change or improve as we face the unemployment rates, as your last guest was discussing. And so, again, with so many companies that are in the demand delayed or demand destroyed bucket, foregoing providing guidance for the rest of this year, even in the companies where demand has been really, really strong, have delayed guidance because they're worried that the demand may fade in the latter part of this year. Again, I think it's really difficult to say, whether or not these companies that are now trading at multiples higher than where they were, January 1st, are really going to drive the market that much higher here in the next couple of months. I think this rally is going to be short-lived.
Do you think that those who might be concerned about this rally being short-lived might try to find shelter in bonds but might be making a mistake if they choose that route, given the fact that yields on bonds really aren't going to move that much more, or are they?
Yeah, that's a great question. We've seen an unbelievable rally in the equity market, but it's been pretty fantastic in the fixed income markets as well. Investment grade credit spreads have continued to compress. High yield bond flows have been significant due to Fed intervention and support there. And so I think, when you look at a risk reward trade-off, despite the equity market just trading a few percentage points off of where it started year to date, the risk reward ratio or trade-off may be a little bit more attractive for equities than it is in the credit markets, just given how much flows have really compressed yields and both in the investment grade side of corporates as well as on the below investment grade side of things. I think investors really need to take a look down market cap as well. We've seen the Russell 2000 index and small caps really perform pretty strong recently. That's been an area that's been extremely beaten up. So, while we always talk about the S&P 500 and Dow Jones Industrial Index, the smaller the company, the worse it's performed this year. And I think, as we look in our equity team where we've been finding value, it's been in that $5 billion to $25 billion space of some of those companies that the market originally perceived demand to be destroyed, where it might be just delayed, like some of the home builders.
Okay. Tim Chubb is the CIO at Gerard. Thank you for being here. Stay healthy.
Good to see you. You too.
When we come back, we're going to take another look at markets, which at this moment have fallen back into negative territory. Also steps for the PPP and making it easier for those businesses which have accessed those funds. More after this. Welcome back to Yahoo Finance on the Move. Let's go to Washington, D.C. Jessica Smith, our correspondent there, is watching the latest now that the Senate has passed. How would you describe it? A reworking of the PPP program to make it easier for businesses?
Right. It gives businesses more flexibility and more time to spend their Paycheck Protection Program loans. And the Senate did pass this bill yesterday unanimously on the second try. The first time they tried to pass this, Senator Ron Johnson of Wisconsin objected, saying that he wanted to be sure that the intent of this bill is not to reauthorize the program through the end of the year. So once he got that assurance from the authors of the bill and from the leaders of the Small Business Committee, then he did not object the second time around. So they were able to move this forward and send it to the president's desk. So look at some of the specific changes to this program if the president does sign it. Businesses will have to spend 60% of the loan on payroll expenses in order to have it forgiven. That's down from 75% where it is now. They'll also have 24 weeks to spend the money instead of 8, and they'll have up to 5 years to repay the loan instead of 2 years. The rehiring deadline will also be moved to December instead of the end of June. Now, some Republicans like Senator Marco Rubio and Senator Susan Collins, who were some of the Republican architects of this program, say they still have some technical concerns. Majority Leader Mitch McConnell says he hopes Congress will address those at a later point, but they were really kind of in a rush here because some of the first businesses who received PPP loans were starting to come up on that 8-week deadline. We have heard from industry groups like the National Association of Manufacturers and Restaurant Association saying that they are pleased with this. They have been lobbying for this for weeks now. So now we'll be looking to see when the president, if the president is going to sign this. I reached out to the White House, but have not heard back. So we'll keep you updated once we hear more on what President Trump plans to do.
And Jessica, just a reminder, we've got Senator John Kennedy, who's on the Senate Banking Committee, coming up in the next hour, so we can ask him a few questions about this as well. But let's turn to something that's going to hit movie theaters and those who love movies. AMC warning it is in big trouble. And as for they're warning they could lose between $2.1 billion to $2.4 billion. How do you come back if no one's going to the movies?
And that's their big problem. AMC saying that it is generating no revenue from movies, from concessions, which represents substantially all of its revenue and cash flow from operations. And also the company saying in an 8-K filing some very sobering remarks saying we cannot predict when or if our business will return to normal levels. One of the problems that movie theaters have is that they have to operate at high capacity, because if they operate at 25 to 30% capacity, it just isn't economical for them. The other problem, of course, is because of COVID-19, all of these movies have been pushed out. You do have some that are supposed to come out at the end of the summer, but look, you have to have Los Angeles and New York, the high density areas, opening up for studios to want to open up those movies in theaters.
Brian, I know you follow corporate debt quite closely. AMC, do we have an idea of just how big their debt picture is?
Well, as Inez was saying, if you have no revenue, that's going to be a massive issue if you're trying to do some fundraising to bridge this period, if you still can't open your movie theaters. So looking at the data, I mean, the last time that AMC was able to issue any debt was on April 15th. It was a $1 billion offering for a maturity date of 5 years from now at a crazy coupon rate. I mean, 11% when you consider that they have a CCC rating, that's junk debt. Of course, they're going to have to offer some nice payout on that. But look, the funding issues for these theater operators is definitely going to be a question for the future when you consider that there are a number of others in this ecosystem like Reading International. This is a cinema and real estate company that actually kind of leases out the theater spaces. They say they might have to tap the Federal Reserve's Main Street lending program to get a cheap loan to bridge themselves through this period. So this whole industry is just really looking for any sort of funding right now in order to keep themselves alive.
You know, when we talk about corporate debt, there's been a lot of warnings about leveraged loans. We're going to hit that right after the commercial break. Welcome back to Yahoo Finance on the Move. In a world where you have 42 million Americans in the last 11 weeks applying for unemployment benefits and demand destruction and consumer issues, you got to wonder what's going to happen to corporations and their debt and how much of a default risk is out there as we move forward. To help us assess that, Mark Carey, GARP Risk Institute co-president, joins us. And just how serious a threat is the chance of large cumulative corporate debt defaults in the future?
Well, my expectation is over the next couple of years, we're going to see the largest ever leveraged loan default rates. Leveraged loans are a risky section of the loan market. There's a couple of $1 trillion of them outstanding globally. And the borrowers were in the riskiest shape ever at end 2019. And now they've been hit with this bad COVID-19 economic shock.
And Mark, it's Julie here. So talk us through then what that means, right? Who holds this debt and what could the implications be if we do see the kind of default rate you're predicting? And by the way, what default rate are you predicting? I mean, do you have a sort of a percentage target?
I'm expecting a default rate around 25% over the next couple of years. And so, that's going to be the largest in modern history. It's going to ripple out through the financial system because the single largest investor in leveraged loans is collateralized loan obligations, or CLOs. Okay, and the bonds that CLOs issue to fund their loan investments are widely held around the world. Some of those bonds are going to take losses.
Hey, Mark, so it's Brian Chung here. I mean, on the other hand, you have many who have said, well, historically, CLOs have performed quite well, even during the 2008 crisis. So even if there were to be some defaults in the underlying leveraged loans, maybe things wouldn't be so bad. Then secondly, you do have some steam going out of the leveraged loan market because it seems like with the Fed's corporate bond backstop, people have been turning away from leveraged loans and getting financing just through issuing debt. Do you think that dynamic is going to kind of soften the blow, even if there is a 25% default rate?
No, the leveraged loans that are in really risky shape, those borrowers are not too likely to be able to issue bonds and take loans out of things. A lot of the debt that's been issued in the last couple of months has been incremental debt to help firms adjust to their loss of cash flow.
Mark, I wanted to follow up with Julie's question to get a better understanding of what the CLO market looks like now. Who holds those bonds? And if you get default at one tranche, that doesn't mean the whole asset defaults, or does it?
Well, I think of CLO liabilities, the bonds that CLOs issue, as a bunch of pieces of pizza sitting on a hill, okay? And there's a flood coming. Each one of those pieces of pizza is one of the classes of bonds. And there's a flood coming. And as the flood of losses on the underlying loans rises, those pieces of pizza are going to get swallowed up. So everybody expects the first piece of pizza is going to get swallowed up in a bad situation. But I think there's a really substantial possibility that 3 or 4 of the 6 pieces of pizza are going to get swallowed up.
Okay, so a pepperoni fan here, by the way. Who's holding the bonds? Is it banks? Is it pension funds? Is it, we saw what happened in 2007, 2008. What is the picture now? Who holds those assets?
Everybody holds those assets. So there are specialists in the riskier bonds, and then a lot of entities hold the safe stuff, the AAA stuff. That piece of pizza is 2/3 of the total pizza, the AAA. That's probably safe, but when people see the single A piece starting to take losses, they're going to freak out.
Does it pose a threat to the financial system?
I think so, because when people freak out, then they're going to question the safety of the AAA piece. And that means everybody who's holding the AAA piece, the banks, the insurance companies, all kinds of institutions around the world are going to have doubts about their own safety.
Another way of putting that is when you eat too much pizza, you get heartburn. Mark Carey, we're going to bring you back because we need to keep an eye on this issue. We appreciate your being here, joining us from the GARP Risk Institute. You're the co-president as well. Out to people. Before we go to break, I want you to pay attention to what Chase Koch had to say to our Andy Sir about moving forward.
Well, the first thing I would say is that heartfelt sympathies to George Floyd's family and all those experiencing injustices. This is, I think, a terrible reminder of how much work we have to do as a country to make sure that every individual has dignity and that dignity is respected. I feel like that a cultural transformation needs to take place in this country. I think we all see that. And, you know, the ideas of mutual benefit and equal rights, as you mentioned, that's what Stand Together is all about. We have to respect those principles because that's what makes the world go round and makes people prosperous and makes people better off. So I would say that that we've got a lot of work to do as a country, evidenced by what's happening right now.
Welcome back to Yahoo Finance on the Move. The Dow is once again in positive territory. Not much. We're up about 10 points. S&P 500, however, is off 7 points, and the NASDAQ is down almost 40 points. Let's talk about your cell phone and ways people try to protect themselves with the VPNs and locking down their cell phones. Dan Howley, you understand these issues much better than most of us. Explain.
Yeah, so if you are security conscious, you're looking to avoid hackers, advertisers, or being tracked by government agencies, then a VPN is really the best way to protect yourself online. So let me give you an idea of what a VPN is and what issues you might run into if you have one. Think of a VPN as basically a wormhole through the internet. Now, when you have your regular internet, you start from your computer, your smartphone, your tablet, and you go through the public internet to the website that you want to access. But while your data goes through the public web, it's able to be seen by advertisers. Hackers can see it if they try, and then certain government agencies are able to see that as well. Now, if you use a VPN, what you're doing is making this wormhole that's fully encrypted and secured that goes on its own journey through the internet, and then it exits out to the website you want to see. The data that you want to get through that website is then sent back to that wormhole and to your device. And while it's in transit, it's encrypted. No one can get access to it. And what you end up doing is giving yourself what's called a new IP address. Now, your IP address, think of it as your mailing address for your device. When you have your regular internet, that's how you're able to be tracked. But with a VPN, your IP address is changed to what that VPN offers. So that way you can appear, if you're in the US, you want to appear that you're in the UK, or in the UK, you want to appear that you're in the US. You're able to do that by spoofing locations. So it's a good way for security, but there is there are some issues that you may run into with certain apps and devices. There's Netflix, for instance, does not allow people to use VPNs when you're trying to view content. And that's because they want to have different agreements in different regions for certain licensing of different shows. You also, if you want to use something like a Google Chromecast, and you need to connect to your own in-home Wi-Fi, you won't be able to use a VPN because it'll think that it's coming from the UK or South Africa or something along those lines rather than your own home. So it won't function. When you do want to sign up for a VPN, though, you want to look at what those services collect as far as data goes. Remember, this is all about security. So you want to make sure that the VPN you're using is reputable. And some of the two that I really like are NordVPN and Private Internet Access. I've used both of them.
Those two you like. I want you to say the names again slowly so people can write it down. But do you have to pay for it, or is it free?
You have to pay for them. They're very cheap. I mean, Private Internet Access is about $7 a month. NordVPN, N-O-R-D VPN, same price. And basically, they will provide you with this service. They don't collect any data. In fact, when you look at their privacy menu, they basically say, we don't collect anything outside of what we need to make our app function properly, which is basically just Google Analytics. But they don't collect timestamps of when you sign on, how much data you use while you're on there, where you visited, anything along those lines. It's all not collected. They won't have any information on you whatsoever. So if you're into privacy, a VPN is the way to go.
Dan, does this prevent police from tracking you if you're at a protest? Because can't you be tracked just by your phone being pinged on a tower?
It can, yeah. You can be tracked through being pinged. A VPN can prevent things along those lines. It can prevent tracking from hostile governments, as well as if you're trying to avoid something along those lines with a protest, yes. If you're traveling overseas, I just recommend getting a VPN regardless. There are certain countries that you go to where as soon as you land, you are going to be tracked. So it's a better idea to use a VPN while traveling or in any kind of instance where you don't want to have a government following you.
Dan, there are times when you do want your phone to be tracked, or at least you want a phone to be tracked. There have been some phones apparently stolen during the looting that has taken place over the past week, and Apple actually can track them if they're iPhones, right?
Yes. So basically what's going on here is Apple has a device, a feature on your own iPhone and my own iPhone that allows you to track it. And it allows you to put up a message saying, you stole my phone, or this phone has been missing, please return it. So Apple does this to some of the phones that are on display in their own stores so that when it's stolen or if it's stolen, it will show a signal saying this phone needs to be returned to, for instance, in Philadelphia, the Chestnut Street store. Someone posted a picture of their own a phone that was stolen and showing that message. Please return this phone to the Chestnut Street store. It has been disabled. And it's something that Apple allows because it lets them, A, track where those devices are. So if they have to get law enforcement involved, they can. And B, allows those devices to be returned to the proper location.
Dan, if I'm one of the store owners who unfortunately got looted, do I have the ability to have Apple essentially make the phone worthless and just wipe it clean? Do they have that kind of data, numbers, serial numbers, all of that?
Oh, yeah. I mean, look, once they turn that feature on where they're able to track the phone and lock it, it's just a hunk of junk. It's the exact same way that you or I, when our phones are stolen. If your personal phone is stolen, use your iCloud account and lock your phone, because then it is just it's an expensive paperweight, basically. And that's what Apple's doing to these devices. Now, whether or not they're getting law enforcement involved, it's unclear, but it's obvious that they don't want looters to get the idea that they can steal these devices and then go selling them. It's just not going to work.
All right. And Dan Howley, once again, the VPNs are NORD, and what was the other one?
Private Internet Access.
Thank you very much. We're going to be right back after this. Welcome back to Yahoo Finance on the Move. A lot of us want to get back to the office, tired of working from home. And as we try to figure out how that's going to happen, Akiko Fujita has actually gotten a futuristic look at what we can all expect. Akiko?
That's right, Adam. You know, we've been talking so much about these tech companies like a Facebook or a Twitter that have talked about a more permanent shift to remote work from home. But, you know, the reality is most companies, about half of the companies out there are looking to try and find an in-between. That means some work from home, some going to the office, and yes, a lot more Zoom calls in the months ahead.
So the first thing when they step out of the lift is they're going to notice that the doors are open. So they're not going to have to touch a door to come in.
Americans returning to work face a dramatically new office experience.
You've got 3 chairs here. How many did you have before?
We would have had 6 before.
There's less furniture here and fewer desks.
What we do down these line of workstations is we take out every other workstation and then people will be able to maintain that safe distance.
And there's plenty of reminders to keep that distance, as we learned firsthand. Cushman & Wakefield calls this the 6 feet office.
2 of the areas we're really focused on is maintaining that social distance while we're in the office, also just reducing the number of touch points.
Employees here use keys instead of their fingers. They stand in marked corners. They're required to walk clockwise around the office to avoid congestion.
The overarching approach has been, how do we create these safe environments with a limited amount of time and a limited amount of capital to make them accessible for everybody?
Other offices are turning to tech, installing thermal imaging cameras to check temperatures and air filtration systems. WeWork expects employees to stay closer to home now. It's launching software to help clients find locations nearby.
This technology that we're putting that we put together and we're rolling it out gives enterprise companies the ability to map out their people to our various locations. If you have 4,000 people, they don't all have to be in 1 or 2 locations.
What does that mean from a business standpoint from WeWork? On the one hand, you're saying there's an opportunity of more businesses coming in, but just as equally, you've got to have a lot of businesses that may not have the same footprint they did pre-COVID.
Net, we have greater demand today than the members that we've lost. Enterprise is about 46% of our business today. We expect that number to grow to about 70 to 75% of our revenue over the next 12 months.
But companies like Facebook and Twitter see remote work as more permanent. That's altering the definition of the office.
Do you think we're seeing a permanent shift in the way we actually look at the workplace?
I absolutely think we're never going back to exactly where we were. And in many ways, that's a good thing. I think there's going to be much more of a hybrid future of working from offices and working remote.
Huffington expects that to lead to a shakeup of C-suite roles. Mental health now a priority, with employees working in isolation.
Who takes on that role of ensuring that part of the equation?
The heads of HR departments are now the most important executive in the company other than the CEO. The health and wellness of employees has now been moved to the front burner.
The changes giving new meaning to business as usual, with our workplace changed forever.
Now, one of the things we've heard from a lot of companies is this idea of phasing out the headquarters, especially in a place like New York where we are. Not a lot of people are going to want to commute in through the subway system because they're concerned about their health. So that's why WeWork says they see an opportunity. They've been getting a lot of calls, at least according to them, for companies who are looking for sort of outposts in the suburbs that employees can go to as well. One thing we should note is that there will be a phased-in process in all of this. And so while we're talking about people returning to a changed office, not all employees are going to return. In fact, Cushman & Wakefield said they're going to start with 25% workforce in the beginning.
Akiko, does anyone address the fact that even if you move from a concentrated area like New York to a suburb, say you go to Connecticut, you still have those same issues within the office, whether it's in a suburb or in the city, don't you?
The same offices in terms of the cramped quarters?
You've got to have people separated. You've got to have people at a distance. And there seems to be this, as Arianna Huffington pointed out, there's going to be this rush for hybrid and limited or less office need And there's this discussion about a rush to the suburbs, but you still got to do in the city what you would do in the suburbs and vice versa.
There's no question about that. And that's why we're seeing, let's say a co-working space like a WeWork spacing out their operations as well. I guess the way to look at this, Adam, is that how much of this is actually temporary and how much of it is permanent. And what companies right now are trying to figure out is how can they do this at a lower capital cost? That's what you heard Cushman and Wakefield say, because the thinking here is that once there is a vaccine, things may go back to where they were. We just don't know what that timeline looks like right now.
Okay, when we come back after this commercial break, we're going to check markets one more time for you. Welcome back to Yahoo Finance on the Move. Jared Blickery is watching markets for us right now, and the swings haven't been wild, but we have been going back and forth between positive and negative territory, depending on which index you're following. Jared, what's motivating all of this?
Well, I think some of the major indices, mainly the Dow and the S&P 500, have just bumped up against resistance and are going to have to take a pause before heading higher. Alternatively, they could roll over. But let's take a look at the charts. We got the Dow down about 8 points. Just kind of went negative there. The NASDAQ is down 0.5%. That is underperforming today. S&P 500 down about 1/3%. Here is the intraday price action, and we can see we are now just kind of testing session lows from the open here, although we did fill the gap from yesterday. Let's take a longer term view here. Here's year to date, and the resistance level I was talking about is 3130 in the S&P 500. That's this resistance level here. Also a 76.4% retracement in Fibonacci. That is the last holdout for the bears. And also in the Dow, I should note that we are reaching the 200-day moving average. We just kind of kissed it yesterday, poked above it today, and now we're right below. So major indices just taking a breather here. We do have financials, industrials, and materials all in the green. Those have been the leading sectors since last week. I just want to take a look at a tweet here that I have from Ryan Dietrich of LPL Financial. He says that at 50 days, and yesterday was the 50th day of this rally, this is the biggest one we've ever had. And if you take all of the rallies that have been greater than 20% in 50 days, we see that 3 months out, 6 months out, 12 months out, almost all of them, all of the returns, are positive. So 6 months out, 10% average, 12 months out, 17%. So good news on that front. Let's take a look at some of our heat maps here. We got the NASDAQ, kind of a mixed picture. The big cap tech's going to be in the red once again. Those have been the laggards. Now, there we go. Those have been the laggards over the last week, actually since going back to last Monday. And if we sort by performance, taking a look at the big winners and losers, United Airlines is up 13%. Airlines doing very well today. This comes on the back of an announcement by China that they're going to let U.S. carriers fly into China. Yet again, that was a point of contention earlier in the week, and we did see airlines dip on that, but they're rebounding today. Chip stocks have been kind of in the red. Broadcom disappointed on earnings, but we do see Micron up 5% here. And we see some other travel stocks like Marriott, that's in the green too by about 3%. So a lot of those travel names kind of bouncing back right now. We can take a look at the airline sector and really a lot of outperformers here. Hawaiian Air, let's see, that's up about 10%. American Airlines up the most, 25%. United up 12%. So good to see those bouncing back as well. One sector that's also been lagging over the last week or so is healthcare. And we can see that again today. J&J down about 2%, AstraZeneca down 1.5%. Gilead notably is up about 1%. And finally, let's take a look at crude oil because that has been volatile lately, kind of bumped up against some resistance, and it's down about 1%. But can you imagine trading at a 36 handle? I don't think a lot of people would have expected that a few months ago, certainly not me. But if you take a look at the year-to-date chart, we could fill a gap that's all the way at about the 40 level. That would be in here. We'll have to see if that happens, but we are facing some resistance. Even the fact that OPEC Plus, or at least Saudi Arabia and Russia, have agreed to extend the production cuts into July, not enough to put a bid on crude right now. Adam?
Jared, you mentioned China and the airlines. I want to point out to everybody, there's a hearing underway right now on Capitol Hill. It's a digital hearing, video conference hearing on how the U.S. should react to China's crackdown on Hong Kong. We're going to be speaking with Senator John Kennedy about that and much, much more when we come back. Yahoo Finance is on the move.
You're watching On the Move on Yahoo Finance. I'm Julie Hyman alongside my co-anchor Adam Shapiro. Also weighing in over the next hour will be our colleagues Dan Howley and Melody Hom. We've got a mixed picture for markets at the moment. The Dow very slightly to the upside, just above 26,000. The S&P 500 down about 0.25%, around 3,100. And the NASDAQ is also down, in its case, about 1/3% here. So again, a little bit of a mixed picture today. This after we got the latest weekly jobless claims numbers coming in at nearly 1.9 million, but a slowdown in the velocity of increases that we have seen in jobless claims as of late. We will talk more about that in just a moment. Also, more stimulus in Europe being announced today. The ECB's bond buying program, so-called Pandemic Emergency Purchase Program, has now grown to 1.35 trillion euros. Germany also introducing a large stimulus package of 130 billion euros. So that's something to watch as well on that front. And also, we continue to see tensions ratchet up between the U.S. and China. There is a hearing going on today with regard to that and to Hong Kong. We're going to be joined a little bit later in the program by Louisiana Senator John Kennedy, who is in that hearing right now. But let's get to those jobless claims, not only the numbers from today, but also tomorrow. Of course, we're going to get the monthly jobs report. Our Heidi Chung is joining us now to break down the numbers. Heidi.
Hey, Julie. Yeah, for the first time in 10 weeks, the weekly jobless claim number came in below 2 million. Last week, another 1.88 million Americans filed for unemployment benefits, exceeding economists' estimates for 1.84 million initial jobless claims. The prior week's figure was revised higher to 2.13 million from the previously reported 2.12 million. After peaking in the week ending March 28th, the weekly number has been on a steady decline, but so far over the past 11 weeks, more than 42 million Americans have had to file for unemployment insurance. Last week's report showed that continuing claims declined for the first time since the pandemic hit the U.S., but in this week's report, continuing claims increased to 21.49 million in the week ending May 23rd from 20.84 million in the previous week. Consensus estimates were for 20 million continuing claims. And pandemic unemployment insurance program claims, which includes those who were previously ineligible for unemployment insurance, such as those who are self-employed and contracted workers, fell to 623,000 last week from the prior week's 1.3 million. Now, today's jobless claims number comes on the heels of yesterday's ADP private employment report and ahead of the highly anticipated May jobs report being announced tomorrow morning. Economists there expect that the U.S. economy shed 8 million non-farm payrolls in May, following a record 20.54 million job losses in April. And Julie, the unemployment rate is expected to surge to its highest level since the Great Depression to a whopping 19.5% from April's 14.7%. So the focus tomorrow certainly will be on the U.S. labor market. Julie?
It will. Thank you so much, Heidi. Appreciate it. Let's talk about what all of this means for markets and what it could continue to mean for markets. We're joined now by Tony Dwyer. He is Canaccord Genuity Chief Market Strategist, joining us from upstate New York. Tony, it's good to see you. So we look at these numbers, which obviously look very dismal. There has been a lot of talk about how the market's perception seems to be things are going to improve from here. And in a recent note, you also wrote, what I'm going to boil down to say is sort of that old saw, don't fight the Fed. Am I interpreting that correctly? In other words, with all the stimulus out there, the path of least resistance is probably still higher for stocks?
Well, the real turn for us, Julie, came on this on twofold. When the Fed, after the last FOMC meeting and at the press conference, the Fed chairman said literally, there is no dollar limit to the support we're going to give to the credit markets. That's an extraordinary statement that says that any credit problem that emerges, they're going to be there to backstop you. And what that did, what most people don't realize when they talk about the market is there's been two different markets here. There's been the stay-at-home market, which was the first, incredible leg up on the S&P and the markets coming off of the March 23rd low, led by the mega cap stocks that benefited from working and staying at home. What's been transitioned since that FOMC meeting, and then even more so after the 60 Minutes interview, where Powell said, where the Fed chairman said, not only is there no limit to the amount we're going to print, we don't worry about that till later. That's not only is it, he's officially telling the world that he's printing money and not to worry about it, he's just going to keep doing it. And it was at that point that second, more different kind of group started to rally. We called it the value stocks, the banks, and the tanks, the economic reopening trade. After that 60 Minutes interview, what had happened before, and just that Thursday before it, do you remember Wells Fargo was rumored to be going to be in trouble, bailed out by Goldman Sachs and having to cut their dividend? 60 Minutes happened, and that shifted it. That comment that don't worry about it, we're going to print money, that really did it.
Tony, it's Adam. Good to see you. So when you folks at your firm make a move to, as you said, to being more offensive in your investment strategy, what's your time horizon? And is it different than the horizon for those of us who might be individual investors? You have much larger pools of capital at your disposal than, say, someone like us.
I appreciate the question, Adam, because I think all too often people like me come on TV like we're telling individual people what to do. The only person that can decide what to do, my job is to give an idea of what could happen. And then you work with your own risk management and financial advisor to figure out what you should do. I advise institutions. So the offensive trade, we weren't defensive. We were market neutral, which meant you're indexed. I couldn't really understand what to do given the uniqueness of the environment. When the Fed chairperson tells you he's going to print unlimited money, literally using the term printing money, and don't worry about that for the future, you want to be exposed to the economic reopening stocks. So just as an aside, the S&P is up 5% from that move we made early last Tuesday morning when the market opened after the Memorial Day holiday. But banks, or the financials and the industrials, are up 13 and 11% respectively. So the mega caps work from home, worked up until maybe late April, and now it's all about the economic reopening.
Tony, I have a bit of a random question for you, which is I'm curious how much retail versus institutional has played a role in this rally. I mean, someone recently said to me, with all these people working from home, a lot of people who wouldn't necessarily have time to might also be trading from home, right? Just lay people, retail people who have stocks and have been trading them. Do you think that has, I mean, I know normally retail is not sort of a big needle mover.
I think it's garnered a lot of attention, Julie, and I'm really glad you brought it up, because I think this narrative that the Robinhood traders, that are home, figuring it out and day trading because they're sitting at home, I don't think that works here, and here's why. Prior to that Fed 60 Minutes interview, emerging was underperforming developed countries. Economic reopening was underperforming mega cap, predictable growth stocks. Since the Russell 2000 was performing really poorly relative to the S&P. So the point of that narrative is, if all of those areas are doing better, that's just too big for the day trader sitting home doing Robinhood. It's not just, a few stocks, it's currencies, it's bonds, it's sectors, it's capitalization. It's too broad. The market shifted. This is so important. The market shifted from, we're going to be working at home for far too long and staying at home, so buy these mega cap names, to, whoa, the banks just retested the low in mid-May. They haven't moved yet. I mean, the banks are up almost 20% in under 2 weeks. So it's a catch-up trade. The market being up over 30% in May wasn't the conclusion that the economy's in a V-shaped recovery. I think it was more a conclusion that it wasn't. And now you're starting to discount that economic vitality through this quote unquote reopening trade.
Tony, when you think about the stay-at-home trade, of course, Zoom video conferencing came out with really blowout earnings. We should expect Slack's earnings out after the bell today. I mean, I hate to be the cynic here, but is it the kind of paradigm where kind of good news is bad news now, because this means it will be the full peak? We can't really expect those kinds of numbers in the months to come.
Well, I think something we were talking about before we came on air is when's everybody going to go back to work, and what's that going to look like? So I'm not so sure that it's not a black or white situation. I don't think our call over the last month has been, if you're significantly overweight these stay-at-home stocks, bring it back toward neutral. They've had such an incredible move, but that's not, go short or underweight. It's just go back to neutral. Where you wanted to focus new buying was on those areas that hadn't done well. We called it the value, the banks, and the tanks. It could be consumer discretionary. It could be materials, anything related to economic reopening and the vitality that brings.
Tony, in the last hour, we talked to a guest from the Global Association of Risk Professionals who is concerned about the leverage loan default rate, which he said could be as high as 25% and could pose a systemic risk down the line. Are you concerned about that, or do you think that the Fed is in there enough that that is not as high a risk?
There's a lot of credit issues that I could come up with. Like I could craft a really negative scenario based upon commercial real estate leverage, based upon private equity revaluations after the drop, and based upon things like that. What the market is focused on is so far that the Fed has said that they're going to step up and solve any problem that comes up. And interestingly, they have. As you know from our most recent note, you've done about $1 trillion now in corporate credit new issuance in just 2 months since the March 23rd low. That funds companies getting through this crisis. So if you do actually reopen the economy, you have the ability to eventually grow again. These credit issues are there. They're real. There's at some point, somebody's going to have to pay back the money. And that really hasn't been like a focus of mine. I'm not one of those, oh my God, the deficit's so big, run for the hills kind of strategist. But the amount of money printing is really extraordinary. But for now, like I said, the move is don't fight the Marty Zweig. Don't fight the Fed. Don't fight the tape.
And for you guys strategically, what does that mean for you on the credit side? Are you staying in investment grade and away from sort of further out the risk profile?
When the Fed announced that they were going to buy various areas of high yield debt, that was a good news item. But the market, it spiked that day, and then it kind of didn't do much in corporate land. It kind of went sideways. Spreads went sideways. Absolute yields went sideways. When the Fed made that comment after that at the 60 Minutes interview, where we're going to print money, they didn't even use quantitative easing. He actually said we're printing money. And there's no limit to what we're going to do and worry about that later. All of a sudden, you got a massive rally in investment grade and high yield bonds that has continued. So our call has been since that time, which was May 12th or May 16th, you want to be buying buy what the Fed is. The guys printing the money told you what they're buying. Right? So you've seen a solid rally in corporate, both investment grade and high yield. It may be honestly a little bit excessive at this point, but again, the guys printing the money are still buying it.
Yeah. All right. Good points here. Follow the Fed. Tony Dwyer, Canaccord Genuity Chief Market Strategist. Always great to see you, Tony. Be well, and thank you for joining us.
Thanks, team. See you later.
Thanks. Well, what Tony was just talking about is actually a pretty good segue into our next guest. That is Sheila Bair. She is the former chair of the FDIC. She's joining us from Maryland because we have two issues that are really acute right now in America that we've been talking a lot about, not on the market side, but rather on the economic side. One is inequality, and the other is racial justice and systemic racism. And Sheila, I want to take that first issue first and pick up on what Tony was saying about people following the Fed, because I know you're looking at people following the Fed and what that has done to income inequality in this nation. And by the way, I should mention Ethan Wolfman is with us as well and is going to be chiming in with some questions. But Sheila, address that first for us, if you would.
Yeah. Well, I think it does contribute to inequality, and I think it would be good for the Fed to acknowledge that and try to find better ways to use their tools in a way that doesn't exacerbate the problem. There are benefits to what the Fed has done, there's no doubt, but these, endless cycles of we get in economic trouble, we go to the Fed, they lower interest rates, and back in the great financial crisis, they started buying bonds with quantitative easing. So all of that inflates the value of financial assets, and inflates the value of stock, and inflates the value of outstanding bonds that have the higher rates than the lower rates that the Fed's instituting. So that's just factual. Rich people are the ones who own the lion's share of those assets, and it doesn't really trickle down to labor markets. There's some indirect help, but not enough. And we saw it with the moribund recovery for most of America after the great financial crisis, very stagnant wage growth. Finally, lower and middle income families who were just starting to catch up. It took about 10 years, and that's typically what a recovery takes after a financially induced recession. So my sense is we were going to get there, maybe get there despite low interest rates, not because of it. But now you're seeing the service workers that are disproportionately minority, African American, lower and middle income. They're on the front lines of this terrible crisis. They're still reeling from the aftermath of the great financial crisis. Minority households, particularly African American households, were much more likely to get these subprime mortgages. They were much more likely to go into foreclosure. Even the ones who could keep their homes have remained underwater much, much longer. You've seen a net worth plummet for African American families. It's actually lower than it was in the early 2000s. So all of these things are pin-up stress points for African American families, and I think this is an element of the explosion of emotion and frustration, justifiable, that we are seeing now.
Sheila, it's Adam. Good to see you and hear you. I'm curious because Jay Powell used the word absolute. It does not, he believes Fed policy absolutely doesn't impact income inequality. So what could the Fed do? Because I would imagine the Board of Governors would respond, that's really up to Congress, not up to us.
Right. Well, that is the attitude. And, but I think you keep pumping money into the financial markets, and to their credit, they've been heroic with this. They've been trying to launch that Main Street program. They started off, accepting PPP loans in their liquidity facilities without discounts. So that helped fund the small business program that Congress enacted. But there are new and varied ways. One is digital currency. So the Fed has resisted that. I think they're now moving more to trying to understand that technology and how it could give them a better transmission mechanism. Congress needs to authorize this. I don't suggest that. Congress needs to step up as well. But opening their minds to, look, if they're going to gin up the printing press, where's that money going now? It's going into financial markets. It's primarily benefiting banks and large corporations that use the bond markets to fund themselves. They're trying to get it out. I give them credit for that, but their tools that they have now just are not equipped to get it down to Main Street. And in my view, and there are a lot of credible people now saying this, when we get into a crisis like this, there should be some automatic stabilizer. If they're going to print money, just print it and send it directly to households. Don't do loans. They got too many loans already. You're going to increase the money supply, put it directly into households. With digital technology, you have the means to do that by now. It'd probably take 12 to 18 months to build it, but it's there and it's possible. And I do think the Fed is more actively looking at this as a potential alternative. Again, Congress needs to authorize this. I'm not one that wants to blur the fiscal and monetary rules. But nonetheless, I think if we're going to increase money supply, use that as a tool to smooth out economic cycles, get the money to Main Street. That's where it's needed. That's where our economy needs it, given how heavily we're driven by consumer spending.
Hi, Sheila. Ethan Wolfman here. Thanks for talking about this with us. One thing that I saw that came out today was about the amount of overdraft fees last year. It was $11 billion, and this mostly coming from people who have to overdraft, and this obviously affects Black communities significantly. I'm wondering about, from your view, what some of the biggest problems in systematic inequality perpetuating things in the financial system, and particularly in banking, need to be addressed? Yeah.
Well, it's a good question because there's a lot of consumer debt out there. Again, it's disproportionately owned by low and middle income families. They typically have higher interest rates on their loans. They're viewed, as higher credit risk. Yes, and because they don't have much in the way of savings, they live paycheck to paycheck. They're disproportionate users of overdraft fees, which are high rate abusive. I've been fighting against them for years. We've made some marginal progress. But it's just one of the many examples where even when, we've made progress in giving minority and African-American families access to financial services, they can access it, but it's still higher cost. I mean, look at what happened with the subprime crisis. The problem wasn't the credit was being denied. The problem was they were being given high cost credit. And the tragedy of that was we saw home ownership rates among Blacks and Hispanics increase significantly in the late 2000s. Then, 2001, we started doing subprime mortgages. We didn't increase home ownership rates with minorities from 2001 until the crisis hit. We stripped equity. We took those minority families out of their nice, safe 30-year fixed rate mortgages, put them into these equity-stripping, high interest rate loans they did not understand. Their neighborhoods were devastated. The home ownership rate has dropped. So many are still underwater still. So it's just one of a number of areas where even when you have access, it's unfair, it's discriminatory, it's higher cost access. And those are root economic problems we absolutely need to confront and face. And again, I think they underpin this broader frustration and anger that's justifiable that we're seeing right now.
Sheila, I just kind of want to ask about the unbanked and how, minorities who find it difficult to have checking accounts, which are so important for everything from, I mean, we saw with the stimulus bill that you needed a checking account to be able to get access to that money right away. How can the Fed or the government bring to bear its capabilities to ensure that the unbanked can get access to banking facilities?
Right. Well, I do think digital technology, so we may be seeing a transformation from banking accounts to digital wallets that are used for real-time payments. So you don't have, it's real time. So you don't have overdraft. You don't need to have that short-term credit, whether it's on a credit card or through overdraft protection to do it. So I think technology in the next couple of years, I think will help us solve a lot of this problem. If we're open to it, if the government's open to it, it needs to be appropriately regulated like any other financial services. So I think that's part of the challenge. In the interim, though, we've got to be careful because a lot of people who are unbanked used to be banked and they stopped because they got overdraft fees, they got minimum balance fees, they got a lot of fees they didn't understand. They were too complex, were not appropriately explained to them. It cost them to have that banking account. It cost them more than it was benefiting them. So we need to really continue to push banks of all sizes to offer, these no-fee basic checking accounts for people who just need to do it to process payments and get rid of those overdraft fees. So it's the kind of product is as important as making sure all Americans have access to a checking account.
Sheila, Julie again. So I guess in conclusion, how do you make all of this happen, right? Whether it is increasing access to bank accounts, whether it's increasing access to the housing market, for example. I mean, technically, of course, there are anti-discrimination laws on the books.
Right.
The problem is the sort of systemic racism that comes from things that are between the lines, right? That are not said. And so do you legislate that away? Do you regulate that away? Do you change the culture? And if so, how do you do that? I mean, this is obviously a huge...
Yeah, no, it's right. I think it's a very complex problem. I do have a lot of hope for technology addressing a lot of this, making, financial services much lower cost, much more real time, much less reliant on credit. I do think technology, it can be abused too. So we need to embrace it, but we need to regulate it as well. But especially in the payment space where overdraft fees, things like that, a lot of abuses occur. It may be that technology through algorithms too can help us get away from the implicit biases that still permeate underwriting and credit decisions. So you've got to be careful there too, because a lot of the algorithms can themselves pick up instances of systemic bias. So that needs to be appropriately regulated. But I think through a combination of technology and frankly, just a national moral commitment, we have got to change our culture on this. We can't, it breaks my heart. We haven't even talked about student loans, but this is another area where African-American students have been horribly exploited with home ownership, getting an education. The financial sector, whether intentionally or not, exploiting people who are trying to improve themselves and trying to improve their lives. It has got to stop. It is not right. And, and even now I hear on the great financial crisis, rationalizations from Wall Street, they were just trying to help, Black families get a home. That is such nonsense and defies every, statistical objective piece of research that's been done on this until the sector itself acknowledges they've been part of this problem and cleans up their act. It's just not going to happen. So that involves their choice. It's something government can't force. But I do think technology, by disintermediating some of this, will help provide some pressure to get, services that have equal access, that are truly neutral in terms of how they're priced, how they're delivered. I think that's, again, properly regulated. I think that's going to be our best hope on this.
Hope. I like that we ended on that note. Sheila, thank you so much. It's great to get your perspective as always, especially on this. Sheila Bair is the former chair of the FDIC. Thanks so much. And coming up next, just as Sheila was talking about pushing for change, we're going to talk about the increasing number of employees at both media and tech companies who are doing just that. We'll be right back. You're watching On the Move on Yahoo Finance. Well, as we have seen people take to the streets over the past week to protest the killing of George Floyd and so many others at the hands of police, we've also seen increasing dissent within companies, and in particular within media and tech companies. One prominent example coming just yesterday when the New York Times published an op-ed by Senator Tom Cotton in which he called for military intervention in U.S. cities. A number of reporters and other employees at the New York Times took to Twitter, and all of them basically tweeting similar sentiments, saying that they thought that this op-ed put the lives of the employees, particularly the Black employees at the New York Times and Black people everywhere, in danger. That was the word that they used. The publisher of the Times has responded in a note saying that he defended the decision, but at the same time said he was going to listen to employees. Melody Hom, I know you've been watching this issue closely, and it is interesting and a shift seemingly, particularly at a place like the Times where I believe the policy is for reporters to not take an action like this.
Yes, exactly. And, just reading through this letter, Julie, I have to say it's cowardly. I'm looking at 5 different kind of tweet grabs that folks from the Times really published on Twitter this morning. And like you say, there's no real apology to the Black journalists who are fighting on the front lines, who are attending these protests, who are in danger in order to cover the story. And even here internally, we can disclose that we have had these kinds of trainings, right? If we were to do field reporting, the kinds of protections that we need to do. And these are even folks who are not Black, who are facing those sorts of dangers. So I think there is definitely some momentum that's coming from internally, where perhaps even 5-6 years ago, there wouldn't have been this galvanized group of a chorus of sorts internally. They might have been fearful for their jobs. They don't want to speak up. But I think there is momentum here, and kind of switching gears a little bit, thinking about a company like Facebook, where we have seen 33 employees, early employees, penning a letter essentially saying that they were responsible for creating Facebook, but the company today is not the one that they love. It's not the one that they built. It's not the one that they're proud of. And we have seen this huge clash from the executive team, from folks like Mark Zuckerberg, and the people who are actually building the products and who are responsible really for the creation of these. And just perusing LinkedIn this morning, I have seen at least 2 folks posting viral posts that have since, kind of exploded on the platform, former Facebook employees now kind of acknowledging their resignation because they are not happy with the direction that the company is going in.
Yeah, Melody, the fact that, real quick on the Times is interesting, just because their op-ed page has been a source of difficulties, I guess, for the paper and journalists there. Some op-eds promoting just conspiracies or inaccuracies as far as science goes. And this one seems to really just cross a line just beyond that. But as far as Facebook goes, you look at something like Mark Zuckerberg, who, has said in the past that he would have taken action on comments that elected leaders make that could drive violence. He specifically said he would make moves on that and take such posts down. And here we have an example of him kowtowing to President Trump because he's afraid of any kind of pushback. And, Twitter made the move, Snapchat made the move. Snapchat yesterday discussed about how they weren't going to promote President Trump in Discover anymore. And, it's interesting to see how Facebook has tried to court conservative voices, specifically having sit-downs with them over accusations of conservative bias. There is none. We haven't seen any evidence of such, and it doesn't make financial sense for companies to have a bias one way or the other because they want to draw in as many users as possible. This is just kind of on Zuckerberg's part. I mean, a failure is kind of the easiest way to put it.
Dan and Melody, I want to talk to you guys about recruiting, because particularly in Silicon Valley, let's leave the Times aside for a minute, particularly in Silicon Valley, that's the competitive edge. And it is fiercely competitive between tech companies there. Where do we get to a tipping point where this becomes a real problem for Facebook because it can't attract or retain talent because they have philosophical differences with the management of the company? Dan, you want to weigh in first on this?
Yeah, I mean, look, Facebook is from an investor standpoint or from an employee standpoint, it's going to be different. When you look at from an employee standpoint, you're going to say, well, I don't agree with what you're doing, and I can just go down the road and get a great job at Google. Google is a company. Don't get me wrong, Google has its own issues, obviously, but they have responded to employee issues. They pulled out of government contracts as far as AI goes over concerns from employees. They had abandoned their plans for a search engine for China after a lot of pushback from employees as well as those in the government. So, I mean, look, if you're an employee at Facebook and you aren't happy with the way the company is going, you have myriad options. They are fighting to get you as an employee. You don't have to fight to work there if you are a high enough level developer. And I think, that's something that we're going to continue to see, the kind of employee activism at these kinds of companies. It comes down to whether or not you agree with what the company that you work for is doing.
Dan, thank you. Speaking of technology, up next, we're going to be talking about one of the tech IPOs coming to market this week. ZoomInfo, ZI is the ticker, is set to begin trading, I believe, imminently. It is indicated far above the price at which it sold shares. $21 is where it sold shares. The latest indication I saw was pushing $40. We're going to speak to the CEO of that company next. It is the busiest week for IPOs that we have seen yet this year. And one of the companies that's just opened for trading is called ZoomInfo. ZI is the ticker. They sold 44.5 million shares at $21 each, raising about $935 million in that initial sale. The shares are surging, almost doubling as they get underway here today. We're joined now by Henry Schuck. He is the CEO of the company, and he's joining us from Vancouver, Washington, just outside Portland, Oregon. Henry, congratulations. Thank you for joining us. Your company, there are a lot of Zooms out there. Just to be clear, ZoomInfo, ZI is the ticker. It is a marketing intelligence company, basically. You sell marketing leads, is my understanding of what you do. What are you guys going to use the proceeds from the IPO for?
Yeah, great. Thank you for having me. Really what ZoomInfo does is we help sellers and marketers find their next best customer. We do that today.
Oh, we're getting a bit of a freeze on Henry's shot there. So we're just going to put him on pause for just a second. Inez Ferre is with us as well. Inez, I know you are watching this stock very closely here. And as we talk about these IPOs that are happening this week, I imagine this one's performance is pretty exceptional.
pretty incredible right now. The stock is soaring more than 90%. The company pricing its IPO at $21 a share. That was above its range. And as you said, Julie, not related to Zoom in any way. This is a cloud-based platform for sales and marketing teams, and it provides information about organizations, about professionals. Now, the company, from what I saw in its S1 filing, is that its top line just about doubled between 2018 and 2019, with revenue coming in at $293 million for 2019. Revenue the year before was $144 million. Its losses had also, though, widened. Its net loss came in at $78 million in 2019 compared to a net loss of $28.6 million in 2018. But certainly a really good reception for ZoomInfo in this IPO.
And I think we have Henry back. Sorry about that.
Sorry.
Well, you know, this is just a factor of our new reality, Henry. So please don't apologize. So please continue what you were saying about what you guys do.
I have no idea where I got cut off, but we help 15,000 companies and 200,000 sellers and marketers find their next best customer and do that with data and insights and technology to get there. We're excited to open today. We're going to use close to $700 million of the proceeds to pay down debt and then put cash on the balance sheet.
Henry, congratulations. It's Adam Shapiro. Help me understand specifically what that means when you talk about sellers and marketers. Would I, as a consumer, and we had a segment earlier about VPN, so I couldn't be tracked. How does this work? And if someone gets one of those VPNs, is it going to interfere with what you do?
Yeah, look, first of all, our customers are all businesses and they're all selling to other businesses. So it's all the B2B economy. And so imagine, and I'll give you a great example. We have a customer called TentCraft. TentCraft makes big tents for outdoor events. So you go to the Taylor Swift concert, there's the big VIP tent or the outdoor tent. That's what they do. And they do it for events. And the pandemic hit and literally all of their business evaporated. There wasn't a single event on the face of the earth. And so they turned to us and they said, look, we're making tents. We think there's an opportunity to take these tents and reconfigure them to be able to sell them to hospitals and healthcare facilities so that they can use them for outdoor COVID-19 testing. The problem for us as TentCraft is we've never sold to a hospital. We don't know how many there are in the country. We don't know who the decision makers at those hospitals are. We don't know which ones are in our backyard, which ones are anywhere across the country. And we need your help. And so we gave them access to ZoomInfo. We gave them access to our platform and our data and insights. And within the first week, they sold to a hospital in Erie, Pennsylvania, and then a hospital in New Jersey, and then a hospital in Texas. And just last month, TentCraft had the biggest revenue month in their company's history. And it's the platform and the data and analytics that lets you target your next buyer, know who to contact, know what to say when you contact, and to be able to do that quickly. This is a solution you can buy on a Monday, be provisioned and trained on a Wednesday, and be counting ROI on a Friday. And we think that's a really important part of our solution, and it makes it really important, especially in the economy as it is today.
Henry Naspere here. Congratulations on your IPO. Just taking a look at the numbers in your S1 filing, your revenue for 2019, it practically doubled from the year before, but your net loss widened. So what are your plans for profitability? And does the pandemic shift at all your timeline for profitability?
Yeah, so I think what you're looking at is GAAP profitability. I think what our investor base really pays attention to is both top-line growth, which we're growing organically over 40% a year, and then adjusted operating income margins. And we have adjusted operating income margins of 47%. So this is an incredibly cash flow generative business. But we're going to get to GAAP profitability in the short term.
Henry, I also wanted to ask you about growth through acquisitions, not just organic growth. I know that you guys combined with a company called DiscoverOrg back in February of last year, and you really increased in size as a result of that. So I'm curious with the path going forward, whether you see more opportunities for that.
Yeah, so actually, funny enough, I founded the company when I was 23 years old. I put $25,000 on my credit card while I was in law school to found the business. I founded it as DiscoverOrg, and we actually acquired ZoomInfo and then took on their name because it was just a better name than DiscoverOrg. And And it was a really successful M&A transaction. We had done a handful of M&A transactions before, and we think we have a muscle for M&A, which is not often found in software and technology companies. And it's a muscle I think we will continue to flex in the future.
Henry, again, congratulations. Thanks for riding through the tech issues with us. Appreciate your time. Take care.
Thank you so much for having me.
Thanks again.
Bye-bye.
Well, coming up next, we're going to be talking about the beauty business, what salons are doing right now as states begin to reopen. We'll be right back. You're watching On the Move on Yahoo Finance. As we start to see different states make their way through the different phases of reopening, a lot of folks are anxious to get haircuts. I speak from experience. We're joined now by Christina Russell. She is CEO of Sola Salon, which is a franchise company that has about 500 salons in its network. Christina is joining us from Denver. Thank you for joining us. So how many of those 500 salons are now open? And what kind of precautions are folks needing to take?
Yeah, thank you so much for having me. I have to say we are excited today to be about 80% open. So we are fully open across most of the states. There's only 7 where we're still fully or partially closed. And that means we have about 425 of our locations open. And this is something that means a lot to our beauty professionals. We actually provide support to over 15,000 individual independent beauty professionals that operate within our locations. So it's good to see them all back in business. They were eager to get started. As far as precautions, you know, it's been an interesting journey with this, realizing that we have in our model some natural things that actually make it a little bit different than probably what the traditional salons are going through, because we do operate in individual studios. I see that you guys are actually showing some images there on the screen. I don't know if those are showing up for the viewers, but you can see that each studio is independent and it has its own sliding doors. So it's always a one-on-one interaction at Sola, and it's allowed our stylists to give their clients a little bit more comfort with coming back in for these types of services. But there have been quite a few changes that we've made both operationally and in terms of our cleaning protocols to make sure that we're keeping clients and our beauty pros safe.
Christina, I just kind of want to ask, what are you seeing from clients, or what are the franchises seeing from clients? Are they hesitant to return? Have they returned en masse? Are they trickling in? How has the reception been?
We wondered about that and how that might differ across different markets where the COVID-19 outbreak has obviously been a little bit different in certain markets. But what we've generally seen is just an eagerness to get back to work. Because our stylists are independent beauty professionals, they're not employees. This is really their sole livelihood, and they don't have the ease of getting the PPP because they're such small micro businesses. So, the benefits may or may not be there, but it's hard for them to really make it through because the loans they would need are such micro loans. And then in terms of unemployment, they're not traditional employees. And while some of the laws were changed in states to allow independent professionals to also apply for unemployment, not all of them made it through the eligibility process and actually ended up seeing money in their pockets. So they've been eager just to get back in. From a client perspective, we have seen that the pent-up demand that you hear people talk about certainly was true in the hair industry. Many of them have been busier than ever. We saw a huge uptick in terms of their business through the platforms that we can view. And we were impressed with that. We were not surprised by it. And we imagine that it will continue at least for the first few months of this as they catch up with clients who've waited, several months to come in for services. And then we anticipate that it will normalize a bit as people get back into their normal hair care routines. As far as the uptick in our business with stylists, it's interesting because the beauty industry at large is feeling a lot of strain around this. And it's really tragic for some of the smaller mom and pop businesses, independent salons, because they may or may not be able to weather the storm. We've heard estimates from beauty industry experts and analysts saying that it could be between 10 and 30% of traditional salons that don't make it through the crisis. And that's, astonishing. And it's, as I say, it's a tragedy for our industry. What that's meant for us is that there's quite a few stylists that are looking for a home. And so we've seen a lot of interest in going independent in renting studios in our spaces.
Christina, it's Adam here, and a lot of us are rooting for these businesses to succeed. There's a lot of fear about the airborne possibilities of COVID, and yet a lot of cities regulate the air filtration systems at hair salons. Forgive me for quoting Legally Blonde, because you have things like ammonium thioglycolate in the air. Do those filtration systems, it would seem to me that they are an extra safety feature. I mean, the regulations might be, pretty strict in New York City, but here you have something that unintended consequence to the positive.
I agree with that 100%. And I think, the other benefit that a lot of people don't realize in the beauty sector, unlike the folks that are preparing or delivering your food, who don't get a whole lot of training in sanitation, beauty professionals take hundreds and some estimate over 1,000 hours of sanitation and cleanliness training as part of their certification. So between that certification that they've done already and the learnings that they had even through the AIDS epidemic, we've partnered with Barbicide, who helped the industry through the AIDS epidemic in terms of understanding disinfection. Those kinds of tools and resources for recertification are very familiar to our professionals. And then in terms of the filtration, you're absolutely right. This is a big concern for the beauty professionals that operate within our locations, because each one has her small studio. A location might have 20 to 40 studios in it, and they don't want to have the mixing of the odors and chemicals from one studio or another. So we pay a lot of attention to that ventilation already. And that has given, I believe, some comfort to our clients and even to beauty professionals that operate out of traditional salons as well, to look at the differences that might be happening in the studio environment.
Christina, thanks for talking us through what you and your various salon professionals are going through. Christina Russell is the CEO of Sola Salon. Thanks so much. Appreciate it.
Thank you, Julie.
All right, we'll be right back.
Thanks all. I appreciate it.
You're watching On the Move on Yahoo Finance. Some breaking news for you. The U.S. Attorney General Bill Barr just announced that the Department of Justice and the FBI are opening an investigation into violation of civil rights. That's civil rights laws. That's in connection with the death of George Floyd. So we'll keep you posted on any more headlines. The Attorney General just holding a press conference in the past hour. Well, as we look at the protests that are going on around the nation, of course, a lot of people are still out of work. We learned today that unemployment numbers for last week, jobless claims, rose to nearly 2 million. We've got the monthly jobs report tomorrow. And our Rick Newman is looking at a new report from Moody's that shows things on the economic front may not be getting better anytime soon. Rick?
Hey, Julie. Yeah, I mean, I've been paying attention to a lot of the longer term forecasts from economists. And this, of course, gets to the question of why in the world is the stock market surging when the economic picture is so gloomy. Here's one of the things that jumped out at me from this recent Moody's Analytics report. So Mark Zandi, the chief economist there, estimates that of 8 million businesses operating in the United States, we could lose up to 1 million of those. So 1 million business failures. I know that Congress has pushed some aid out to those businesses, and the Fed is trying to help. But it turns out there are a lot of businesses, and especially small businesses, that cannot really access the Paycheck Protection Program because they don't really have a relationship with a bank. Just for other reasons, they're going to go out of business. And this is long-term structural damage to the economy. These are not businesses that we're going to replace easily. So I know the stock market looks ahead to the future and anticipates future economic activity, not current or past. But just in May, we just got numbers today, 48% increase in commercial bankruptcy filings year over year for the month of May. And I think that's just a preview of a lot more carnage coming. So the economic outlook is gloomy.
Rick, I'm curious. We grew up listening to Republicans warn about federal government overreach. And now with control of the Senate and the administration, we're witnessing why we might want to be worried about federal government overreach. How do Republicans run in the fall on what they used to stand for?
They don't, honestly. What I think they try to run on is, they're going to probably try to steal some campaign points from President Trump. He hopes that by the fall, he'll be able to point to at least some data that shows improvement in the economy. And there probably will be some data that shows improvement in the economy, but this is going to be a terrible picture for a considerable period of time. We will probably have an unemployment rate that's still close to 10% by the end of the year. That was the peak at the worst point of the last recession. IHS Markit, another forecasting firm, they're saying we're not going to get back to pre-virus employment levels until 2024. That's 4 years from now. The Congressional Budget Office is saying that we will have $15.7 trillion worth of lost economic output by 2030. What they're saying is like, look, we are suffering structural damage right now that is going to be costing us jobs, businesses, and income for years.
Hey, Rick, I want to ask, there's been talk of the different kinds of recoveries we might have. Every letter in the alphabet has been thrown out there. We've talked about the potential for the virus coming back in the fall. Where is the bottom? We've been told that the bottom came and went. We're going to see some kind of recovery, but if that's going to happen again in the fall, have we really seen it?
Well, if you look at the unemployment numbers, and we're going to get another batch of them tomorrow, we probably are close to the bottom. But I think that's a misleading way to think about it, because it's almost as if, well, if you're at the bottom in June, then you'll be out of the bottom in July. It's very possible that we're at the bottom and we're going to stay at the bottom. So think of it as like a giant swimming pool. We're at the bottom and we have to walk to the other side, and it's a long way. It's like if your house burns down, you can put out the fire, but you still have no house. So I think it just seems very possible, perhaps probable, that the worst of the damage is behind us, but that we just muddle along in a state of shambles for months, if not longer.
Right. Yeah. The swimming pool is not one I've heard yet. The V, the swoosh, all of those I have heard. Rick Newman, thank you so much. Thanks to Adam and Dan and Melody as well. Keep it right here on Yahoo Finance.
Welcome into live coverage here on Yahoo Finance. I'm Zach Guzman. This is the ticker. Right now we have stocks in the red. All three major indices trading lower today, taking a break from 4 consecutive trading days of gains. Right now the Dow off by about 1/3%. The biggest loser today, the NASDAQ, off by about 0.8%. On a sector-by-sector breakdown, what we're seeing right now in the S&P, only financials, industrials, and materials, the 3 sectors in the green so far. The other 8 in the red being led to the downside by real estate, off more than 2%. But of course, the market's reacting to the update we got from the Department of Labor in terms of unemployment claims. That number exceeding the expectations economists had. The total tally coming in at 1.87 million Americans filing for unemployment benefits in the week ended May 30th. And for more on what we're seeing in that report, not necessarily the direction economists wanted to see ahead of tomorrow's big jobs report, I want to get to Yahoo Finance's Heidi Chung, who has more details. Heidi?
Hey, Zach. Yeah. So for the first time in 10 weeks, the weekly jobless claim number came in below 2 million. Last week, another 1.88 million Americans filed for unemployment benefits, exceeding economists' estimates for 1.84 initial jobless claims for the week. The prior week's figure was revised higher to 2.13 million from the previously reported 2.12 million. And after peaking in the week ending March 28th, the weekly number, though, has been on a steady decline. But so far over the past 11 weeks, more than 42.6 million Americans have filed for unemployment benefits. Last week's report showed that continuing claims declined for the first time since the pandemic hit the U.S. But in this week's report, continuing claims increased to 21.49 million in the week ending May 23rd from 20.84 million in the previous week. Consensus estimates there were for 20 million continuing claims. And pandemic unemployment assistance program claims, which include those who were previously ineligible for unemployment insurance, such as those that are self-employed and contracted workers, fell to 623,000 last week from the prior week's 1.3 million. Looking at the states, though, that reported the highest number of claims last week, California reporting the highest number of jobless claims at an estimated 230,000 on an unadjusted basis, and that is up from 203,000 in the previous week. Florida had 206,000, up from 175,000. Georgia reporting 148,000, and Texas with roughly 107,000 initial jobless claims. Now, today's weekly jobless claims report comes on the heels of yesterday's ADP private employment report and ahead of the highly anticipated May jobs report tomorrow morning. Economists estimate that the U.S. economy shed 8 million non-farm payrolls in May, following a record 20.54 million job losses in April. And Zach, the unemployment rate is expected to surge to its highest level since the Great Depression to a whopping 19.5% from 14.7% in April. So certainly all eyes tomorrow will be on the U.S. economy and specifically the labor market.
Yeah, it's kind of tricky to tease that out when we think about the better number than we got on the ADP side, and then the underperformance of the number that we got today, and what that could mean when you look to tomorrow. Of course, as we like to do, breaking it down state by state, highlighting some of those states in a different way this week. Looking at the 5 weeks that we saw as the coronavirus pandemic hit the employment picture here in the U.S., the state's been in the lockdown, comparing that 5-week performance in terms of jobless claims filings that we saw in the initial period to the 5 weeks that we've just seen, the most recent 5 weeks. Interesting to note, some states showing a bit more of a stronger turning of the tide here when you think about stopping the bleeding in job losses. Those would be Rhode Island, Vermont, Michigan, Montana, and Idaho, all showing about a 75% drop when you compare those 2 time periods in the number of initial jobless claims. So maybe those states showing a little bit more of a stronger start and trying to return to normal. Of course, it's worth noting that none of those states are showing numbers anywhere close to what we saw in terms of initial jobless claims before the pandemic hit here. So still a long way to go, but at least noteworthy to highlight those states. On the flip side, as we've shown in prior weeks, Florida and Georgia still remain some of the hardest hit states in terms of the overall spike in unemployment claims. And those states, on the flip side, not showing any material progress in terms of the 5 weeks when this first started to the 5 weeks now, only seeing about a 30% drop in terms of average weekly jobless claims numbers in those states. So not necessarily optimism on that front there. But for more on this, I want to discuss what we should be expecting for tomorrow's big Friday's jobs report with our next guest, the CEO of one of America's largest independent public accounting and advisory firms in the nation, Marcum LLP CEO, Jeff Weiner joins us now. And Jeff, when you're trying to gauge what to expect, as Heidi noted, potentially a 20% unemployment rate when we get it tomorrow, what are you thinking about that number and how the market should be bracing for it and what it says about the current state of the economy?
Well, first of all, thanks for having me, Zach. Good seeing you. I think the market knows what to expect tomorrow. The unemployment rate has consistently gone up since March. The coronavirus pandemic has resulted in unprecedented layoffs, mandated business closures. But I think it's more important to focus on the coming weeks and months. Many states are starting to open up again. I live here in New York, where we're in phase 1 of the recovery, and in many places entering phase 2. And as we go through the phases and things reopen, I think the market is going to be more interested in how the numbers start to go down from here, which shows people going back to work rather than what's already baked in.
Yeah, you talk about a lot of that being baked in. I mean, we have recovered on the S&P that 76% retracement level from the lows, recovered those losses. Fundstrat's Tom Lee pointing out that once you do that, likely to see, again, new all-time highs on the S&P. So, I mean, is that kind of the case? I mean, since we have, as Heidi noted, seen the weekly number of initial claims come down pretty much each week since this started after we hit that peak, is it kind of that nothing right now, aside from, I don't know, maybe a second spike in coronavirus cases might be able to knock the market off its current recovery?
No, the market really is looking for the recovery. The market expected the recovery. The market is seeing the recovery. And you just said it. As long as there's not a second wave or a second spike, it doesn't matter whether it's a U or a V or a W. As long as there's steady progress and people are getting back to work and businesses are allowed to open. Remember, a lot of these businesses were closed by government mandate. There was nothing wrong with the economy prior to March of this year. So as these businesses start to open, the one weak place you're going to see is going to be the travel, hospitality, leisure, entertainment, sports. Those businesses where you have mass gatherings and you really, social density is going to be a problem. Those are going to be the last businesses to open, which is maybe why the results in Florida, which is heavily reliant on tourism and travel, the numbers aren't getting better as quickly as they should. But I think the market is seeing exactly what they want to see. And as long as the unemployment numbers start to go down, there will be a point in the not too distant future where we turn negative and there are more people going back to work than filing claims.
Jeff, I want to get your opinion on this because last week, a lot of economists were saying, okay, it looks like we've turned a corner because when we take a look at the continuing claims number, we saw that decline. But this week's report, we saw another uptick in that regard. So is that telling us then that these reopenings aren't really impacting it as much as we would like to see? And are people just not rehiring quickly enough?
Heidi, it's an interesting question. They may not be rehiring quickly enough, and they may not be rehiring everybody that they laid off or they furloughed. There are a number of businesses that will figure out that they had too many people and they can actually accomplish the same with less. I've spoken to a number of Marcum clients who've said, we used to have 100 people on our factory floor and we're doing just fine with 40 now. So there will be a certain segment of the population that companies realize they can be more efficient. There will be certain businesses like baseball stadiums and movie theaters and hotel resorts that don't open at full capacity for the next couple of months. But I think you'll see a slow, steady climb starting sometime the end of this month into July, where the numbers are going to flip and we're going to realize, because it's happening, it just may not be, there's always a lag in the numbers. When the economy is good, the employment numbers lag the good economy. And when the economy is bad, they lag the economy. So I just think that we're going to start to see a slow, steady change of direction. And at some point in the not too distant future, the unemployment numbers will turn negative because more people will be hired that are being let go.
Yeah, and we've continued to wait to see that, at least in this next report, the trend not expected to show a bottom yet. But when we do look at the market itself, it's interesting because last time we had you on a few weeks ago, we were talking about the trend of SPACs and the way the companies have been going that route to access the public market. And just this week, we got the biggest IPO of the year, and Warner Music Group shares again higher. We got ZoomInfo Technologies just debuting a few moments ago. That stock up about 75% in its debut. So what's your take now on how it seems like we've reached a relatively stable point here in June? It seems like the IPO window is back open again. What are you seeing on that front?
Well, it is, and there's a lot of pent-up demand. There was money sitting on the sidelines before the coronavirus pandemic started, and that money is still on the sidelines. The markets, has recovered, basically almost everything that it lost, and people are looking to put the money to work. You talk about SPACs, that's all about management team, and there's a bunch of good management teams out there looking for transactions, and there's money to back them. So I think the IPO market will be strong through the summer. Everything will recover slowly. Everything's going to stay strong as long as there's not that second wave and, something else extraneous that affects the market that none of us are thinking about right now.
All right, there you go. The latest in terms of trying to gauge the recovery that we're seeing here from Jeff Weiner, Marcum LLP CEO. Appreciate you taking the time to chat with us.
Good seeing you, Zach.
And while we are on the topic of tomorrow's big jobs report, we should note that tomorrow we will start coverage here on Yahoo Finance a little bit earlier than usual to bring you that coverage here on Yahoo Finance. Will begin at 8:30 a.m. Eastern time tomorrow. You will not want to miss that. We'll be digging through the report and bringing you the headlines as soon as they cross. Meantime, as we noted, we've been continuing to track cases here in the U.S. and around the world in regards to the coronavirus pandemic. People standing ready to watch for a much feared second wave of cases. As we've been monitoring them across the globe, it might be letting up in some countries, including here in the U.S., but a total number of cases is now growing faster than ever worldwide. When you dig into those numbers, more than 100,000 new reported cases each day. And now the number of countries reporting a rise in coronavirus cases over the past 2 weeks is sitting at double the amount of countries reporting a decline, according to the New York Times database tracker. For more on that, though, I want to bring on our next guest. That would be Dr. Brian Garibaldi, Johns Hopkins Biocontainment Unit Medical Director, joins us now. And Dr. Garibaldi, when we look at that, we'll get into the international data in a second, but I want to start with the tick higher we're seeing play out right now in Florida, because yesterday that state recorded its largest number of new cases since mid-April, a jump of more than 1,300 cases. So what do you make of that and the potential fears of a second wave?
Well, hey, Zach, thanks for having me back on. I think we have to be careful with the day-to-day changes in numbers because there's lots of different things that affect when positive tests are reported. And so, I do think we have to be mindful of these trends and just recognize that there are, about a third of the country is on the rise, about a third of the country is kind of staying flat, and about a third of the country, thankfully, is coming down. And I really think we have to think about the country not as just one nation in terms of the infection, but really looking at these local trends. And so I think we just have to keep a close eye on particularly the states that had opened up a little bit earlier and make sure that this is not the beginning of a rise or another bump in infections in Florida and other states that are on the rise.
Yeah, and when we talk about responding to those ticks higher in cases, it's interesting because we got the update from the CDC director, Robert Redfield, today telling House lawmakers that still the CDC is underprepared. The U.S. is underprepared for pandemic threats. So if that's the case, it doesn't sound reassuring that we would be in a good position to respond to a rise in cases here. What's your take in terms of maybe how we haven't been doing as much as we could have been in the interim months after we saw cases start to decline in terms of preparing for what could come?
Yeah, I think we have to be really careful to not, take our foot off the gas pedal in areas that are on the way down. Even in New York, which was our hardest hit area of the country, it's estimated from some studies that only 10 to 15% of the population was actually had the virus. And so, it won't take much to rekindle a spark in a densely populated area as we start opening up. And so I think we really need to build that local capacity to recognize where there might be new hotspots and to really be flexible in terms of how we approach opening things like businesses, but also, outdoor activities for the summer, community organizations that are organizing summer camps. And obviously the big question in everyone's mind is what do we do with school in the fall? And I think that really is going to have to be a local decision based on what's happening in the community and whether or not it's appropriate to go back to full classes the way that we had, or if there's a staged approach. Or, I'm on the committee for my kids' school to help advise opening, and we're still struggling with, what are the metrics we're going to use to decide how to bring back students? Who do we prioritize? If it's the lower students that come back earlier because they benefit more probably from in-person learning. I think those are some big questions that the entire country is faced with right now.
Yeah, I wanted to ask you about that because Dr. Anthony Fauci was asked about that in an interview with CNN yesterday. We're commenting on exactly that, when we should be opening schools here in the U.S., thinking about what the timeline looks like. He seemed to be, conceding the fact that there are risks anytime you think about opening up a school come the fall. But he did say that he would be supportive of schools being able to open up in the fall. So what really are those fears that you're discussing in your own local level here when we think about how you would measure it, what it could look like if you do see a tick higher in cases? Obviously, it would be, I think, a lot more destructive to then have to shut schools down again. So how is that path forming as you try and monitor it?
Well, I think we need to keep our eyes open to what's happening in other countries who have started opening schools earlier because of their different school seasons. It would be surprising if even though children aren't as affected severely from this virus as adults, we've seen these inflammatory states that can happen to children, but that's very rare. If this virus follows other respiratory virus patterns, children will probably be an important vector for transmission. And so I think we need to be mindful not just of the children's safety, but also of teachers and families who are sending children to school who may have at-risk patient or at-risk family members at home or themselves be at higher risk from the disease. So I think it really has to be a local community-based decision based on what's happening in your community. Is it safe to bring the children back, or is there some, can you do outdoor classes? Can you do a combination hybrid telecommuting for some students and then rotate who's on campus? I think there's lots of ways to approach it. And I think we're in sort of no data land right now because this has never really happened before. And I think we have to just pay attention to what other people are doing and learn from that experience.
Yeah, and you mentioned other countries as well. I'd be remiss just lastly if we didn't note the uptick in cases right now experienced in Latin America. We're seeing cases balloon in Brazil. Just on Tuesday, reported its highest number of deaths due to the coronavirus since the outbreak began. We're seeing a similar deteriorating situation in Peru as well. How alarming is that, though, when you think about how the epicenter continues to shift around the globe and how that could complicate mitigating what could happen down the road if this is to spread again? And maybe, again, I hate to keep hitting the point, but lead to a second wave.
Well, I think it's really important to pay attention to what's happening in other countries because this is a global phenomenon, right? If there are hotspots of this virus in the world, until there's a vaccine, that will always represent the possibility of creating further hotspots in other nations and spreading back to the United States. So I think this is a global problem, even though we're talking about it in terms of the local and community responses that we have to do on a local level in the United States. This is a global problem, and I think we need to continue to be at the forefront of helping to drive the science to understand this, but also to help support other countries who don't have the robust infrastructure that we have. And even with the infrastructure that we have, we've seen how we've become the epicenter of the world for this virus with a majority of the deaths and a majority of the cases. So I think we're all worried about what's going to happen with countries that don't have that infrastructure in place.
Yeah, and we're seeing that play out now in Latin America. But Dr. Brian Garibaldi, Johns Hopkins Biocontainment Unit Medical Director, appreciate you taking the time as always.
Thanks for having me on. Stay safe, everyone.
You too. We're going to take a quick break here. On the other side, digging into the way that not only schools but offices are ramping up to reopen, what the new problems are in that regard and what the new luxuries might be on the other side as well. Stay with us. Much more coming your way right after this. Welcome back to live coverage here on Yahoo Finance. Right now, we have the S&P off by about 0.5%, breaking that 4-day winning streak for the time being. We'll bring you updates as we get them. In the meantime, we've been examining the way that offices are prepping to reopen or potentially sticking with working from home through the coronavirus pandemic after millions of Americans have lost their jobs. And those that do, we're going to have to work differently, probably for an extended period of time. And for more on that, I want to bring on Yahoo Finance's Akiko Fujita, who has more in the shift happening at workplaces and homes across the country. Akiko?
Yeah, Zach, we've talked so much about this permanent shift that we're likely to see with more and more workers working from home. The reality is about half of the companies are looking at a more fragmented workplace. So a little bit of visits to the office, some work from home as well. We got a sneak peek inside of one of those offices, Cushman & Wakefield, putting together a template for other companies to follow.
So the first thing when they step out of the lift is they're going to notice that the doors are open. So they're not going to have to touch a door to come in.
Americans returning to work face a dramatically new office experience.
You've got 3 chairs here. How many did you have before?
We would have had 6 before.
There's less furniture here and fewer desks.
What we do down these line of workstations is we take out every other workstation and then people will be able to maintain that safe distance.
And there's plenty of reminders to keep that distance, as we learned firsthand. Cushman & Wakefield calls this the 6 feet office.
2 of the areas we're really focused on is maintaining that social distance while we're in the office, also just reducing the number of touch points.
Employees here use keys instead of their fingers. They stand in marked corners. They're required to walk clockwise around the office to avoid congestion.
The overarching approach has been, how do we create these safe environments with a limited amount of time and a limited amount of capital to make them accessible for everybody?
Other offices are turning to tech, installing thermal imaging cameras to check temperatures and air filtration systems. WeWork expects employees to stay closer to home now. It's launching software to help clients find locations nearby.
This technology that we're putting that we put together and we're rolling it out gives enterprise companies the ability to map out their people to our various locations. If you have 4,000 people, they don't all have to be in 1 or 2 locations.
What does that mean from a business standpoint from WeWork? On the one hand, you're saying there's an opportunity of more businesses coming in, but just as equally, you've got to have a lot of businesses that may not have the same footprint they did pre-COVID.
Net, we have greater demand today than the members that we've lost. Enterprise is about 46% of our business today. We expect that number to grow to about 70 to 75% of our revenue over the next 12 months.
But companies like Facebook and Twitter see remote work as more permanent. That's altering the definition of the office.
Do you think we're seeing a permanent shift in the way we actually look at the workplace?
I absolutely think we're never going back to exactly where we were. And in many ways, that's a good thing. I think there's going to be much more of a hybrid future of working from offices and working remote.
Huffington expects that to lead to a shakeup of C-suite roles. Mental health now a priority with employees working in isolation.
Who takes on that role of ensuring that part of the equation?
The heads of HR departments are now the most important executive in the company other than the CEO. The health and wellness of employees has now been moved to the front burner.
The changes giving new meaning to business as usual, with our workplace changed forever.
Now, one of the interesting things that we heard over and over throughout our reporting is that this notion of headquarters, having a company headquarters where everybody commutes to, is likely not going to return, at least in the medium term, because people aren't going to want to get on trains to commute into work in places like Midtown here. So that's one significant change we're likely to see. And even when people return to the office, Cushman & Wakefield says expect about 25% capacity. So you'll see a lot of rotation, some employees coming in on Monday and Wednesday, others coming in on Tuesday and Thursday to keep or to prevent that congestion in the office.
Yeah, and so much for that destruction of the cubicle, the shift to community workplaces too. Another thing that I'm not sure will hold up necessarily for the long term, but Akiko Fujita, appreciate you bringing us that. We should also note another special report in terms of our coverage here on the climate crisis That will be coming your way tomorrow right here on Yahoo Finance at 4:30 p.m. Eastern Time. You won't want to miss that one either. We're going to take a quick break here on Yahoo Finance. On the other side, Las Vegas is back after 78 days of being dark. What we're seeing on the front lines as casinos reopen and how long that could mean Las Vegas might have to wait before we see a full return to normal. Much more on that right after this. Welcome back to live coverage here on Yahoo Finance. Right now, stocks still in the red across the board. When you look at the major indices, the S&P off by about 0.5% for the time being. Financials, industrials, materials still the only sectors in the green. We'll bring you updates on that front as we get them. But the big news this week, Las Vegas is back after 78 days of being dark. Casinos there opening again, offering the first chance for a lot of people to get back out there and enjoy the sights of the Strip, as well as some gambling action. But does that mean that a full return is on the horizon? For more on that, we're bringing on our next guest. Keith Foley is Moody's Senior VP and Lead Gaming Analyst, and he joins us now on the phone. And Keith, what are we seeing here? What's the promise offered by this return here on day one of action? What are you seeing, and what does it mean for the recovery?
Well, it's nice that these facilities are starting to open up. I think there's some pent-up demand, but I think it's going to be a long haul before we really start seeing some heavy-duty activity. So this is going to be very interesting because this will be a test to some degree for what's going to happen throughout the United States in terms of casinos. You know, casinos basically rely on a lot of people socializing and being in an enclosed space. So what's happening today in the environment is pretty much the opposite of that. I think we're going to see people waiting on lines to gamble. I don't think they're going to be at full capacity because a lot of the machines and other facilities have been limited to adhere to some state guidelines. But I would expect that people are going to start showing up. The real question, though, is will they be spending?
Yeah, and I guess that is a factor to be considered in the equation of kind of a different fronts you can look at it is how many people are actually going to be coming back, and then also how much will they be spending. But that's kind of a function of what's going to be available for them to spend on. We've seen gambling floors come back with limited occupancy there, about 50% rates of what they used to be. Some shows not necessarily coming back in the opening weekend. Clubs. I mean, what is the revenue breakdown that investors should be considering when we're talking about reopening and how different it looks from what we saw last year?
Sure. When you're talking about Las Vegas, you're probably talking about 50% of the revenue coming from traditional gaming activities, including tables and slots. The remainder coming from restaurants and other non-gaming amenities. A little bit different on the regional side for the regional casinos, which we think will probably ramp up faster than Las Vegas, that being one of the reasons. But if you're running at about 50% capacity of slots at this time, and what we're hearing, I can't verify this, but what we're hearing is the win per units in some of the facilities, some of the Native American facilities that have opened up, if that's any indication, you're probably going to have each individual machine perform pretty well because of the limit in the supply of those machines and the people waiting to play them. I don't know how long that will last, but I would expect that revenues are not going to be near the quote 50% of what a casino normally gets. I would expect it's going to be well below that, and that the cash flow from that is also going to be a lot lower than it's been in the past. It's going to be a long, hard ride.
Yeah, we had an analyst on yesterday estimating it'll probably take until 2023 before you start to see things return to normal. But it's also worth noting, as he pointed out, that Las Vegas is not necessarily the entire cake for a lot of these gaming companies. When you look at Macau and the way that Las Vegas Sands and Wynn have expanded over there, you can look at Boston with Wynn's expansion with the Wynn Encore there. I mean, how I guess has Vegas become less important to some of these names, and how important should it still be when we're thinking about the overall gaming economy?
Well, I think it's a big part of gaming in the U.S., so I think it's a big part of the economy, particularly for Nevada. Interesting about companies like Wynn and Las Vegas Sands, in terms of the Las Vegas opening, they've probably learned a lot from what's been happening over in China. Most of their revenue and cash flow comes from China at this point. Las Vegas is a very, very small part of what they do, and that's been the case for a number of years. But that really doesn't diminish the importance of how well Las Vegas does in the United States here, because it will be a leading indicator to some degree of what will happen across the region. Not entirely, but it will be a very, very good leading indicator of what's going to happen. One of the challenges, though, is in terms of what we'll find out in terms of what's exactly spent at these casinos. You may not be aware of this, but most of the states do report publicly the amount of gaming revenue that they receive, but it probably comes out close to a month after the actual activity. So we won't know for a little bit of how well it's doing. But Las Vegas, I don't think Las Vegas is ever going to be not a major consideration when it comes to gaming in the United States. I don't think, it might decline a bit for a long time and take a while to get up, but it's been an excellent place for businesses to do conventions for a lot of midweek traffic, and I think at some point that'll still be the case.
Yeah, especially considering the decline of Atlantic City that we've talked about here on the show as well. But Barry Friedman, Barry Friedman's going to be coming up in a little bit. Keith, want to appreciate you taking the time to chat with us about Las Vegas on day one of reopening. Exciting times. Keith Foley, Moody's Senior VP and leading gaming analyst. Appreciate it.
Thank you, Zach.
All right, we're going to take a quick break here. As I noted, shifting topics completely. We're going to be digging into the way that the response has played out here across the country as protesters continue. Going to dig into two different scenarios there on the front of military spending and the way equipment has been repurposed for police forces, as well as now policing reform being pressed at the highest levels of political discourse, including Joe Biden coming out in support of that. Much more on those fronts coming up after the break. Welcome back to live coverage here on Yahoo Finance. Right now, we still have stocks in the red. The S&P off by about 0.5%, breaking its 4-day winning streak for the time being. We'll keep you up to date on that front. But meantime, we've been continuing to track protests around the country following the death of George Floyd in Minneapolis. And if the scenes of military equipment on city streets playing out seem very reminiscent of Ferguson back in 2014, that might be by design. The Pentagon's so-called 1033 program has been around since about the 90s and allows military equipment to be redistributed on the cheap from the military to police forces around the country. And after Ferguson, President Barack Obama attempted to curtail that program, which has distributed billions of dollars worth of equipment to police. But interestingly, under the Trump administration, the program has received renewed support. And we have continued to see the stream of that equipment to police forces around the country. So joining us now for more on that program and how military equipment continues to get passed to police officers around the U.S. is Walter Olson. He is a senior fellow at libertarian think tank, the Cato Institute. And Mr. Olson, appreciate you taking the time to chat with us. I guess first, I just wanted to chat about the way that it might be enticing for local officials to accept this equipment, because anytime you offer anything at a discount, people are going to jump at the opportunity to take it. But what are the implications of actually giving this equipment to police forces, and how does that shift maybe the way they police in communities across the country?
If you offer people free or cheap stuff, they will take it. And this is typically stuff that they weren't buying on their own. They wouldn't consider it a budget priority. And once you've got the gear, the temptation is to use it rather than letting it just sit there and have to maintain it. And we have seen the results. We've seen armored vehicles in situations where they were probably not needed. We've seen grenade launchers, helicopters that turn protest scenes into something closer to a war zone.
Yeah, and I mean, that is, you say grenade launchers, and a lot of people out there might not actually believe that, but that was the case. And you look at the 2017 report that President Obama ordered into all of this, and we think about what happened. He ordered the report to be done, the research to be done, and you look at the number of things that were distributed, 138 grenade launchers and 126 tracked armored vehicles getting distributed there. It is noteworthy when you think about that equipment. But what I guess if that's been the trend for so long and we had seen efforts to curtail it, what has it been like when we think about both parties maybe trying to address that issue and fixing that?
Well, for a long time, there was bipartisan support for these programs because local police departments liked the free stuff and they have a powerful voice. But more recently, there has been this partisan divide in which Obama and the Democrats have grown skeptical, have been listening to people who say that this changes the dynamic. It changes it from a kind of neighbors facing off against neighbors into something more like, these are strangers. We can't tell who they are because they're behind uniforms, they're RoboCop uniforms, and they are more like, and this is charged language, but more like an occupying army. And we never want that to be the relationship between the military and the populace, or between police and the populace in the United States. That's never been what America has aspired to be like.
Yeah, and you raise that aspect of the military force. We did hear, interestingly, from former Defense Secretary Jim Mattis weighing in on this issue, highlighting exactly what you're talking about. I just want to read what he said there. Militarizing our response, as we witnessed in Washington, D.C., sets up a false conflict between the military and civilian society, is what he said. It erodes the moral ground that ensures a trusted bond between men and women in uniform and the society they are sworn to protect and of which they themselves are a part. Walter, when you hear that from a man who worked closely with President Trump, and you see what kind of force President Trump is advocating for here, and then you add in the element of all of this military equipment, how do you break that down in terms of a man who's normally quiet, weighing in and finally taking the stance to say, look, this is a problem?
I hope everyone listens to what General Mattis said, because I don't think anyone could have put it better or with more credibility. And, we've seen violence and disorder. We've seen crowd scenes spin out of control. And sometimes the government has to respond with force. If they are burning down a police precinct, as in Minneapolis, yes, they've got to use a lot of force. So many other times we've seen the tension diffused because the police got out there and talked to the demonstrators, and they began realizing that they agreed on some things and that this was one community together. It's harder to do that when you're militarized, and that's one of the big prices we pay.
Yeah, and as you noted, I mean, there are points made by the other side advocating for this equipment. You can talk about military helmets that have saved police officers' lives before, but there are the separate issues that we've been discussing here in terms of the overall implications of actually using that equipment for maybe more nefarious reasons. But I want to appreciate the fact that you chatted with us on it. Walter Olson, Cato Institute Senior Fellow. Appreciate you taking the time.
Thank you.
We're going to take a quick break here on Yahoo Finance. On the other side, digging into the other issues at hand here in regards to police reform, why Joe Biden is calling for some major changes, including banning the use of chokeholds by police. Much more on that and the efforts already underway by local police forces across the country to try and change things even ahead of potential changes at the national level. We'll discuss that with an expert from NYU's Policing Project right after this. Welcome back to live coverage here on Yahoo Finance. As protesters continue to call for police reform following the death of George Floyd in police custody in Minneapolis, real reform is gaining support at the highest level of politics. Former Vice President Joe Biden made it a pillar of his speech earlier this week to include specific mention to implement changes that may have shown improvements to policing on a local level, including banning police chokeholds and bolstering accountability over the use of force. Here's what he had to say in that speech.
I call on the Congress to act this month on measures that will be the first step in this direction, starting with real police reform. Congressman Jeffries has a bill to outlaw chokeholds. Congress should put it on the president's desk in the next few days. There are other measures to stop transferring weapons of war to police forces, improve oversight and accountability, to create a model use of force standard. That also should be made law this month. No more excuses, no delays.
Of course, some local police departments haven't waited for national action, as the chief of police in Camden, New Jersey, shared with us on the show earlier this week. They credited those reforms and others in helping them get to the point of marching hand in hand with Black Lives Matter protesters and avoiding the same police brutality that has played out at other demonstrations around the country, as well as the issues that have plagued other police departments around the country. And joining us now for more on that is the man who helped Camden institute those changes years ago, the faculty director at NYU Law's policing project, Barry Friedman, joins us now. And Professor Friedman, I mean, when we look at this, obviously there are a few things right now that advocates are pushing for, and they're seemingly simple changes, but so impactful when you think about 3 officers failing to take a 4th off as he holds his knee on another human for 8 minutes. But one of those changes, specifically that duty to intervene, would have made it a part of their training to make sure that they did step in to prevent that. So how has it changed the police forces that you've worked with that have instituted seemingly simple changes so far?
Good to see you, Zach. There's big debate in the country a few years ago about how use of force should be regulated. And the consensus view, even among those people in law enforcement who were most reluctant, was that a lot of the things you've mentioned needed to happen. And then there were standards even above that. So in Camden, we sort of went and said, what are the best elements of everything? And let's put them in one policy. And I think having done that and then vetted it with the ACLU and the Fraternal Order of Police and the community has made a real big difference in the way everybody sees that police department.
Yeah, no, right now, there does seem to be a push, at least in the way of actually capitalizing on the effort right now, the anger being shown across the country to actually bring a lot of attention to the police reform issues that I know you've worked on for years. Specifically, one of those groups right now is highlighting it with the hashtag 8Can'tWait, that's been gaining attention. Even Oprah right now giving her support for Campaign Zero, the group behind that. But they highlight a few different things, including what we heard Joe Biden just talking about in terms of banning chokeholds, requiring de-escalation, trying to prevent the use of force. What have you seen in the statistics that come from instituting those changes?
I think you see a lot less use of force and a lot fewer injuries when you institute those changes. And I don't think those changes are rocket science. I mean, if you stop and think about it, there's been resistance in policing circles, but most all of them, including finding ways to de-escalate situations, to exhaust other ways that you can resolve the situation without using force as a last resort, caring about the sanctity of life, not shooting at moving vehicles. There's a lot of, because other people get hurt. A lot of this is not rocket science, and it also doesn't endanger officers if they're properly trained. I think it's the right way to go, and we actually think every state should have a law that mandates this.
If it's not rocket science, and it does seem like a lot of people are in agreement now, why has it taken so long for that agreement to be reached, and what has been the pushback maybe from police groups or just from general politicians saying that this wasn't something that was needed until 2020?
Well, back in the 1980s, the Supreme Court said that the only thing that you have to do to meet the constitutional requirements is use force in an objectively reasonable way at the moment that you use it. So even though you could have avoided the situation 20 minutes earlier by not bursting into a house, doesn't matter. So it's an incredibly favorable standard for the police, and so you can see why they like it. It gives them an enormous amount of leeway. You'd like to know you can come on the air and do anything you want and never have anybody criticize you for it. So you get that huge favoring of it by the police and then opposition by police unions and police to changing the standards.
And when you talk about those standards, I mean, obviously right now, Minneapolis has been the case that a lot of people have been applying these changes to. When you look specifically at that example and the way that the officers who stood by in that example here have now been charged, in your experience, I guess the question becomes, sure, those charges have been brought, but under the last set of rules here, what is your belief in how that goes forward and actually getting those charges prosecuted and what that could look like based on the way that these old rules were in place?
Yeah, at the Policing Project, we refer to having these rules in place as front-end accountability as opposed to back-end, which is criminal prosecutions and trying to punish people after the fact. And the lesson you learn is you'll have a much better chance on the back end if you've got a strong front end. It's only logical. If you're real clear about what the rules are, then it's easier to discipline them for violating the rules. If you're mushy on what the rules are, it's harder to discipline them for that. And so, part of the reason the prosecutions are being brought is because some of what they did is prohibited in Minneapolis Police Department's policies. But that policy also is built on a Supreme Court case, Graham versus Connor, which gives a lot of discretion. And that combination is going to complicate things, I think, in Minneapolis.
And I guess lastly, though, we're seeing a lot of the efforts now to apply some of these things nationally. What are the hopes and fears of something like that happening versus going the local route and getting some of these things instituted on a much more local approach?
Well, I think every state should have a law. It's just crazy to think that, the folks in the police department in one town can decide they're going to use force in a particular way, and then in the town next door, they're going to use it differently. It's tricky at the federal level because of limitations of the federal constitution. You either have to entice the states to do that, which is how they changed their drinking laws by threatening to withhold a big chunk of federal funds, or you have to use the 14th Amendment, which requires you to prove that there's a pervasive problem all over the country. Now, I think you can prove that with use of force, but that would be a serious debate in Congress. And so ought to happen certainly should happen at the local level, ought to happen at the state level, probably can happen at the federal level, but it's a little bit of a harder push.
All right, we'll see what happens as that push continues with protests across the country. With Barry Friedman, Policing Project Faculty Director, appreciate you chatting with us.
Good talking, Zach.
All right, we're going to take a quick break here. On the other side, the new push to extend the rules for small businesses using PPP funds passing the Senate, heading to President Trump's desk. We'll chat that after the break. Welcome back. Republicans and Democrats came together to pass changes to the Small Business Administration's Paycheck Protection Program, expanding the timeline for small businesses to use those grants provided by the government. And now those fixes await President Trump's signature. And for more on that and the changes, I want to get to Yahoo Finance's Brian Chung for more details. Brian?
Well, Zach, late last night, the Senate did pass the House bill that actually proposes some more forgiveness for that Paycheck Protection Program, which was designed to keep a lot of those small businesses in business through the COVID-19 crisis, because the original program really only structured everything through the end of June. This revision that still needs to be signed by the president, we don't have timing yet, would generally expand the amount of time that these companies actually have to work through their PPP money. Originally, they only had 8 weeks to spend the money. That'll be expanded now to 24 weeks. And they were originally limited to using up to 25% of the PPP money on things that are not payroll. This will actually loosen that so that you can actually use up to 40% of the loan for things that are not payroll. Another few things, that's the adjustment for the repayment plan. It'll actually be extending that to 5 years instead of 2 years. And then there's also a rehiring deadline, because keep in mind the PPP was contingent on being able to rehire your employees. Originally, they wanted to see those employees rehired by June 30th, but with a lot of the shutdowns continuing, they've extended that to December 31st. The idea here is really hopefully that this will encourage a lot of borrowers to maybe take on a PPP loan, because there's still $120 billion left in that fund. But of course, we still need to get it signed by the president, and it's not necessarily a perfect proposal. You have the Center of Responsible Lending saying they would have preferred more streamlined forgiveness for small businesses, and then also maybe some data collection on the types of borrowers and the demographics which is not going to be included in this extension, Zach.
Yeah, a lot of that money is still sitting here when a lot of people said that it wouldn't be potentially because of the rule changes that just got passed. And we'll try and monitor how quickly that money goes. But Brian Cheung, appreciate you bringing us that update. That'll do it for us here in the 1 p.m. hour. Stay tuned. We got much more coming your way, as well as an update with the LA Area Chamber of Commerce CEO for more on how Los Angeles is battling the 1-2 punch of COVID-19, as well as continued civil unrest there. Much more coming up after the break. Stay with us.
Welcome to Yahoo Finances, the ticker. I'm Kristen Myers. Checking market action here. All the major indices in the red, actually after a pretty impressive couple of days of being in the green and seeing some pretty strong rallies. The Dow actually just flipped into the red, being buoyed there, I would say, by Boeing, which actually right now is up over 6.5%. Of course, tech-heavy NASDAQ getting slammed right now. Microsoft, Apple, Facebook, all in the red there. Facebook leading that pack lower, down over 1%. Now, we got some slightly pessimistic news today on the jobs front. 1.877 million Americans filed for unemployment benefits last week. Now, that's exceeding estimates of 1.843 million initial jobless claims, again, for last week. I want to remind everyone here that just yesterday we were talking that ADP reported that private payrolls fell by 2.76 million. And that was some good news because the estimates were up over 8 million. So to talk more about jobs and the market, I want to bring in portfolio manager at Tocqueville Asset Management, John Petrides. Hey, John, how are you?
I'm great. How are you?
I'm good. So I promised you that I was going to toss this question to you right at the top. So I have to ask it, John, what is going on? We had a great couple of days and now all the indices in the red.
Well, the good thing that I'm seeing is that the market is off its lows following the jobless claims. You know, unfortunately, people, over 40 million people have lost their jobs in an 11-week period, which is just staggering to think about. And to consider that we're only a couple of percentages down on the S&P 500 for the year is really extraordinary. And it's hard to circle the two. But again, the market is trying to rally a bit here off of these numbers, which is a good thing. You know, the ADP number was a massively wide gap yesterday. You know, expectations were for 9.2 million losses in jobs, and we only had 2.5 million or something like that. Tomorrow we have the BLS, the non-farm payroll numbers. Expectations are for 8 million job losses. So let's see what happens there.
All right. So I want to talk about this rally that we've been seeing. Best rally, one of the best rallies, 50-day rallies. But, just yesterday we were talking about how we are essentially standing at the bottom of the canyon, looking all the way up at the top. What are you expecting then over the next 6 months through to the end of the year?
Yeah, I mean, the market to the upside here is breaking all records on almost every level. We have, a near 40% rally over the past 50 days, something we've never seen ever since the data has been tracked for the stock market. So truly unprecedented. And it's really been driven by three things. The first has been the massive quantitative easing we've seen by the Federal Reserve. And not just on the Fed side, you've seen the ECB today with Christine Lagarde acknowledging more stimulus for the economy. On the fiscal end, you saw the Bank of Japan about a week ago did another stimulus package that equaled to 40% of Japan's GDP. So really, central bank and government authorities are throwing the kitchen sink at this. And what we're trying to do here is build a bridge until we get closer to a vaccine. And you have the entire global healthcare system focused on one thing, and that's trying to find some treatment and or solution to COVID-19. And all of the quantitative easing here is really to buy time. And, we would expect that you're kind of seeing this grind higher. There are two risks to the downside to the market here. One is the market has really forgotten about the upcoming presidential elections in November, right? The outcome of to that. And two, if the second wave, when it comes back, if it's as severe as we saw this past March and April, the market is not pricing that in again. So, which could be a possibility because, again, we're in uncharted waters here. We've never seen this before. And if that comes through before the vaccine hits the masses, stocks are going down.
All right. So to pull out your crystal ball before we let you go, what are you expecting tomorrow? Again, that unemployment number is supposed to hit 19.5%, at least analysts are expecting 8 million job losses. What are you seeing for tomorrow?
Yeah, I'm going to punt and say I'm going to agree with the analysts because, the gaps with the average estimates, because the gap is so wide to the expected outcomes that really trying to forecast what economic data is right now is really like throwing darts. The good thing is, and part of the reason why the stock market is moving higher is, the economy went to zero. And now the rate of change is better than zero. And that's where we're going. And the sooner that we get closer to ending social distancing, the more comfortable we get to opening the economy across the entire country, the more that people could put money to work. And that's going to help drive the stock market higher. And hopefully that, we see not only the worst of the economic downside now, but all of the data gets revised upward. One last point to make, don't sleep on the auto sales numbers yesterday. Seasonally annual adjusted car sales yesterday was about 2.2 million. That was about 800,000 greater than expected. And that's a big deal. And that's why you're seeing this rally in cyclicals, is because people are putting money to work, and a car is a big ticket item. So that was very encouraging sign.
All right, John Petrides, Tocqueville Asset Management. Thanks so much.
Thanks for having me on.
And I want to remind everyone that tomorrow morning, starting at 8:30 a.m., you can tune in for Yahoo Finance's Jobs Report Friday special coverage. That's tomorrow. Well, as coronavirus continues to impact the United States, worldwide cases are growing faster than ever. And here at home, Florida actually had the largest number of cases in 6 weeks. So to chat more about this, we're joined now by Dr. Lloyd Minor, Dean at Stanford Medicine. Hi, Doctor. How are you?
I'm well. How are you, Kristen? Good to see you.
I'm good, thanks. So, Doctor, I want to ask you why we are seeing this trending positive case numbers going upward. It seems like we had such good news with that case number coming down over the last several weeks.
I think there could be several reasons that we're seeing an increase in cases in some areas. We're now in that period after Memorial Day when we would expect to see new cases from exposures during Memorial Day. We know that the incubation period, the time from exposure to development of symptoms for this virus, is in the neighborhood typically of 7 to 14 days. So we're in that time window now. And the activity of people during Memorial Day in Florida and other places may account for some of that increase in cases. We still need to be vigilant, even as many locations are releasing some of the shelter-in-place orders. We still need to be vigilant about observing social distancing, about wearing masks in public places when we're going to be around other people, and taking the precautions that we should always be doing, such as hand washing and other precautions.
Do you think that perhaps reopening, some of these states reopening too soon might be contributing to these numbers? Could the protests start impacting those numbers in the days and weeks coming up?
Well, those are all concerns and things that we're going to need to watch very carefully. Now, we do have a lot more testing available today than we did at the beginning of the pandemic in the United States back 3 months ago. We still need more testing, but we have in most regions of the United States today far more testing so that people, when they do experience symptoms, they can be rapidly tested. And if they're positive, they can quarantine at home. Hopefully they won't need hospitalization and their contacts can be traced. That's what it's going to take to really contain this epidemic until we get a vaccine.
So doctor, you're, as I had mentioned in the intro, you're the dean of the medical school. I'm interested to know and curious to know how you guys are training essentially the new crop of doctors as we see, universities across the US, but also around the world essentially closed.
Yes. For our preclinical studies, that is the studies that are done in the classroom or in laboratories, we moved to online training experiences back early in March. We haven't had any in-person gatherings since then. And that's worked reasonably well because of media such as what we're using to communicate today. For our clinical instruction in the hospitals and the clinics, we resumed last week, getting our students back into clinics, and we'll be back up full speed in terms of clinical rotations by the end of this month. I think that certainly we want to make sure we continue to graduate physicians and physicians' assistants and other trainees on time. And so we've had to make some adjustments in the curriculum, as I think many of our peer institutions have. But I don't think any students are going to be delayed in their graduation, nor is their training in the long term going to be adversely affected.
Now, in California, Los Angeles was pretty hard hit by the virus. The Bay Area, not as badly affected. One, why? And is there any lessons that could be learned there from your area that could be passed on to other cities or states?
Yes, I think there's several reasons why the Bay Area was not as severely affected. First, even before the counties in the Bay Area issued a shelter-in-place order, a full week before that, most of the tech firms had sent their employees home to work from home. And then the counties did move forward with a shelter-in-place order around March 13th, and the state followed very closely thereafter. And that limited the transmission of the virus. Also, we were able to do testing in this area before many other places were. We here at Stanford were one of the first to get approval through emergency use authorization from the FDA for our diagnostic test for the virus, the so-called RT-PCR. And during much of March, we were doing the majority of the testing here in the Bay Area. We were able to get results quickly back to patients and healthcare providers about who was infected, and then those patients could receive treatment and also quarantine and have their contacts traced. Another benefit actually in the Bay Area, or another reason why we perhaps didn't have as large of a surge as many places, is that we have relatively poor mass transit in the Bay Area. And a lot of the exposures, I think, that tragically happened, and the reason for the huge number of cases and the surge in New York could in some way be related to the mass transit systems, which ordinarily are a benefit, but in this particular case served as a mechanism for the spread of the virus.
That is the first, I guess, good news about not having good mass transit. Last question here quickly for you, Doctor. So we've talked a lot about racial inequity, and I know that COVID-19 exposed a lot of those. I'm wondering specifically if the university is doing anything to improve health or health access to minorities in your area.
Yes, we have another number of partnerships and collaborations. I mentioned the testing that we continue to do, and we rolled out early and made it available to healthcare delivery systems around our area. We also have a number of partnerships and affiliations with communities that are underserved. And we have a lot of scholarship going on here related to health inequities. As you very correctly pointed out, COVID-19 has underscored the fact that underserved communities, communities of color, are disproportionately affected by this disease and by so many other diseases. And it's underscored the fact that the social, behavioral, racial, environmental determinants of health account for the bulk of healthcare outcomes and of healthcare. And that's something we all need to focus a lot more attention on in the future than we have in the past.
All right, we'll have to leave that there. Dr. Lloyd Minor, Dean at Stanford Medicine, thanks so much for your time.
Thank you.
And coming up, we are going to stay in California and look at how in Los Angeles, businesses have been impacted by the protests. Welcome back to Yahoo Finance. Checking market action here. The S&P 500 and the NASDAQ now in the red. The Dow has actually flipped into the green again, probably boosted there. Well, I know it's boosted there heavily by Boeing, up now over 6.28%. So there's the Dow from Boeing. Now, keeping our conversation inside of California. Protests and looting have badly impacted businesses in Los Angeles that were already struggling after the coronavirus. And for that, for more details, we have Melody Hom. Hey, Melody, great to see you.
Yeah, Kristen, and of course, the coronavirus is an ongoing pandemic. It is far from over. And Los Angeles, as you mentioned in your previous interview, has been a hotbed for new cases and hospitalizations. So just the looting that happened on Saturday night, incited by initially peaceful protests, and then these bad actors, anarchists, as one small business owner told me on the phone just now, have really ravaged businesses. Just thinking about the larger companies that were affected, Nordstrom, of course, Apple, a lot of these companies in the Grove, a popular shopping center, were looted, were vandalized. But I think being less talked about are the small businesses that were still closed on Saturday because of the coronavirus. I spoke with one vintage shop owner who has a shop on La Brea, and many of the stores on that street in Mid-City were actually looted as well. She said about $50,000 to $60,000 worth of goods were stolen, and it was like an organized crime ring where there was one car that showed up right outside of the store. One person quickly went in with a sack, and then following right after was another car. I've heard it being described almost as a McDonald's drive-through sort of operation. So just thinking about how these small businesses will recover from this guttural punch, not only from COVID, but also the looting crisis, is something that people are still figuring out. The kind of emotion that we're hearing from these small business owners too is they don't even know if they can file a police report because police are too busy at the protests. Some are thinking of escalating it to the FBI, but ultimately many of them are kind of echoing this experience that perhaps they don't think that any of these legal officers or officials or government members will be able to help them in the long run.
All right, well, Melody, stick around because we want to continue this conversation now with Maria Salinas. She's the CEO and president of the Los Angeles Area Chamber of Commerce. Maria, thank you so much for joining us. So we just heard from Melody about what some of the business owners are seeing there. Does that match with broadly what you're hearing from business owners in the region? Maria, you might be muted right now.
My apologies. I think I had hit that.
No worries. That's life and with doing it like this.
No, her comments definitely align with what we've been seeing both on the ground and even for the last couple of weeks, just in working with our small business owners and preparing for a reopening. And this past weekend was supposed to be a reopening weekend in Los Angeles. Several small businesses had heeded all the warnings and the emergency orders of staying closed. And we've been working with our public agencies and our county to ensure that our small businesses had the right guidance and compliance requirements that were needed in order for them to open. So there was definitely a lot of activity going on in the weeks leading up to this past week. What we've seen is a lot of destruction of small businesses, of a lot of mom and pop shops that have seen destruction that will really hold them back from reopening in a very long period of time, if ever. So definitely a lot of emotions on the streets of Los Angeles. It started off as a peaceful protest, but I think like Melody described it, there was a few characters that took from the important message that the protesters were wanting to speak about, which we absolutely support.
Maria, one of the silver linings over the last few days has been kind of the amplification of trying to support Black-owned businesses. So I've seen lines outside of Black-owned cafes, Black-owned restaurants, Black-owned retail stores. But I imagine, I don't know if you're hearing anything from customers or owners themselves about this sort of uptick in activity.
And we work at the Chamber, we work with a lot of business organizations, a lot of diverse business organizations. I was on a phone call with one of our very close partners is the Greater Los Angeles Area African American Chamber, and really learning what some of the things that they were doing on the ground. And really more importantly, how can we be helpful? We can be a strong partner to ensure that minority-owned businesses, whether they're African American, Latino, whatever the diversity, that we are supportive. We're one community, we're one business community. The important thing to remember here is that when we're talking about our small businesses in Los Angeles, they fuel our economy. They're part of the fabric of our economy. About 93% of our businesses in LA County are small businesses with 100 employees or less. But we have a thriving economy, and it just goes to show you how important those small businesses are to our growth and our economic sustainability.
Maria, yesterday we were chatting with Tom Sullivan from the U.S. Chamber of Commerce, and he was telling us that overwhelmingly, small business owners were more optimistic than they were pessimistic, but that was regional, that optimism. So are you getting that feeling in LA, greater sentiments of optimism than pessimism when looking forward?
I think we work with a broad sector of small businesses, and I think you find the gamut, to be honest with you. There are those small businesses that are more established, that have resources, that have a banker, an accountant that can help them navigate times like this. And then we have several small businesses that might be described as micro enterprises that don't have the same level of access. And so when the PPP loan was made available, for example, they were left out. And so it does, range in terms of the feelings of our small businesses, some that have an infrastructure that can help support them and help them navigate a crisis like this, and others that might feel a loss of hope. And those are the businesses that we as a chamber want to be able that we can embrace them all, and that we can help provide resources and information to ensure that they too can navigate this crisis.
And of course, Maria, a lot of those small businesses were unable to attain PPP for a wide variety of reasons. Are you, as the Chamber of Commerce, kind of pledging to give additional funds to any of these small businesses at this time?
I'll tell you what we're doing. Very early on, when the loan was announced, we knew that if businesses did not have a relationship with a financial institution, that they might come across a barrier to actually being able to apply for that loan. And that's definitely what we found. What we have been doing is working with our local government, with both Los Angeles County and the City of Los Angeles, as they have put out community funds and loan fund programs that could assist and fill in the gap. One of the things that we do at the Chamber is that we provide technical assistance. And when you're talking about applying for a loan of this nature, it's very important that businesses also have that technical expertise that go with that. So we've been partnering with the City of Los Angeles, with the County of Los Angeles, to ensure that we can step up and help fill in when it comes to technical assistance that small businesses need.
All right, Maria Salinas, Los Angeles Area Chamber of Commerce, thanks so much. And of course, Melody, always great to talk to you.
Thank you for having me.
Of course. Well, coming up, we're going to be chatting Facebook and the new moves that they're going to be making. That's next. Welcome back to Yahoo Finances, the ticker. Checking market action. Major indices largely in the red. The Dow is flat right now. Again, buoyed there by Boeing, which is still up over 6.5%. But let's talk Facebook. That stock today, a little bit under pressure, down about 1% and a third of a percentage point there. So to talk about the new move that they're making to label certain news outlets on their platform, I want to bring on our resident tech expert, Dan Howley, with more. Hey, Dan.
Hey, what's going on? Yes, Facebook is now going to label foreign state-controlled media as such. Previously, if you looked at something like Sputnik, RT, which coincidentally, I don't know if you remember this, but they also had a contract with the New York Taxi and Limousine Commission where they would show RT content in the back of cabs. Besides that, China's People Daily, the mouthpiece of the Communist Party for China, from organizations from Iran, etc. They will all now be labeled as state-controlled media, whether or not they're funded or they have the governments are able to flex some kind of editorial control over those organizations. So a lot of times you may see something shared in your timeline or go to those websites themselves or profiles themselves. Now you'll start to see them labeled as such. And then eventually we will see people, if they do share posts from those groups, those individual timeline posts will then have those marking designations as well. So those aren't coming yet, but will in the future. The actual designation as state-controlled media, though, that's coming now.
It's an interesting move that they're making, especially given the inaction that they wanted to take on the president and his post. But I want to quickly get in what Apple is doing, tracking phones, right, that were stolen from protests.
Yeah, so what they're doing is they're using some software that's installed on display devices. I inaccurately said earlier today that it's similar to what we have on our own devices, but this is software that's specific to display devices in Apple stores. And basically what it allows them to do is display a message that says, you know, this is a device is stolen, it's locked, please return to XYZ location. And then it allows the device to be tracked as well so that they can alert authorities about devices that have been stolen from their stores. And it's something that they set up individually. On the personal side, for our own iOS devices, we do have a feature that allows us to track them and lock them entirely, but it's two different types of software, really. But this is a way of saying, Apple saying to looters, look, you got this device, now it's just a fancy paperweight. You can't do anything with it. You can't resell it. You might as well just bring it back now.
All right, and Apple now down more than half of a percentage point. Thanks so much, Dave.
Thank you.
And I want to chat now about Elon Musk. He's been taking a victory lap over the last couple of days after that successful SpaceX launch. But today he's decided to take to Twitter to throw some punches at another company. We have Yahoo Finance's Emily McCormick with more on that.
Hi, Kristen. So we do have Elon Musk tweeting, quote, "It's time to break up Amazon." And this was in apparent response to a screenshot that former New York Times reporter and author Alex Berenson said, indicating that his book, Unreported Truths About COVID-19 and Lockdowns, did not comply with Amazon's guidelines and therefore was not accepted to be offered for sale. Now, Berenson said in his series of original Twitter posts, quote, "Today, Amazon refused to publish my booklet about the coronavirus because it did not comply with their undisclosed guidelines. This is outrageous censorship from a company that has gained hugely from lockdowns and dominates the US book market, especially with stores closed." So Elon Musk then weighed in with his own series of tweets in response, saying, first, "This is insane, Jeff Bezos," and also, "Time to break up Amazon. Monopolies are wrong." Now, Berenson did publish a portion of the text on his personal website. It's not immediately clear what those guidelines were that were not in compliance when it came to that booklet. I did reach out to an Amazon spokesperson for comment, but they were not immediately available to give a statement to this. And this is a developing story here. Kristen?
You gotta love when Elon Musk takes pot shots on Twitter. But Emily, I also want to ask you about American Airlines, because they're actually increasing domestic flights this summer, which surprises me considering how few people are traveling right now.
Well, some green shoots that we're actually seeing here from just the data that we've gotten in May, Kristen, particularly for American. We saw American put out some stats today saying that daily passengers averaged just around 32,000 per day in April, but grew to more than 110,000 by the last week of May. So clearly starting to see a boost in demand here. And that's what we're seeing reflected now in their updated July schedule. So American Airlines said it now plans to fly 55% of its domestic schedule for July versus the same month last year. And that's up from May when it was flying just about 20% of its schedule from 2019. We're also seeing a boost now for the schedule in July over 2019 on the international side as well. So starting to see that boost in demand. It echoes what we've gotten in the TSA numbers as well, seeing the number of daily traveler through point data on the upswing from April to May. And we're not out of the woods yet, of course. We're still down significantly year-on-year basis, but looking on month, at least we're starting to see that travel demand starting to tick up. And taking a look now at American Airlines stock, that is up 38%. So market participants definitely loving at least the new updates we're getting from airlines today. Kristen?
All right. Thanks so much, Emily McCormick. And coming up, we're going to be chatting more about the markets and what to expect in tomorrow's jobs report. Welcome back to Yahoo Finance. Checking the market action right now. Now all three major indices in the red. We've seen the markets essentially give up some of the gains they had made over the last couple of days, especially after getting some disappointing news today on the jobs front ahead of the jobs report tomorrow. And to keep this conversation going on the markets and the jobs report that we're going to be getting tomorrow, I want to bring in Peter Chur, head of macro strategy at Academy Securities. So Peter, I was reading your note a little bit earlier, and you said that you're not going to be going fully short, but that you are strongly in favor of reducing risk positions. So how defensive are you going to try to be going forward?
I would say slightly defensive. I'm really much more about the rotation. I think we've already seen a little bit of rotation where what we were calling, say, the work from home stocks, so the big tech that had done really well and led the way, I think they're going to underperform, and we're going to see some money rotate into the reopening stocks. So you're seeing that a little bit today with commercial real estate doing very well, the financials doing well, even airlines doing well at the expense of some of the big tech. And I think that's just a very natural rotation to expect.
So speaking, about sectors, what sectors are you liking? We've seen, financials doing pretty well today. Energy, real estate has been doing well recently. So what sectors are you liking going forward?
I really like commercial real estate right now, away from some of the big cities, because I think that's still at very depressed prices. I think people are going to miss that. Work from home is probably not the long-term solution. I think we're going to approach something that looks a little bit more like a hub and spoke system or satellite offices. So I do like real estate. Financial should benefit on the back of that. I like autos as well. I think people are kind of misplacing how well autos can do it to the extent that we reopen, we get that rebound going. So that's kind of where I'm focused. And again, pulling away from some of the sectors that have done maybe overly well.
So yesterday I was having a conversation where essentially we were talking about how growth stocks were outperforming value, but is now the time to perhaps make a switch?
Yeah, again, I think now's that time where, listen, Amazon's a phenomenal company. Amazon's done a great, great job, but I don't think everyone's going to continue shopping purely from home. And I think other companies are going to try and compete with them. So I think you want to see everyone piled into that. And I think a little bit of this has really been weirdly driven by the bears. I think people were very bearish and they got stopped out of being bearish. So what do? They bought some big tech and they shorted other stuff. So I think you have to find out, where are the bears hiding? And the bears are still hiding in these others, and they're kind of long in tech. So I think that rotation continues to occur, and market's going to be a bit neutral. One of the things I look at a lot that I think is very, very interesting is if you look at the equal weighted S&P, there's a ticker for that. It's RSP versus the market cap weighted, which is SPY. There's been a huge divergence. So the big tech has been really leading the way. I think that's rational given what we saw, but we should see that compress back down.
I'm wondering what you're expecting out of the recovery. We've been talking about how we are at the bottom of the canyon staring up at the mountain. What do you think that climb is going to look like?
So I think it's actually going to look pretty decent. Maybe not quite a V, but close. My base case has been, right now we've lost, say, about 30 out of 100 jobs. So one thing that I think people aren't paying enough attention to, those 30 jobs are better protected than they were even during the financial crisis. There's a lot more government money going to their employers, to the people who lost their jobs. I think we get about 20 of those jobs back through the reopening. I agree with your earlier guest, too. I think we're seeing progress in how we deal with COVID. I think we've isolated certain problem areas like the nursing home and long-term care facilities, and we will do better going forward in dealing with the COVID. And from there, my next key really depends on, after DC does the next set of stimulus, really do we move on to infrastructure spending and rebuilding the supply chain? I was very confident that we would get to there. I'm slightly less confident now because I do think DC has to deal with the protests and the civil rights issues that are going on, and that might detract them from their focus on the economy, especially with the NASDAQ at all-time highs.
So before I ask you about that jobs report, Tamar, I want to quickly ask you about the IPO market. Jeff Weiner in the last hour said that he thinks that the IPO market is going strong right now. Warner Music Group, obviously we saw yesterday, right now up over 8%. What are you thinking about the IPO market?
Yeah, again, I think the risk appetite is there. And if you kind of fit what people are looking for, it's a good time. I've been more focused on the corporate bond market, where you're seeing record issuance. Amazon issued the other day, very large deal. It set records for the lowest coupons in a decade. So there's huge demand, I think, for new assets, and especially if you're the right company and you fit people's investment needs.
And Peter, jobs report Friday we have coming up tomorrow. What are you expecting there? Good news, bad news?
To be honest, I don't even look at the jobs numbers right now. I think they are so warped by the delays in filing, and then there is so much money floating around the system. I think people are reluctant to go back to work if they can avoid it. So I don't think we're going to get a true picture on the jobs probably until August or September. So I think the jobs reports actually overstate the problem right now. So I've been largely dismissive of them just because I don't think we're getting useful information out of them.
All right, Peter Chur, Academy Securities. Thanks so much.
Thanks very much for having me.
Thanks. And just a reminder for our audience out there, again, Yahoo Finance's special broadcast on the jobs report starts tomorrow morning at 8:30 a.m. Now, in the newest episode of Yahoo Finance's Influencers, our editor-in-chief, Andy Serwer, talks to Chase Koch about what it was like to grow up in the famous, or perhaps infamous, Koch family. Take a listen.
Yeah, I'll just maybe give you two examples of that would shed light on kind of growing up in the family. The first one is like everything goes back to being based on principles and the importance of principles. So as a kid, I remember, we'd show up at the dinner table. We had the 5 things: love, courage, faith, honor, and loyalty. As kids, those were our core principles. So we were held accountable to those every day. So we'd show up at the dinner table and say, all right, Chase, tell me one principle and how you exemplified that today. And that goes all the way back to when I was 5, 6 years old. The other example I'd give you that really was a huge influence on my life was my first job at Coke. When I was 15 years old, I worked at the feed yard for the first time. And just to back up a little bit, I grew up playing a lot of tennis. I was a competitive tennis player. I played on the national circuit. And when I was 15 years old, I got burned out and tired of it. And I remember throwing matches intentionally to come home and be able to hang with my friends and not play tennis. And I remember my pop calling me up to the office and said, you can either continue playing tennis and playing 100%, or I'm going to get you a job. I said, get me a job.
And remember, you can catch that new episode of Influencers tonight. Well, coming up, we're going to be chatting a new interesting way of predicting where, when, and how fast coronavirus will spread. That's next. Welcome back to Yahoo Finance's The Ticker. Looking at the markets, all major indices still in the red after getting some slightly pessimistic news on the jobs front. Again, an additional 1.877 million Americans filed for unemployment benefits last week, and that was exceeding estimates for 1.843 million. Again, we have the jobs report tomorrow, so stick with us as we continue to chat what to expect there. But as we were chatting about a little bit earlier, coronavirus continues to spread across the world. But what if we could predict exactly where, when, and how fast it could spread? Well, a new app from Diagnostic Robotics says that they might be able to do just that. And we're joined now by Kira Radinsky. She's the Chief Technology Officer for Diagnostic Robotics. Thanks so much for joining us, Kira.
Thank you for having me.
So, Kira, I want to know just first how this app works, and then if you could chat with us a little bit about the accuracy of it.
Definitely. So Diagnostic Robotics is a clinical triage system that has been working for approximately 50 million people across the globe till today, with more than 100,000 different medical providers using that. It's not an app, it's actually an AI platform integrating different healthcare systems. 3 months ago, we've been requested by the Israeli Minister of Health to not only triage for all the diseases, but this time triage on a daily basis, all of the 8 million patients in Israel. Using this clinical triaging, we've been able to estimate an epidemiological map showing where COVID is right now, but most importantly, using machine learning, we provide predictions about how it's going to spread. We were able to predict on April 4th 3 large cities, published them on the media, and indeed, a few days later, the government has quarantined them based on our predictions. Since then, on a daily basis, our report is being presented to the Vice President of the Ministry of Health, making any type of clinical predictions and additionally quarantine and exit strategy. I must mention this is the only digital solution that Israel has deployed, and we've been out with the exit strategy for the last month. The solution has also been monitoring 46 million people in Odisha, India, with our collaboration with Deloitte, and we recently launched in Rhode Island State as well.
So, Kira, I'm wondering if you can chat through. I know you mentioned this has been deployed in Israel. How successful or how accurate has it been in terms of predicting where the virus will go next?
So our AUC is 82. So in other words, we rank cities, and if you look at the top 10, 82 on average will be correct ones based on the real actual ranking at the end.
I'm wondering if you think that a tool like this could be successfully deployed here in the United States, especially as right now, in a moment of civil unrest, people are very cautious and very wary of technology having access, to their phones and to their personal data. Do you see it being applicable here in the United States? I know you have a partnership with one state.
Definitely. So we launched with Rhode Island, and not similar to the tracking information. Our information is not keeping any PHI, personal information at all. It's completely anonymous, aggregating only clinical information. This enabled us to learn a lot about the disease and its progress. We were one of the first companies to identify that loss of taste and smell correlates with the disease. For example, we also know that extreme fatigue combined with dry cough is much more correlative than just fever. What enables this is the collaboration of all of the people answering this on a daily basis, providing us insights about how the disease spreads.
All right, Kira Rudinsky, Chief Technology Officer of Diagnostic Robotics. Thanks so much for joining us.
Thank you.
And coming up, we'll be chatting the Paycheck Protection Program, the PPP, and some of the new changes that might be coming up. That's next. Welcome back to Yahoo Finances, the ticker. Well, businesses looks like they'll be getting some more flexibility in how they use funds from the Paycheck Protection Program, the PPP. And to chat more on that, we have Amanda Cohen. She's a James Beard nominated chef and owner of Dirt Candy. We also have Sabeel Marcellus joining us for this conversation. Thank you both for joining us to chat about this. So Amanda, I first want to ask you, I know that you've received funds from the PPP program before. How many employees do you have, and how helpful was that program for you through this time of coronavirus?
So I had 33 employees and I laid all of them off. And I actually still have 33 employees that I have laid off. I have not hired a single person back. The PPP was totally unhelpful up until this moment when it was, we made all the changes were made. Unfortunately, I just couldn't figure out how to use it in New York City, which really has been totally shut down.
So Amanda, tell me about the new fixes to the PPP program that the Senate has just approved. Is that going to allow your business to stay open through the end of the year?
Yeah, I hope so. It should allow us to. You know, we have so much more time to use the money, which was the best thing that could have happened to us. I don't see how I could have used it for the first 8 weeks when really we were told not to open. But now New York City is starting to open up, hopefully by July, and I can use it to hire back some of my staff. And then they've changed the split on how you have to use it. So instead of it being 75 for payroll and 25 for rent and everything else, the split makes a lot more sense where I can do 60% on payroll and 40% on utilities and rent and everything else. So the way it was all sort of divided, it just didn't make sense. And now it's a lifeline. It's probably not everything. I don't know if it'll allow me to stay open forever, but certainly through December 31st, it's a huge, huge lifeline.
And tell me about the impact of the coronavirus on workers in terms of their pay, but also their benefits. I know that your restaurant has the distinction of having a no tipping policy, but because of that, you actually pay out higher wages. So what do you think is going to be the impact of all this that we've seen, the devastation?
Well, I actually think that it might be very good for the industry. I think to get people to come back to work, we're going to have to pay them a lot more. And I think maybe we won't be able to hire back as many people, but we will be actually able to pay them more or think about paying more. Because what happened when everybody got laid off is before there was the federal stimulus, there was a real scramble to figure out how anybody was going to live off of their tipped wages. Those aren't part of unemployment. And so my staff was lucky, actually, because we paid them such a high wage. They were at the top end of unemployment before the stimulus happened.
And what kind of fixes do you think we should have going forward? You said that you think you can keep your doors open through the end of the year, but is there anything else that needs to be done for the Paycheck Protection Program to help in restaurant industry overall?
I'm not sure much more can be done with the Paycheck Protection Program, but I do think that restaurants still need a little bit more help. We're where places people gather, and I think it's going to be a long time before people feel comfortable gathering again in large groups, even if we're mandated that it's okay to open. It's going to be a long road to get back to where we once were. So really, restaurants need a stabilization fund. We need something more to get us through probably the next 18 months until there's some semblance of normalcy again in life.
When you do reopen, what kind of precautions are you actually going to be putting in place in your restaurant? Do you have room to have 6 feet distance between the different tables? Is all the waiter going to be wearing masks? Are you going to do temperature checks? How are you going to handle it?
We're still figuring that out. I am in New York City. I'll probably be one of the last cities to open and fully open. Yeah, I can certainly have some room between tables. I can have 6 feet, but I used to have 20 tables, and now I'll probably end up with maybe 4. Certainly not enough tables to keep my business running. All my servers will be in masks, probably gloves, and my employees will definitely be getting temperature checks.
Amanda, I know you said that you laid off essentially all of your employees. Is there a phased reopening plan that you perhaps have in mind? Perhaps start with takeout and then move to opening up the restaurant fully?
Yeah, so what we're going to do is starting in July, early July, we will go to takeout and delivery and hopefully some outdoor seating. This is something that will be very new to New York, but we're going to try to use the city streets. I've never had a sidewalk cafe before, but we'll try to figure out something with that and maybe be able to let people eat in the parks. And then maybe come September, October, it feels like the city feels a lot safer. We'll do half capacity or quarter capacity, whatever I'm mandated at, truly. It's mostly up to the city. And, the city, even if I'm mandated to be at 50%, I'm having a hard time believing that I can get 50% of my guests back into the dining room at the moment.
So actually, on that point, I'm really glad that you mentioned it. I know you said that you think that you have the funds to really carry you through to the end of the year. Is more funds critical or necessary to keep you going past 2020 into 2021? I mean, are you at all worried? Are you pessimistic and downbeat about, the future of your restaurant?
I am terrified. I feel a little bit safer until December. But come January 2021, I don't know what I'm going to do. We're not going to have tourism back. I still don't think we're going to be at 100% capacity in restaurants. I think people's finances are going to be very different than they were beforehand. And I don't know how my restaurant will survive without some more help. That's why the stabilization fund is imperative to get us through this time.
And I'd be remiss if I didn't ask you about what's happening in New York City with the thousands of protests. Where do you stand on all that as a small business owner, although you are closed right now?
I am closed, and I think they're great. I watch the peaceful protests outside my window every night, and I think it's amazing. And I really hope they continue, and I hope this is a time for change. I really, really hope that finally we can make some change in this country.
All right, Amanda Cohen, owner of Dirt Candy. Thank you so much. Sabeel Marcellus, always a pleasure when you join us. Thank you as well.
Thank you so much.
And one last look at the markets. Again, all the major indices remain in the red after getting some pessimistic news there on the jobs front. Again, we have to wait until tomorrow morning to get the latest jobs number. Stick around with us. The final round is next.
All right, good afternoon, everybody. Welcome to the final round here on Yahoo Finance. Miles Udland with you in New York. Let's take a look at the stock market right now on this jobs day eve. And we've got a market in the red and moving a little bit lower here in the final hour of the trading session. The NASDAQ, the big loser on today's session, off about 0.9%. The S&P 500 off about 0.7%. Of 1%. And as we've seen on a couple occasions this week, a lot more action is happening on the sector level than we're seeing on the index level here. So if we look at the S&P sectors, interesting laggards today, real estate and utilities, some of the safety trades we've seen in this market, both off more than 2%. Far and away the biggest sector losers during today's session. On the plus side, only two sectors, financials and industrials, XLF, XLI, are higher on today's session, but the banks continuing
morning. Their strong performance this week, perhaps a sense maybe that this cyclical trade might actually remain intact, that there is not just some bullishness about the stock market snapping back, but also the economy perhaps shaping up better than expected into these summer months. I want to bring in my co-host, Shauna Smith, now for a bit more. Shauna, on today's market, and I guess also some trepidation, nervousness perhaps around what we may hear tomorrow on the labor front.
Yeah, that is interesting. And I also think it's just investors kind of taking a breather. We've talked about this pent-up demand that we have seen, almost looking like investors were trying to identify any excuse to buy in this market, which I think is a big reason why we have some of these individual winners, these individual names continuing to outperform. So I think today's move, it's not really much to make of it. Dow only off, just around 100 points. So not a huge move to the downside here, but it is interesting the fact that we are seeing this pause and this massive momentum, this big rally that we have had so far this week. Another thing that stuck out to me in today's market was that NASDAQ 100 hitting an all-time high earlier. We obviously are off that all-time high right now, but I really think it speaks to some of the strength that we are seeing in the tech sector. And I know we'll talk about this a little bit later on with some of our market guests, but it's interesting just the rally that we've seen in tech. And it's also leading to the question of whether or not some of those valuations in the tech sector could be a little stretched at this point. And Miles, you mentioned the fact that it's Jobs Day Eve. We obviously got those jobless claims numbers out this morning, 1.8 million Americans filing for unemployment. Relatively speaking, it's actually pretty decent when you compare it to some of the recent reports that we've gotten. It's actually the first time that we've come under 2 million claims since the middle of March. So it kind of goes to the theory that we probably have seen a bottom in the jobs market, at least for now. So that could mean, I guess that could be a pretty strong sign for the markets, at least the market's momentum going forward.
Yeah, and I think tomorrow's jobs report, and you mentioned, Shauna, that idea that perhaps we've peaked. I think there's a lot of different ways that economists are coming at that idea. And I'm going to be very interested just to see what the data says about, what the data says tomorrow, because pretty much every economist thinks that tomorrow's going to be as bad as it gets. 19% unemployment rate is what we're expecting. Most economists believe the shadow unemployment rate is closer to 25%. It would be quite scary if it does indeed get worse than that in June. And certainly that would be not the market's base case. So we'll really be poring over those numbers to see any signs of life in the labor market, but we'll discuss more on that as we get through today's program. You mentioned the NASDAQ 100 hitting an all-time high earlier today, and certainly a sentiment check in this market was the IPO we saw this morning. ZoomInfo, which is not Zoom, the conferencing company. This is a business that's essentially, I guess, a Rolodex for cloud computer companies. Jared Blickery joins us now for a bit more on what's going on with that IPO, Jared, and maybe if you too see this as a heat check of sorts for this market.
Yeah, we've been talking about the IPO market all week long, and here's ZoomInfo Technologies up 68%. Really nice pop. Just look at the intraday price action. Took forever to open, by the way. I think it was 12:30, 12:40. Last time I remember an IPO or something trading for the first time was Spotify. That took about a similar amount of time. But we saw something similar yesterday with Warner Music Group, and let's see how they're doing today. Looks like they are up let's see, 4.68% over the last 2 days. That's really as of yesterday's close, but from the 25 lows, got a nice pop there. And we've been talking about, really, it's only been biotechs that have come to market this year so far because of the depressed environment that we're in. So this is a nice sign of risk-taking that we're seeing here, Miles.
All right, Jared Blicker with the latest on what is going on in the IPO market today. And again, very interesting just in this kind of environment to see an IPO come out and to see the kind of demand that we saw. This thing priced $21 yesterday, and then we saw it, open or was indicated to open at double that price earlier in today's session. I want to come back to this labor market discussion that we were having, and I want to bring in Dan Roberts now for a little bit more. Dan, what we saw in that initial claims print this morning, and I think, again, continuing, I don't know, in my reading of it, I'd be interested for your take. It seems like economists are waiting to say, yep, worst is over. And yet kind of the report is still really bad. And it's really hard for me to say that this is definitely the worst is behind us here.
Yeah, I agree. And that's just what I was about to say, that, optimism about, well, whatever the number is tomorrow, that could be the worst it gets. I feel like 3 weeks ago, we heard the same thing about the previous month, that, well, this is probably going to be the trough here. And tomorrow, if the number is worse than expected, boy, and stocks just continue to go up regardless of that. And we talk about this every day. We talk about, look, the stock market is not the economy, but as the economic data just continues to be so grim, it starts to feel irresponsible. Now, of course, the answer here is that a lot of Americans are not really invested in the stock market. Many are, sure, through their 401ks, but the people who are making these gains and winning in stocks are not the people who've lost their jobs, and so the divide there isn't that surprising. I also want to say that the optimism about, well, maybe this next number will be the worst it gets, well, that assumes then that a lot of people are about to get their jobs back. And boy, I don't see the evidence for that. I don't really see the evidence for that optimism. I mean, just look at the restaurant industry. We talk about this every day. Look at the gig economy. So many of these furloughed or laid off workers, I think, unfortunately, are starting to either see the writing on the wall and think, maybe I'm not about to get my job back, either not soon or not ever. And then there's also the weird and thorny issue. And I just was reading about this in a New York Times piece about McNally Jackson, my favorite bookstore in New York City. But the issue of some laid off workers realizing and doing the math that their unemployment benefits are bringing them more money per hour than they were getting with their actual job that they've lost. So then they face the very weird decision of, even when I'm allowed to get my job back, do I want it back? So boy, I just don't see the reason necessarily for the optimism around the jobs data right now, but stocks just kind of chug ahead separate.
And kind of another factor that was supposed to be a silver lining and perhaps a reason to be additionally optimistic was Senate passing that additional extension for legislation regarding the PPP, extending the time to actually pay back that loan from 8 weeks to 24 weeks. But as we have covered extensively, for some people, those 8 weeks are already coming to an end. So they had to decisively make action to lay off employees or keep employees if they did get that PPP. And just speaking to different industry experts and analysts during this time, to Dan's point, a lot of these employers are not going to be going out and rehiring some of the employees that they had originally laid off. They'll say, okay, we cut out that cost. We've organized our budget in a way where we're not keeping this headcount in place. We've slashed our headcount by 50% or whatever. So just thinking about the repercussions of even something that was supposed to be a positive sign for these small businesses shows kind of the unintended consequences of reacting too late, right? Because unfortunately, a lot of these employers already made their decisions regarding what their new business will look like.
Well, and Melody, I think to that point, this is a reminder, and I know right now there's a lot more going on in the country right now that we're all consumed with, but those unemployment benefits that Dan was referencing, they run out at the end of July. There is a timeline here that Congress needs to be, and I know they are cognizant of it. And again, we discussed this with Rick yesterday. 7 weeks in legislative time is an eternity, but 7 weeks is what we have for a new wave of stimulus that in size probably needs to be about as big as we saw in March and April to get passed. Otherwise, this whole notion that, not only are people going to be rehired, but that businesses will reopen, that's probably going to go out the window when we get into September and October if we don't see additional action on that front in the weeks ahead. And along these lines, we got some interesting news today right out of New York City. News that restaurants won't be reopening until the month of July, and it continues to give us a framework for what recovery looks like in some of the hardest hit areas of the country. For a bit more on where things stand with the coronavirus, and also I think some troubling trends in terms of case counts going up and hospitalizations on the rise. I want to bring in Anjali Khemlani now for the latest on all that. Anjali.
Thank you, Miles. Yep, as you mentioned, there are some concerning sort of emerging spots around the country, which really a lot of health experts have been keeping an eye on, and they span, around the country. They're not really, relegated to just the coast or to the southern areas. So really a mix of what is going on and what we're looking for the future. Meanwhile, there are some different little pieces of news today, all related to the health sphere. First of all, Roche got its FDA authorization for a new kind of test, which in about 18 minutes can identify severe patients who are hospitalized that may need to be on a ventilator. And so that, as we know, with the concerns over the ventilator problem earlier this year, that may be a new move to kind of help that. Meanwhile, the Health and Human Services Department just released new guidelines that more positive COVID tests are are going to be collecting even more information. We know that, the inequities in healthcare have been highlighted throughout the outbreak, but also in light of all the protests in the past week. So we're hearing a lot more about that, and the federal government has been taking action. And so now we're going to be seeing more information and more data about where these cases are popping up, including zip codes, information about race and ethnicity, and gender as well. And so that is going to also help direct the federal government on where their resources are supposed to be going. So, some interesting developments there. As we know, we've heard from so many health experts that this is going to be with us for a while. So keeping an eye on that.
And Anjali, if I could really quickly, just about the severe test does this, because I remember the oximeter reading was essentially the way that doctors were looking at, who has the most severe case of COVID. What does this test tell us? And so I guess this also indicates that there's a broader understanding now of this disease and what severe cases really are relative to more mild cases.
Right. So one of the underlying sort of common threads with some of those severe patients was severe inflammation. And so when you're hearing about that, that can be detected through a blood test. And that is what Roche has been able to detect. And so looking at those indications is helpful. And yeah, we are definitely learning, a lot more about what the common threads are. At what point does a person, end up at higher risk of being on a ventilator? And so I think we're going to be seeing, in the coming months, a lot of the stuff that doctors were looking at in the past few months coming out in studies.
And all of this important to know as we reopen the economy. If more people get sick, but we know what to do with them, there is certainly a plan in place, which we had no idea what we were doing back in March and the earlier parts of April. All right, Anjali Khemlani with the latest on the coronavirus. Always great to get your thoughts. Coming up on the other side of this, we're going to our call of the day, and we're turning to the gym space. A couple of firms out with their commentary on Planet Fitness, one firm pulling their price target on the stock that has had a huge rally in the last few weeks. We are back with all that coming up in just 2 minutes. All right, welcome back to the final round here on Yahoo Finance. Miles Udland with you in New York, and it's time now for our call of the day. And today we're talking about a name in the fitness space that has had a huge rally over the last couple of months, and that is Planet Fitness. The stock today down about 3.5%, and the peg for this segment is the news out of Raymond James downgrading the stock to market perform. And they basically say the reopening trade that we've seen in Planet Fitness has played out. The firm had a $63 price target on shares. Planet Fitness trades at 74 today. So if you had taken Raymond James's advice and ridden the stock to 63, you did quite well, and the stock exceeded those expectations. But Shauna, I think it's interesting to see how enthusiastic investors have been about the Planet Fitness story. Considering on the one hand, only 40% of their stores are open. But I think in this environment, having 40% of fitness centers open, considering what shelter-in-place policies are still in play in most of the country, at least most of the population centers, it's certainly a surprising story, I think, for some of us catching up to speed today.
Yeah, and I mean, this is strictly just a valuation call from Raymond James's part, at least. The stock is up over 170% since that low that it hit back in the middle of March. But I think it's interesting. Okay, so they have 40% of their gyms opened, and traction so far, it looks pretty good. I wouldn't be surprised, though, if that looks drastically different once we see the coasts open up, because New York, New Jersey, the places that have been hardest hit here, I think people are going to be very hesitant to go back to the gym. I know when I talk to my family, when I talk to my friends, no one's really in a rush to either go back to places like Planet Fitness or to even go to boutique classes, boutique workout gyms. So I think that even though we are seeing that, hey, this recovery is going well in certain parts of the country, I agree with what Raymond James is saying, just that there are so many uncertainties out there. I don't think the fact that Planet Fitness is handing out hand sanitizer, making it more available, at least cleaning their high trafficked areas, trying to do this whole touchless check-in through the mobile app, that's really going to be enough to incentivize a wider range of their former members, if they discontinue their former members, to come back. Because I think areas that have been hardest hit, people are extremely cautious. I think a lot of our friends or a lot of our families still are not going to the stores on a regular basis, still kind of can't even wrap their heads around working out in a public place very close to somebody, even if they are 6 feet away. So I think Planet Fitness, even those signs in some areas of the country, it's doing very well. I think that it still has a long way to go and will be quite some time before it begins to normalize.
Shauna, I think the projections and even the surveys going into the pandemic and during the pandemic are actually a little bit different, or I'm sensing that it's different than the sentiment we're seeing from actual activity. Because let's remember, survey after survey, gyms were right up there with live sporting events, live stadiums, live concerts, in terms of people being very afraid to return to that as normal behavior. But I have a feeling that as much as people are saying that they're not interested or they're very hesitant to do this, that people will return to Planet Fitnesses. Just thinking about the Black Card membership that the Raymond James note points out, 60% of the revenue actually, I think, comes from those Black Card memberships, which is basically like a passport service that you have access to all 2,000 locations of this gym. So that means that even if you are living in one area, living in a certain city, if you travel, you can end up there, having that accessibility, saying, okay, I left New York City because it's a hotbed. I'm going to go to a different state. And then you have access to a gym that happens to be open because it is less concentrated. There are fewer people around. I think you'll see more of that shift perhaps, and people holding on to their memberships, especially if we see this continued exodus out of major metropolitan areas. So I think another point is, one company we talk about a lot is Peloton. The Planet Fitness customer is not the Peloton customer, right? I don't think there actually is a large overlap when you think about the price point, when you think about the affordability and accessibility of a gym chain like Planet Fitness. I anticipate that people who are paying $40 for a VOD class, that have the luxury to do that, that have the privilege to do that, to be able to have a Peloton at home, they are not the ones who are Planet Fitness customers who unfortunately don't maybe have access to those kinds of services or the VOD services that will become costly after these free trials end. So I kind of am on board with this Raymond James call for the most part.
You know, guys, I look at this note and how the stock is doing and that it's gone well so far with reopening, and that's about 40% of the locations being reopened. And to Shauna's point about, a lot of people we know are still not venturing out. They're not comfortable with this. Boy, I think that's probably us being a little bit in our East Coast bubble, where obviously there were more cases in New York and New England. And so things have been slower to reopen here. And then obviously on the other coast where Melody is, it's the same. And LA and New York City seem like really the two last cities standing in terms of going slower with reopening. I think this story really shows us the huge split we're seeing now across the country. It's a reminder. I mean, pick any business. Right now we're talking about gyms, but we can do it with restaurants. We can do it with bars. And I know later in the show we're going to talk about casinos reopening in Vegas. But boy, I'm not so sure that a lot of people, I think maybe we're wrongly assuming that a lot of people are not going to be comfortable. I think in a lot of these states that have begun to reopen, if they say gyms are open, a large percentage of the members say, great, I'm going to the gym. If my local state or local city authority says it's okay, then it's okay. I can do it. I think as we go into the summer months, you'll see more of that, where the minority are people who are feeling even more cautious or even more strict with their coronavirus precautions than the local guidance is. It seems to me like the majority of Americans will say, well, if the local guidance is that this business can open, then I'm going to go frequent this business. So it is good for gym chains. It's good for Planet Fitness. Of course, it's just hard to wrap our heads around that when we're here in New York, or in my case right now, Massachusetts, states that are slower to reopen.
And, to that point, Dan, I mean, in a note also on Planet Fitness, Cowen today, they raised their price target $15 to $80 a share. They have an outperform rating. And something that they brought up is that, the trends that you would expect in Planet Fitness, and in this case, that's 40% of new members hadn't gone to the gym before. That basically indicates, and I think it's, Jared Blicker had the chart up earlier. If you look at it on a longer time frame, Planet Fitness, that's a V. Right? That's a V-shaped recovery. And that suggestion from Cowen's conversation with Planet that their membership is acting the same way they did in the past, that suggests, to your point, Dan, that I think in more places than perhaps we are appreciating right now, people are getting back to normal. Now, that doesn't mean they're doing 100% of the things they used to, but we're all going to be faced with decisions on what do we want to do again? Do we want to go back to the gym? Do we really want to go back to a restaurant? Dan, I wonder how quick you'll be to return to the movies. That is something I know you like to do. And we're all going to make our choices, but certainly, at least for Planet Fitness's customers, and some of the other notes also point out their competitors are in a lot of trouble. 24-Hour Fitness, what's it? Club Sports International, I think is the company.
New York Sports Club.
They're in a lot of trouble. So maybe that's good for Planet Fitness, but it really does come down to we all have choices to make as consumers. And I think for a lot of people, the gym is one that's going to stay in that bucket of that measured, calculated risk as we get towards whatever this new normal is going to be. All right, coming up on the other side of this, we're going to talk a bit about the market's biggest 50-day rally on record. Ryan Dietrich of LPL Research is going to join us to discuss coming up right on the other side of this break. All right, welcome back to the final round here on Yahoo Finance. Miles Udland with you in New York. Let's take a quick look at the market. Losing a little bit of steam here as we head towards the closing bell. We had been at session lows, the NASDAQ off over 1%, recovered some of that, but with the Russell also turning red, we now have all four averages that we watch closely here at Yahoo Finance in the red with about 35 minutes to go in today's trading session. I want to bring in Ryan Dietrich now. He is the senior market strategist over at LPL Financial. And Ryan, a note that you had out recently certainly caught our attention. The 50-day rally we've seen from the lows. We're up 38%, the largest rally we've seen on record over that time. And I guess just historically, where does the move we've seen off the lows fit into some other periods in market history? Because I think some people say, boy, those aren't really years you want to be compared to.
Yeah. Hey, Miles, first off, thanks for having me back. But you're right. I mean, 50 days ago, yesterday was 50 trading days, I should say, was 50 days off the March 23rd lows. And it's the greatest rally we've ever seen in 50 days on the S&P 500. Clear distinction. S&P 500 stocks started in 1957. We did see with the S&P 90 some bigger bounces in the Great Depression. But again, just going back since 1957, we took a look. The bottom line is after these substantial moves higher, 6 months and 1 year later, you actually continue to see outperformance. The previous record, that's 50 days ever, was October of 1982. Not the worst time for an extended move. I think our real synopsis, when we looked at the previous largest 50 days ever, yes, they took place usually at the end of bear markets, but they didn't take place in a bear market. They took place more often than not actually at the start of a new bull market. I know that sounds crazy. We can get into all the bad things that's happening, but what the stock market is telling us, I've been coming on with you guys for 2 months now saying we're probably not going to meet those lows. Lows we're in. We really feel that way now. But looking forward, the market is saying better times could be ahead. The market's a forward-looking mechanism, and economy could pick up the second half of the year more than most people think we think here.
And, ultimately how you characterize any market period doesn't really matter, right? The only thing investors need to know is the general direction. But I guess now it's something you're looking at, because I think some people have talked about this in the last, several months. Go back to January 2018 and take those highs. That was basically the top, within a couple percentage points. Have you had any conversations with folks who are saying, maybe that was a secular bear for that 2 year period, even though there were record highs, blow off tops, huge crashes, and that maybe this is the kind of reset we're seeing after a tumultuous couple of years there in the market?
No, that's a great point. You guys talked about small caps before I came on. I mean, the Russell 2000 has not made a new high for 2 years. Okay. I mean, we think it's this great bull market. I know we had 34% correction, but there's different parts of the markets that clearly haven't participated. And that's what we are encouraged by. What's leading again today? Industrials and financials. Clearly the baton has been handed from tech and healthcare to some of these other groups that lagged. But that's how bull markets work, right? Eventually, we're going to get a pullback. I mean, June, you go back the last 20 years, is one of the worst months of the year. Put to call ratios are getting low, meaning people are getting optimistic. We've just had the best 50-day rally ever. A little optimism makes sense. So a pullback will probably happen. But the fact that the market has kind of handed that baton to different sectors is really a healthy phenomenon, in our opinion.
Hey, Ryan, going off of that and just the recent moves that we've seen in the market, the big debate is what we've seen in the tech sector with the NASDAQ 100 hitting that all-time high earlier today. Are you under the view, because some say that this trade still has room to run, while others say that there's a great rotation underway and we could see some of these big tech names fall? Where do you stand on this?
Yeah, with tech here, we still think that's a group you want to be in. I mean, the big names, NASDAQ 100 led on the way up. They actually did better on the way down, and now they've weakened a little bit the last 2 weeks, I'm aware. But until they really show some weakness, we think that's a group you want to stick with. Also, we still like healthcare. Healthcare is quite similar, where it did well, and now it's kind of been a little weak. But for the rest of this year, you look at earnings. I mean, earnings are coming from healthcare and energy. I'm sorry, not energy, healthcare and tech. And those are two groups that we still think can participate and maybe even outperform the final, we'll call 7 months of this year.
And, Ryan, just broadly, I think you talked to an interesting set of investors, compared to maybe someone who's at a, bulge bracket shop that we talked to. What are you hearing in terms of what questions are you getting? How much skepticism is there from the folks that you're in regular contact with about where this market stands right now?
Right. Well, fortunately, I get to deal with LPL advisors, so they kind of get what's going on and they understand the fact that markets are going to pull back. There's volatility. This is probably the shortest recession we've ever seen, and likely the expansion goes higher. But just look at look at any of the tweets I do that are bullish, right? I know you guys see this stuff too. The skepticism on this rally is just, it's hated. I think it's almost more hated now than it was when we were down 34% back on March 23rd. I know it sounds crazy to say, but a lot of people say the Fed, right? The Fed is too powerful. The Fed is just printing money. I've got the same concerns as a lot of other people about some of those things. Reality of the fact, when you stop an economy, you need record stimulus, whether it be fiscal or monetary. And we have seen that. And that's what was needed, that olive branch to help people that have been so impacted by this when we get to the other side. And we're getting closer to the other side. And I'm not saying what the Fed did is right, but I'm saying if you really wanted to help what's going on, confidence and liquidity is what the Fed has done. And they've done a good job in our view right there.
All right, Ryan Detrick, senior market strategist with LPL Financial. Always great to get your thoughts, and we'll talk to you soon.
Thanks, guys. Appreciate it.
All right, coming up on the other side of this break, we're going to take a look at this market with Jared Blickery. We're also going to discuss what's going on in the travel space. Casinos in Las Vegas reopening, American Airlines increasing the number of flights it expects here in the U.S. over the summer. We'll get into all of that coming up in just 2 minutes. All right, welcome back to the final round here on Yahoo Finance. Miles Udland with you in New York. Let's go over to Jared Blickery now for a closer look at this market that is in the red, but continuing to kind of hang in there as we head towards the closing bell. Jared.
Yeah, lots of movement here. And we came into the day with all three of the major indices at important inflection points, the Dow climbing or right at its 200-day moving average, the S&P 500 at a key, its last Fibonacci retracement level, also price action resistance. And then the NASDAQ 100, not really our main index, but that's right at its record high, which it breached today, if ever so briefly. And so we're seeing a little bit of a pullback here. It would be normal to see markets pause, and that's kind of what's happening. So here's the intraday price action, and we can see we are up off the lows right now, 30.90 providing support. Just kind of looking at what's happened over the last 5 trading days, not really being able to fill this professional gap here. And that's just fine. That's kind of a bullish sign, but probably will fill overnight. And then just looking at a year-to-date chart, we can see we're right at this inflection point right here. That's the resistance area. So we'll have to see what happens going forward. Could pull back all the way to about 29.50, and that would be right around this breakout area right here. But I think that's as far down as we go. Now I want to turn our attention to our Yahoo Finance Premium idea of the day. This is an investment idea by Argus Research, and they are reiterating their buy and raising their target in microchip technology to 125. So that would be somewhere, let's say, right up here. And some of the reasons they're giving: microchip technology rallied 12% In a buoyant market on June 3rd, after the company raised its fiscal quarter 121 guidance, they appear to be one of the first companies to raise its guidance, even as the pandemic remains a global issue. And finally, companies now seeing a better outlook are likely to be concentrated in areas related to the digital economy that directly benefit from the disruption unleashed by the pandemic. And again, that price target is 124. And if you're looking for a stop, you can have the 200-day and 20-day moving average protection at about 109. That would be right, 109 would be right in here. There we go. Back to you, Miles.
All right, Jared Blickery with our Yahoo Finance premium idea of the day. Let's turn now to obviously reopening the economy, but an area of the economy, very closely watched physical place that is getting itself back together. And that, of course, is the Las Vegas Strip. Last night, hotels across the Strip opening for the first time. And Shauna Smith, you can look at Twitter at some of the footage that was coming out of these casino floors. And I know there's enhanced safety measures. I saw sinks in the middle of casino floors, and there's hand sanitizer everywhere. But overall, a very crowded scene. And we discussed earlier the trends that Planet Fitness Management is seeing in terms of people returning to their gyms. Look, one person's enthusiasm for working out is another person's enthusiasm for craps. And I think everyone is going to find their thing they're willing to compromise for. And I guess really it's not all that surprising that we're seeing casinos packed on day one.
It's not surprising. I was listening to a few people that were interviewed that were either in the casinos or heading there today, and they were saying that they have been checking. They have been waiting for this moment now for quite some time, for over a month. One woman was saying she just could not wait to get back into the casinos and start gambling. So I don't think it's a big surprise that there was just this pent-up demand. People want to get out of their houses. We were talking about the fact that people can't wait to go to the gym. I agree with you, Miles. People also can't wait to get back into casinos and start gambling. What was interesting to me, though, if you did see some of those videos, was the number of people that were not wearing masks. And you would think that you were in an enclosed place, you would be more likely to wear a mask, or that maybe it would be required, but it wasn't required. I know a lot of the casinos were handing out masks to those who didn't have it if they wanted them, but the majority of the people looked like they did decline. I think that also comes down to the fact that it's a little bit hard to drink and also to smoke if you are wearing a mask. So that might have been playing into it a little bit, but there were lines of people outside. There was over 100 people at one casino just waiting to get in, waiting for the moment that they will reopen their doors. So they are far from at capacity. I think they're only limiting it right now to 50% of their total capacity, but still the demand is there. And I think people will continue to go and gamble as long as they can.
Yeah, Shauna, it's hard to be a cautious glutton, right? I mean, if you're going to indulge in the vices, that's nearly impossible to do while being masked up. And if you think about even that epic interview that Anderson Cooper of CNN did with Las Vegas Mayor Carolyn Goodman, where the mayor basically was saying, this is ridiculous. We are an essential business, and thinking about the kind of clientele, right? They're not risk averse. That's the whole point, that these are gamblers. So they're gambling their lives to a certain extent and the health of others. So this is like 0% surprise to me. And maybe we should see an uptick in Vegas now.
Yes, guys, just to chime in here, the other thing I'll say, and we talked about this just a few segments ago about gyms, but we didn't really get into this. It's something I'm noticing across the country in areas where certain businesses or industries have reopened. I hesitate and am cautious to judge things solely based on photos. I think during this time, during the pandemic, there's been a lot of photos that rocket around social media where someone looks at a park. Sometimes it's been a New York City park, and they say, oh my God, look at this. And it looks like the park is packed and people aren't social distancing. And that's fine, and I understand the alarm, but I just think, especially now that it's not consistent state to state and all the states are in a different phase of their reopening, it's just hard for me to jump to conclusions and judge and point and say shame to certain photos. And yep, I've seen some of these photos from casino floors, and some people aren't in masks and it doesn't look like they're distancing, but at some point, people are going to venture out, and in a lot of states, they already are, and they're going to have to make their own decisions. And other people, if they look at that and say, oh my God, I can't believe they're doing that, well, then don't do that. And people are going to maybe get reinfected, and that'll be bad, but it's on them, and people are going to make their own decisions. Some people are going to be lax with wearing their masks, or they're going to be social and have friends over and not be 6 feet apart. Other people are going to be really strict about it. One more note on casinos that hasn't come up that's very interesting. sports betting stocks have been doing very well amid the pandemic, which is interesting because there have been no sports. But part of it has been the assumption that once sports do resume, because they will resume, that the sports betting will be great, and the momentum and the assumption that some states that have been hesitant to legalize sports betting will now maybe choose to legalize because they need the money, because they need the tax revenue. And that's bullish for those sports betting stocks. And of course, brick and mortar casinos are in a different place. And some of those brick and mortar casinos see some of those online betting apps and things like DraftKings as a threat to their future.
I do enjoy, Dan. We've talked about kind of social distancing and reopening in so many different ways, but adding a photo depth of field as a consideration here is just a new one that I commend you for innovation in how we discuss other people's takes on reopening. That is one that I think we should definitely bring up more often, because you don't hear about depth of field all that much out there in the world. Let's quickly talk a little bit about some news in the airline space today. American Airlines, that stock is higher. The company announcing that it's increasing its domestic bookings for the summer, its capacity for the summer by some 74%. Now, that's off a low base, right? They basically went down to what amounted to no flying relative to what they do. But, Shauna, I think it's an interesting, again, kind of a sentiment check on at least there's enough demand for American to say that we want to nearly double what we expected our summer capacity to be. And again, that doesn't mean 3 million people are coming through TSA checkpoints every day the way we saw in the before times. But there are people out there who have summer plans who are saying, you know what, I'm going to go ahead and do them.
There are. And I think this also plays into the fact that a lot of these airlines, or at least the ones that are positioned to win, are the ones that have the biggest presence here domestically. Because I think we have seen, at least from what the data has shown that we have gotten, is that there has been an uptick, but most of them have been in domestic travel. So American planning to fly 55% of its domestic schedule. Obviously a bullish sign here for the company, but it's interesting to see how the plans vary from airline to airline, because United was out saying that they're only flying 25% of their domestic schedule this summer. So it's interesting just to look at the discrepancy between the two. But I think there are signs. Obviously, we get the TSA data that has been an uptick. People are returning to airports. People are feeling more comfortable to fly. I think there is still a lot of hesitation out there. We don't know. It's probably going to be quite some time until we get back to the levels that we were at back in 2019, or even in the beginning of the year before the coronavirus outbreak really hit here in the US. But we've heard from a number of these airline CEOs in the past couple of days. We had the CEO of Delta saying that the average flight is actually almost half full. It's almost 50% full. So to him, this signals that there is a need to start adding more flights into the marketplace and add some of those bigger planes to meet the demand that's out there. So yeah, it is a huge step in the right direction. I think people are more willing to travel, but I think it's going to be quite some time really until we get back to those pre-crisis levels.
And I would just slightly apologize to our viewers for saying that American stock is up today. It's up 40%. That's an explosion to the upside. Obviously, the stock's down a ton from its highs. It's been more than cut in half, but United shares up 15%, Delta up 13%, and American up 40%. And coming up in the next hour, we're going to talk to Helene Becker, an analyst over at Cowen, a little bit more about everything that she is seeing in the travel space as we head towards the meat of these summer months. Well, this week on Influencers with Andy Serwer, he talked to Chase Koch, the heir apparent over at Koch, and is currently in charge of KDT Venture Capital Investing. Let's take a listen to a bit from their conversation.
I started Koch Disruptive Technologies about 2.5 years ago, Andy, with the thought that that we could bring something different to the marketplace and really create a kind of a new approach to innovation for Koch Industries, but also bring something different to the market. And I'll explain. As you know, Andy, Koch is it's a global company. We're in about 60 different countries. We have 130,000 employees, but we touch the majority of the economy. You know, I mentioned wood products. We're in electronics. We're in software with Infor now with that acquisition. We're in agriculture, a number of different verticals that touch the majority of the economy. And when I was working in the agriculture group, I spotted, this is again 2.5 years ago, I spotted an opportunity to say, what if we brought all of Koch Industries together as kind of this Koch laboratory concept and offer that to technology founders in a way that they haven't experienced from other, getting capital from venture capital or other corporate VCs. And so that was really the idea on how can we bring our assets, our capabilities to them in a way that they hadn't experienced before, in a way to unlock their potential. But it's a win-win. Back to this idea of mutual benefit, that helps Koch Industries as well, because we're on this journey of trying to transform a lot of our industrial companies to being technology companies. So we feel like if we don't do that, some of our businesses will become dinosaurs, right? So we have to stay ahead. And we saw this as an innovative model to basically have access to those technologies.
Everyone on for a half hour, tape it at 11 in the morning and just run it.
Well, not everyone can be Mark.
All right, welcome back to the final round here on Yahoo Finance. Miles Udland with you in New York. And we're joined now by Keith Lerner. He is the Chief Market Strategist at Truist SunTrust Advisory Services. And Keith, I want to get right into your latest note. And it's, I don't know if it's, maybe it's, I wouldn't say it's complicated, but if, you know, the stat that you call out, 90% of stocks in the S&P trading above their 50-day moving average. It's essentially saying that the momentum in the market to the upside is very strong right now. And I mean, your data shows that historically, this is a bullish sign, a very bullish sign for stocks over the next year. When you uncover this kind of data and you share it with your clients, do you get a lot of pushback that, hey man, what are you talking about? This market's overheated. Stocks can't keep going up. What are you saying?
Yeah, well, you know, it's funny. I don't get too much pushback, and we don't only rely on one indicator. But I will tell you this, and we put that out last week on Wednesday, and it sounds complicated, but it's really not. It's basically saying we have the majority of stocks rising. And historically, when you get to a really strong momentum signal, when you look at 12 months, we've looked back and the market's been higher 14 out of 15 times. Another thing is, these type of readings tend not to happen during bear markets. So you've never saw this during 2008. And what's also important, we dug even deeper. And when you go from a very oversold or where everything's moving down to everything's moving up, that's bullish. So our base case is that we are in a bull market. I will say, you know, short term is a more difficult call. I think it's a more mixed because you are seeing a big move. You're seeing put to call ratios show a little bit of complacency. But folks that have a 12-month outlook or longer, it suggests that you should stick with the trend and that we're in a bull market.
And I guess, you know, Keith, kind of more broadly talking about the market strength, and, you know, this is just one way to slice it, but I think a lot of people have taken a variety of different looks at the market, and most fundamental and technical indicators say that, you know, the market looks strong right now. What seems to be the most common piece of pushback that you're hearing or still seeing? Is it as, I mean, I just keep seeing, oh, well, the market's diverging from the economy, but that story hasn't changed in 8 weeks. Is there anything new that you're seeing from the skeptics on why they view the market as actually weaker than what the price says?
No, I think it's what you just said. It's still the disconnect. Up until last week, on a 4-week basis, so the 4-week sum of fund flows from retail investors was the greatest we've ever seen, even more so than what we saw during March. So in other words, we've had this big ramp up, and during that ramp up, retail investors have been selling at a accelerating pace. So there's just a lot of skepticism. I will say for the first time this week, got a couple of calls about folks that have been in cash, wondering what to do now. So a little bit of that fear of missing out is starting to come in. But, you know, the old saying is that bull markets start on pessimism, they grow on skepticism, and they mature on optimism. I think we're moving a little bit from the skepticism side, maybe towards a tinge of optimism, but it's just a tinge at most at this point.
And so, you know, obviously we've all talked the divergence to death, but certainly the economy is reopening to some extent. Have you changed your base case on what you think the labor market or GDP might look like by the end of this year? And how much is that factoring in to your thinking in the market right now?
Well, the more of the path of the economy has been factoring in. Back in March, we actually rebalanced and raised equities. And our premise back then is that the market was already pricing in a recession. Historically, markets bottom about 5 months before a recession is over. So we think right now the economy is bottoming right now, and the recession likely is, you know, going to be over sometime either this month or the coming month. That doesn't mean that we go right back to where we were. It just means we hit the trough. Our base case on the economy is that we likely don't recover the old highs until, you know, early 2022. Yeah, one last point, Maj, before I forget. We also did a study just on this path is when we looked at the worst quarters of economic growth. So we looked forward and said, okay, how does the market act?
Yeah.
Historically, once we've seen quarters of 4% or more on the negative side, for the economy, for the stock market, a year later you were up every time. So that disconnect is normal at the early stages of a bull market.
All right, Keith Lerner with Truist SunTrust Advisory Services. Always great to get your thoughts. We'll have you back soon. Stay safe. Take care.
Great. Thanks, guys.
All right, coming up on the other side of this break, we're taking a look at a market that is red as we head towards the closing bell ahead of a jobs day. The NASDAQ now off more than 1%. We're back here with more on that in just 2 minutes. All right, welcome back to the final round. Let's turn to the world of sports very quickly before we get to the bell. The NBA has officially approved its plan to return to play at the end of July. Dan Roberts is still with us for some quick thoughts, Dan, on the league coming back as we expected. But I guess here we go.
Well, here we go, but let's see, right? I mean, fingers crossed. The plan is in place and it's approved, but let's see, because if you look over in the college football world, a couple of colleges that had their players return this week have already reported, oops, there's some COVID-19 cases. So let's see if NBA happens, but the plan looks good. It's interesting that the NBA didn't go straight to the playoffs with 16 teams as some people expected, and as the NHL plans to do, go straight to the playoffs. First, doing an 8-game little mini regular season and then the playoffs. It's all happening at Disney. I hope it works out, but a lot of possible pitfalls.
Well, and the thing the NBA has said is if someone gets sick, we're not going to shut down the whole season. But what if a dozen players get sick? What if coaches get sick? What if staff get sick? I think there's a lot of questions, but certainly sports fans are excited to see what happens. And, you know, we're discussing daily fantasy, sports books earlier. The world is ready for this.
I do think the ratings, Miles, will be huge if and when these games return. And I think the leagues know that. And for some of the leagues that are so reliant on ticket revenue, they're banking that at least the TV eyeballs will be great.
And I can't wait to discuss the ratings with you because, as you know, no matter what you say about ratings, you are wrong according to the ratings people. All right, coming up on the other side of this, we're going to have the closing bell on this Thursday afternoon ahead of a big jobs report tomorrow morning. We are back with that in just 2 minutes.
Welcome back to the final round here on Yahoo Finance. I'm Shauna Smith. We are less than a minute away from the closing bell on Wall Street today. Stocks extending their losses into the close today. We have all three of the major averages in the red, although well off the lows. The Dow, the S&P, and the NASDAQ all moving to the downside. The NASDAQ, the worst performer of the three major averages this afternoon, off nearly 0.8%. We're also seeing the S&P in the red, off about 0.5% today. It's interesting once you look into the sectors, the action that we are seeing in that today. Utilities, which has been an outperformer recently, is the biggest laggard, with that sector off over 2% today. We're also seeing some weakness in real estate and the communication services sectors. Those three sectors are the worst performers this afternoon. 9 of the 11 S&P sectors are trading in the red as we head into the closing bell. The only gainers today, financials and industrials. Financials we've been talking about has been an outperformer, continues to be. that was the closing bell on Wall Street. It looks like we are still shaking out the close of today. S&P and NASDAQ, though, for sure, closing the day in the red. Like I said, the NASDAQ, the biggest loser today. We haven't even mentioned the econ data that we got out this morning, or some of the data that investors were closely watching. And that was a jobless claims number, 1.8 million more Americans filing for jobless claims last week, and that continuing claims number higher than expected at 21.5 million, really pointing to the fact that it's taking a little bit longer for some of those workers that have been laid off to return to work. I want to bring in my co-host, Miles Udland. And Miles, it's interesting. We've had this huge rally so far this week, really coming, starting the month of June on a pretty high note. Today, investors are taking a little bit of breather, but there's not really a clear reason as to why we're seeing this break in the rally.
Well, no, and I think the most important thing that we've seen in the market this week is what's happening in financials. And as you mentioned, one of the two sectors that were higher on today's session was the financial sector. XLF was up more than 1%. And you look at the KBW Bank Index, that's up nearly 4% on today's session. And so I think, again, as you mentioned, the data continues to be terrible, to use a conservative adjective there. But overall, and we just discussed this with Keith Lerner, the idea that the worst is happening and that in the future, even if things are bad, they will be less bad than they are today. The market hasn't moved off that position. And so, yes, we're going to see an unemployment rate that we haven't seen in 90 years tomorrow. But that doesn't really change what the market has already baked in and moved on from. And it's a weird thing to hit on every day. But you look at the setup from the market, the strength we've seen internally, and the fact that banks continue their climb higher. The market is saying that this reopening is probably going to go well and the economy is going to impress as we move into the second half of the year.
Yeah, I think that's exactly right. And to bring Yahoo Finance editor-in-chief Andy Serwer into the conversation. Andy, it's interesting because like Miles was just saying, it seems like the market is in the midst of this V-shaped recovery, and it's hard to find people in the business world that believe that. It's hard to find even the economic data to back that up, at least on the economy side of it.
Yeah, I mean, it's just really shocking, I guess, almost, Shauna. I mean, just here it is in a nutshell, right? The stock market is at a record high for all intents and purposes, record high. And as Miles just said, the economy is at a record low. And neither one of those points are exaggerations really at all. And it is just very, very hard to square that. And, you know, you see a little profit taking today and like, well, people are, and by the way, this is not lost on anyone. I mean, this disconnect is being screamed from the treetops. And, you know, you hear a lot about, oh, the billionaires are just, you know, completely disconnected from the rest of us, or at least the shareholder class. And obviously that's true. You know, it's hard to explain. Obviously, the market indexes are carried to a great degree by companies that are doing okay or even benefiting from this crisis. But, you know, overall, something's got to give here, Shauna. And, you know, it could well be, best case scenario, that the giving is the economy recovering a little bit faster than we thought, which would sort of justify the valuations. And there's a lot of craziness. I mean, Amazon is up 30% since the March low, right? And for just imagine that market capitalization. And then another one I love is today, American Airlines is up 40% in a day. So there's a lot of craziness out there, a lot.
There is a lot of craziness out there. And then we haven't even brought up, and Rick, I know I always go to you on this, but it's so relevant today, and that's the political risk. We got the statement from Mattis yesterday. Snap, we also had this after the bell. Snap no longer promoting President Trump. Esper also at odds with Trump, although he did walk back some of his initial comments, and also what a Biden win could potentially mean for the market. Yet we're still seeing these significant gains with the S&P up, what, over 30%, up 37% in the last 50 days alone.
Yeah, and I guess the real political risk for the markets, I mean, sad to say, the markets don't really care about riots or civil unrest or even looters for that matter. The markets should care about Joe Biden apparently taking a lead over President Trump because he does favor policies that would be pretty different from President Trump. Trump has been considered basically good for markets, I think, with the exception of his trade war against China. And Biden's policies on paper would be a little less friendly to markets because he wants to raise the corporate tax rate and a few other things like that. I don't think he's going to raise the corporate tax rate if he wins, at least not within the first couple of years, because you can't raise taxes in the middle of a recession, which we're still going to be in. But to Andy's point about the massive disconnect between the stock market and the real economy, I think the Federal Reserve is just carrying the stock market at this point. I think that's basically what it comes down to. I think the investors think the Fed is just going to solve every problem. I mean, basically at this point, investors seem willing to believe that the Federal Reserve has superpowers and that it can just stop bad things from happening. I don't think that's entirely true, because one thing the Fed cannot do is create demand. They cannot make people spend money. They cannot make businesses spend money. They can put a lot of Band-Aids on the economy, though, and they have.
Yeah, they certainly have. And we'll also get the reading tomorrow. It's Jobs Eve day tomorrow. We'll get the big jobs report head of the bell tomorrow. And if it's any indication, just in terms of what we got from the private payroll number and also the jobless claims number today, it seems like the jobs market at least isn't improving significantly yet. So more stimulus might be needed here down the road. All right, guys, I want to get to our call of the day, and it's an interesting one. It's on Planet Fitness. It was downgraded to market perform from outperform, also removing that $63 price target. This is a call from Raymond James. And Akiko, we were talking about this last hour, and I'd love to get your thoughts on this, because my point was, I get it. It's a valuation call. If you take a look at the stock performance, you don't have to look any further. It's up over 160% from that March low that it had right after the outbreak really came to the United States. But still, there's a lot of positivity in this call. They're saying that from the numbers of the gyms that have already opened, the numbers look good. People are returning to the gym. But I still think the majority of people in the areas that have been hardest hit, so areas like New York, New Jersey, out in California, those gyms have yet to open. And I find I'm hard pressed to believe that people are going to be running back to the gyms very quickly.
Yeah, I mean, I tend to agree with you on that, Shauna. I guess the one number that I thought was kind of interesting, which is I think a number that came out from a Cohen note on gyms specifically, was that there are new people who are signing up, which is a good sign, right, for these gyms. Because, you know, I keep thinking, in addition to the concerns about health and how clean these facilities are, there's a lot of people over the last 2.5 months who have gone through their own regimen. You know, I, for example, have signed up for Peloton, never did it before, but you have to wonder how much of this is actually going to be sticky. Are people really going to feel the need to go back to a gym now that they've got some kind of regimen from home, especially in the face of these health concerns? I mean, I guess the flip side to all of that would be that people have all of this pent up frustration. You know, they're wanting to go outside after spending so many hours indoors. So I'm not sure which way this swings, but from, you know, when you consider that there are new subscribers reportedly who are coming in saying they want to sign up for these gyms, that's got to be a good sign, at least in the first several weeks of states reopening.
Yeah, you make a good point there. I just think, I guess I question whether or not some of the initiatives that Planet Fitness is doing, like more they're making hand sanitizing more available, that they'll have stations with that. Employees are cleaning and sanitizing areas that are high traffic areas. They also have a touchless check-in available now through a mobile app. And Andy, I guess my question is whether or not that's actually going to get people to return, and how long this potential recovery could be, because we've been talking about the fact that some at least were initially expecting this V-shaped recovery. The economic data doesn't look good. So I think that also points to the fact that people are a little bit hesitant in order to go back to life as it was before the coronavirus outbreak.
Yeah, you know, businesses, Shauna, that are predicated on convening people physically are in a tough spot. And, you know, it's baseball, rock concerts, and gyms. And there's, you know, a lot of them. There's a lot of different companies like this. And these guys have, what, 2,000 locations across the United States? So they're not small. And, you know, of course, they can be safe, but then there's perception. And the perception is going to take a lot longer than actually the safety, because these places can be perfectly safe, but people still won't want to go. Just to go on a slight tangent, but I hope it's related. I was watching a show about the Weimar Republic in the 1920s in Germany, and they were showing people at movie theaters, right? And I think there were silent pictures at that point. But I realized this was only about 6 or 8 years after the 1918 influenza epidemic, right? And so here people were, and I think this is a realistic portrayal, but here people were sitting cheek to jowl, as it were, in a movie theater, not concerned at all. That's the good news. The bad news is it was like 6 or 8 years. after the pandemic. Now, I don't know if anyone was going to movies in 1920 or not. But anyway, at some point, things will get back to normal is my roundabout point here. But
hey, Andy,
too long for Planet Fitness.
But, we're talking about when are people going to feel comfortable going back to the gym? There's another big factor here, which is, are people going to have the money to pay for gym memberships? And I feel like people, the analysts just seem to be completely overlooking the fact that 42 million people have lost their jobs during the last 10 weeks. And yes, they have been getting some help through unemployment insurance and enhanced benefits there. But some people are starting to run out of money, and more people are going to start running out of money. I mean, a gym is discretionary spending. It's not food and it's not rent. And I think that's going to be a problem for companies like this.
And Rick, you make an excellent point, and it's a good comeback to me because there's a huge difference between then and now. So what I was talking about was the 1920s, which was called roaring, right? In other words, that particular epidemic did not produce any kind of Great Depression. I mean, it was not good for the economy in 1918, 1920, 1919. But afterwards, you had this upsurge. Now, maybe we'll have, the roaring 2025s. I don't know. Still a long way to go before we get there. And some companies are not going to make it.
Yeah, certainly. Well, I guess the one thing that Planet Fitness does have working in its favor is that it's a lot cheaper than some of its competitors out there. So if people are looking for more affordable options, I guess that would be one of the first places that they would look if they were looking to return to the gym. All right, well, we're going to take a quick break, but when we come back, the market wants to move higher, but our next guest says, be careful. We're going to talk about why Lee Munson of Portfolio Wealth Advisors isn't ready to chase those returns just yet. We'll have his interview right after the break. Welcome back to the final round here on Yahoo Finance. We have some breaking news here after our Slack out with earnings. Miles Udland going through the numbers for us. Miles.
Yeah, let's take a look at this release, Sean. On the stock, it's probably lower here in the after hours, and I wonder how much is the impact of what we saw from Zoom last night. So let's get to the numbers here. A 13-cent per share loss. It's a little bit wider than what the street was looking for at a 6-cent per share loss during the first quarter. Revenues coming in better than expected, $201.7 million against $187 expected. In the second quarter, the company did raise its guidance. 206 to 209 million in revenue is the new forecast. The street had been looking for right around 199 million. For the full year, Slack sees revenues coming in $855 to $870 million. The street was looking for $842 to $862. So they beat on the top line here. They raised their outlook for the second quarter and the full year. But I think in this environment, when Zoom came out and doubled their revenue guidance, which, as we talked about yesterday on the show, it cut the company's valuation in half overnight. Slack is supposed to be part of this stay-at-home trade, and I think Slack, they mentioned they added a record number of users. They have 122,000 paid customers right now. They added 12,000 net new paid customers. This is a good quarter, a very good quarter for this company. But in this environment, clearly the street was wanting for a bit more out of Slack.
Yeah, Miles, and you mentioned the competitive set here, and it's full, okay? And it's got some entrenched juggernauts. I mean, you've got Skype, which is Teams. You've got Google Meet. You've got WebEx with Cisco. And so, you wonder how much growth there really is in this business. I think it's a question.
Yeah, it certainly is a question. But when you take a look at, I know the paid customers were what the street was really focused on. And those numbers actually look pretty strong, Miles. They added a record 12,000 net new paid customers during the quarter, a record of over 90,000 net new organizations. These were either on a free or a paid subscription plan, but still, though, building up that very important part of their business.
And just quickly, as Jared Book replied to us here, the company withdrew its guidance for calculated billing. So they are still saying, even though they're giving revenue guidance for the second quarter and the full year, they're still saying they don't have a ton of visibility into what Slack looks like over the balance of this year. And again, I think for a company that, fits into the environment where they do, it's certainly disappointing to the street.
All right. Well, let's get more on the broader market action that we have seen, not only these stay-at-home stocks or stocks that have been benefiting from the coronavirus, but really the broader action that we have been seeing. And for that, I want to bring in our next guest. We have Lee Munson, President and CIO of Portfolio Wealth Advisors. And Lee, it's interesting because we have some of these individual names that have continued to be standouts. We know Slack is under pressure here after hours, but the stock has performed very well since the start of the year. And then broadly speaking, the S&P just recording its best 50-day rally ever, up over 37%. So my question to you is, does this market have room to run, or should we be thinking twice before we start chasing some of these returns?
Well, I am. I mean, I think this momentum has legs. The problem is that it's detached from what the economic reality that we're getting in right now. So here's how I see it. If I want to be polite, which I try to be sometimes, we would just simply say that the market is discounting 6 to 12 months out on really good consensus guidance, 130 a share for the S&P, basically what we have right now. And that would take us to 3,000, 3,100. The problem that I have is that I have a fundamental different belief on that. I don't think we're going to make what consensus said, which is down 20, 25%. I think we're more looking like maybe 100, 110 share on the S&P. Put that at a valuation. I'm getting more like 2,800 times, 2,800 on the S&P, and that's going all the way out 2022 earnings at maybe 150 a share. So I think that you have to, if you're buying the market now and you're buying it on fundamentals, you really have to believe that we're not doing guidance and that's a mistake. And that in fact, we're going to have a very robust return. We're going to go from 42 million unemployed to not that much. If I want to be more provocative or cynical or have a few beers, I'd say people are crazy right now. You got momentum players, you got algos putting in hundreds of billions of bucks. And I think it could keep going up. What I've done, I've just peeled back, right? I've been selling into strength for like 8 weeks now. And I've got a decent average price. But unless you manage money for your own self, or unless you're fortunate to have, clients like mine that are definitely behind what I'm doing and they're definitely with me in terms of patience, I think it's got to be very difficult because I think a lot of portfolio managers out there, they've got to run their book for the next 30 days for their Q2 performance. And if you're living and dying by Q2 performance, you got to go and screw around in Latin America. Did you see that, yesterday? It's just popping. And you have to go around to my hunting ground, small value, that's still popping. But you're not doing it on any fundamentals. You're doing it on a catch-up trade. You're doing it on whatever hasn't popped will and start doing it. And you see it in emerging markets.
Hey, Lee, Rick Newman here. I think I'm speaking for the team here when I say we'd prefer you to be impolite rather than polite. But I just want to get to what you're saying. I'm hearing you saying you'd be more comfortable if you saw a haircut in valuations, but also what about the fundamentals would actually make you feel better about the markets? What are some triggers at the level of the fundamentals that would make you a more enthusiastic buyer?
Well, okay, well, why don't we be blunt and say, what would cause you to have to go back to your clients and say, I'm dead wrong and I need to start buying things. I'll figure out how to make up performance next year. Because that's really the question here. Number one, I've got to see these furloughed people go back to work in the next 3 months. I've got to see the August ISM numbers, August, September. I have to see manufacturing start picking up a lot. And I have to start seeing next quarter, these earnings start flowing in so that we think that we really will produce somewhere around 130 or higher aggregate earnings on the S&P 500. The problem is this is not a bull market where I come on and say, I don't care if things were soft. The banks are lending, you go higher, you buy, you hold your nose. This is not that situation. So unemployment has got to not just top out, but I got to see those people. Look at AutoNation. You know, they took 7,000 furloughed people. They said, well, we're going to give back our PPP money. It's like 77 million. We're going to permanently lay off half of those people. Half? What if we have half of the 42 million become permanent? Then I'm just going to sit around being right.
We're going to leave it there, Lee. We're going to see if you are right over the next couple of weeks. Lee Munson, always great to have you on the show. Thanks so much for taking the time today.
Awesome. Have a great week.
All right, we got to get to some more breaking news. Gap is out with earnings here after hours. Miles has those numbers for us, Miles.
Yeah, let's take a look at Gap here. The company reporting a much wider than expected loss, $2.51 per share. The street was looking for a loss closer to 66 cents. Revenues coming in $2.11 billion, light of what the street was looking for at $2.26 billion. Now, the company did not provide comp store sales or comp sales in the current quarter. They are undertaking a strategic review of their real estate portfolio. Now, they did highlight here online sales in the first quarter were up 13% across the brands, mostly coming, all of that coming from Old Navy and Athleta. We saw Old Navy sales online up 20%, Athleta sales up 49%, Gap and Banana Republic sales still down online, not to mention the broad declines they saw at each of their brands in store. 90% of their stores were closed as of March 19th. But the company saw online sales up 100% in May. And so stock down 4%. Everyone knows the Gap story. It's not pretty, but there are some signs within their portfolio that things are turning around just a little bit as we head through the spring here. Sean.
Yeah, Miles, can I just jump in quickly before we go to Shauna? You know, there are existential questions that have been floating around this company. I mean, let's face it, because, you know, when we saw those companies filing Chapter 11, you know, J. Crew and Neiman, you know, they were like, who's next? It reminded me of, you know, the Wall Street banks during 2008, 2009. So far, these guys are managing to stay above water. They got a market cap of what, I think about 4 billion, something like that. Stock's down to 12 from 32 from a couple years ago. But, you know, then you see something crossing the tape that caught my eye the other day, which is Simon Properties suing them for not paying rent, right? You saw that story. So there's still some outstanding questions. And then we're leaving aside like, oh, the strategic problems of the company, which is to say merchandising and, you know, staying ahead of fast fashions, the three-headed dragon of what is it, H&M? Okay, bear with me. Come on, you can do this. Well, Zara, H&M,
Zara.
Uniqlo. Those three.
All your favorite stores, Andy.
Got to catch up. If I go there, Rick, they're dead. Okay.
Me too.
Right. Okay, Sean, that's it for me.
All right, guys, we're going to leave it there. But again, Gap shares under a pretty significant amount of pressure here after hours, off just over 5%. We're going to take a quick break, but when we come back, we're going to talk about one sector that really got a huge boost today, led by American Airlines. American Airlines adding flights ahead of the summer season. So is the travel industry finally back after months of the standstill related or because of the quarantine? We're going to talk to Cowen Senior Research Analyst Helene Becker. She'll join us with her take right after the break. Welcome back to the final round. Let's focus on a massive mover in today's market, and that's the airline stock. Shares of American up over 40% today. We also saw significant gains from names like United, Delta, JetBlue, all getting a pretty big boost. Now, for more on this, I want to bring in Helene Becker, a senior research analyst at Cowen. And Helene, it's great to have you on such an incredible day that we're seeing for a lot of these airline stocks. And this comes on the heels of American saying that they plan to fly just around 55% of their domestic schedule. So what should we expect just in terms of a recovery here for the airlines? And do you think airlines are going to be able to salvage at least some of their summer season?
Yes to the second question, we do. We think that as states open up and as there's things to do, leisure travelers will start to come back. I think people are tired of being, in paradise prison, as I call my house. I love it, but 24/7 gets a little old. And and I think when you see Las Vegas open today, and we know airlines were adding seats back, I think a lot of the traffic is, the bookings are turning into people actually flying, and that's a good thing, because we saw the bottom when 87,000 people traveled on April 14th, and it's grown steadily since. And as I said, as states open, I think you'll see people want to travel more. We're watching Las Vegas for sure. We're watching Orlando, where Disney said they'll open mid-July. And I think you'll be able to see, part of July and into August improve. Our forecast is for 400,000 passengers per day by August 1st, and consistently. Right now, we've been running between 260,000 and 300, and kind of like 10, 20,000. I think we had a recent peak at about 350 around Memorial Day weekend. But look, we're still down from 2.5 million a year ago. So it's not anything that we need to cheer about yet, but it's certainly a trend in the right direction. And our forecast is for 750 per day by December 1st and 1 million by Christmas, kind of like Christmas week, we see 1 million passengers. You're still down 50% year over year, but you're up a lot off the bottom. And if there's a vaccine between now and then that's effective and that people start to receive, I think it recovers faster than that.
Hey, Helene, Rick Newman here. Remember when the CEO of Boeing a few weeks back accidentally on purpose said he thought one of the airlines might go out of business? Do you think that's true? It sounds like you don't.
I don't. You look at the stocks, and that's certainly, a big question, because there are, airlines, and they're leveraged and have always been. And obviously that's a worry. But if you look at their cost of capital over the last 3 or 4 years, money's been interest rates have been really low. Money's been cheap, and they've been able to, refleet, lower their average fleet age on average. You've seen it coming down over the next 6 months. We're gonna see the airline industry in general do almost a decade's worth of aircraft retirements, this year. And as you think about recovery and sustainability, the airlines are going to be in a really good place. And I certainly don't think that we're in a spot where airlines are going to go bankrupt at all. They all have enough money to get to first quarter of 21. Their aspiration is to get to cash flow break even by year end or shortly thereafter. And if they can do that, I think, and that's assuming zero revenue. And of course, we're assuming they generate revenue, and they are generating revenue. And so I think we can take bankruptcy off the table.
Yep.
If there's, I'm sorry, go ahead.
No, I'm sorry to jump in, Helene. It's Andy. And I just wanted to ask you, so what is it going to be like flying? I mean, how many people are they going to be able to put in the planes? And
yeah,
aren't costs going to go way up and revenue down?
Yeah, that's a good question. So here's the thing. There's no such thing as social distancing on an airplane. I mean, you just can't do it. It's impossible. If you were to try to do that, think about it this way. Most airlines have 30 inches between seats. So, and you want 6 feet in every direction. You got to buy, 12 seats. It's not happening. So I think the safest place for you to be is on an airplane. I think your risk is your ride share, walking through the airport, getting on the plane. They're fogging it. They're doing, the cleaning that hospitals do from a sterilization perspective. People are bringing their own wet wipes. If you wear a mask, you're going to be just fine. And I think they're trying to, they're boarding back to front so you don't pass people. I personally think it's going to be okay. Now, that said, to directly answer your question, the airlines have in general said they'll keep book load factor to 60 to 70%, through the end of June, the end of July, the end of September, depending on the airline. It kind of varies. And you're right, this is not sustainable. They can't do it. Break-even load factor before all this started was 80%. Now it's well over 100. So the solution has to be that you're not going to get sick. You wear your mask, and you fly. And of course, if you're uncomfortable, you just opt out and don't.
Right. Helene, Helene, one real quick question here. Are airfares going to go up?
Directionally, up or down? So right now they haven't moved, but as soon as demand starts to recover, I suspect airlines will start to lower fares. When you start to see consistent 60, 70% load factors and people start to book and don't think about it, yep, I think fares are going to go down.
That'll be good news for everyone then flying if fares actually go down, because I think the fear was that we will see a big increase here over the next couple of months. Helene, we have to leave it there. Helene Becker of Cowen, great to have you on. Thanks so much for taking the time today.
Thanks very much for having me.
All right, we're going to take a quick break, but when we come back, Pride Month is underway. We're going to talk to Out Leadership about what corporate leaders can do to improve diversity in the workplace. We'll have that interview right after this quick break. Welcome back to the final round of stocks closing the day well off their lows, but we did have the S&P snapping a 4-day winning streak. The NASDAQ 100 retreating after touching a record in earlier trading. Jared Blickery has more on this for us. Jared.
Yeah, really interesting day. Lots of movement, even into the close, especially into the close. And we saw stocks really come off their lows, even though they dipped into the red for the most part. Here's the Dow, ended up 11 points, 12 points in the green. let's check out a year-to-date chart. When we can see here, not shown, is the 200-day moving average, which is right there. So just kind of pressing up upon that. We have the NASDAQ within a few percentage points of its record high in February, S&P 500 at a key resistance level 2, and the NASDAQ 100, as you noted, hit an intraday high, a record high earlier today, but couldn't close at that level. Russell 2000 just breaking even today, kind of the laggard for the year to date, but some decent action over the last 15 days, which is when we began this mini rally. Also noting that the chip stock continued to do well, and we're seeing those just brush up against their record highs as well. So I think what we're seeing now in the markets, bottom line, is that a lot of these indices are ready to pause, need to consolidate for a little bit before heading higher. Not necessarily expecting a big downturn, but that's just what I'm seeing right now. The VIX also hitting a low. We haven't seen this since about early March, so that's nice to see as well. Want to see that dip into the low 20s. And then the 10-year T-note yield. We have seen the yield curve really expand over the last few days, 14 basis points over the last 2 days for the 10-year itself. And we have this rounded base, and we're finally taking out the 0.8%, the 80 basis point resistance level. So this would be, a move up would be concurrent with a move up in stocks. And also supporting equity prices and the risk movement is the US dollar index. We're seeing that down, I believe it's 6 days in a row. We haven't seen these levels since about mid-March, so that's given equities a bid as well. And I think we got time for one more market. Crude oil futures at multi-month highs here, pressing up against $40. They'll get to 42, they would fill the gap.
Yeah, the massive rally that we've seen in crude has really been extraordinary here over the last several weeks. All right, Jared, thanks so much. I want to turn to a big event that we're watching here at Yahoo Finance. That, of course, June is Pride Month, this year marking the 50th anniversary of LGBTQ Pride traditions in the U.S. For more on this, I want to bring in our next guest. We have Chris Frederick, Out Leadership Global Events Managing Director. And Chris, it's great to have you back on the show. Pride Month is obviously looking very different this year because of the pandemic. A lot of the celebrations that have always been held in person are now happening virtually. I know Out Leadership is hosting its first ever month-long global Pride celebration. So what do you have planned exactly for the entire month of June?
Yeah, Out Leadership realized pretty early on that a lot of prides around the country and around the world were not going to be happening. And so we decided to create a whole 30 days of Pride that lived virtually. So we're going to be having 70 different speakers, 45 events across the entire month. That all kind of raise the visibility and voice of over 20 LGBTQ nonprofits from around the world. So we wanted to really create a unique space for people to convene, learn from one another, and educate one another on our history. So we're really excited to be able to bring the program to life.
Hey, Chris, I want to ask you about the social unrest in the country right now, and ask you, is there any connection between what's going on with Black Lives Matter and what happened with George Floyd and with the work that you're doing?
Yeah, I mean, I think that Pride specifically is that time of year, and Out Leadership throughout the entire year kind of focuses on diversity and how we raise up diverse voices and intersectional voices within our community to kind of raise the issues forward, right? So I think that we are very focused on focusing on improving the lives of everyone around the world. And, I think that specifically Pride is that one time a year where people can come together to raise the visibility of issues that matter to all of us. So it's really important now more than ever for Pride and Pride celebrations, and even Proudly Resilient, to talk about issues that matter to all of us.
Yeah, Chris, that is so important. It's also really important to get corporations involved, to get the business community involved in all of this. So how are you trying to get more and more corporations involved in your Pride events every year?
Yeah, I mean, I think that we're seeing corporations really kind of come into the space and really think about how they want to be involved, right? So more and more, it's not about just slapping a rainbow on something. It's about how can you show up and be authentic and be in the space authentically, right? So more and more companies are thinking about how they can support organizations that are outside of just the month of Pride, right? And so you'll see capsule collections, you'll see products that all kind of benefit other LGBT nonprofits throughout that whole month, throughout that whole year. And I think that specifically what we've been seeing over the last couple months is that companies are coming in and supporting out leadership. We have P&G that just signed on as a member of the organization, and HSBC has been really upping their contribution and their support of the organization. So, you know, I don't see corporations kind of pulling back in any way. I think that if anything, they're really supporting and doubling down.
Chris, let me pick up on that point, because I think that, you know, a lot of corporations have been more vocal in their support of the community, but also last year there was a lot of criticism of corporations coming on board at a time when they've also supported sort of more conservative causes that would have gone against the LGBTQ community. And I'm wondering how, as an organization, you keep these corporations honest in terms of their actions, because I think that can really tie into the conversation we're having today as it relates to the unrest and the inequality. You know, a lot of companies are coming out and saying, yes, we stand with you, but how do you actually measure the action to back up those words?
I think it's talking and having a real conversation about their policies that affect LGBTQ people internally and externally, right? So it's not about just, again, slapping a rainbow on it. It's like, what are you doing to move the needle forward to make sure that LGBTQ people worldwide are taken care of, that equality is an issue that you are addressing as a company. So it's about having a real dialogue, having a conversation. And I think that there's a lot of power around convening and talking to companies that want to be a part of your organization, right? You have a lot of power to be able to say, no, you can't be a part of our organization if you don't do X, Y, or Z, right? And I think that as a result, I think companies listen by and large. And I think, you know, that's a great thing for equality.
Chris, going off of that, just having companies listen and making sure employees are involved in this and taking action, how do you translate this to not just focusing on this in the month of June, but focusing on inclusion really all 12 months throughout the year?
Yeah, I mean, Out Leadership, our work is 12 months out of the year. So, you know, Proudly Resilient is an event that we do, but we are operational all year round. And I think that we are focused on advocacy work around the world. It's not just the US. We're really focused on advocacy work globally. And I think that as a result, companies come to us and really want to talk about how they can kind of create policy, create conversation for their employees so that you know, we can move the needle forward for equality around the world.
All right, Chris Frederick, Out Leadership Global Events Managing Director. Thanks so much for joining us today.
Thank you.
We're going to take a quick break, but up next, as companies look to return to the office, major changes are underway to account for the new COVID-19 reality. We're going to talk to Akiko. She's going to give us a sneak peek of what a post-pandemic office might look like. We'll be back with that in just 2 minutes. Welcome back to the final round. The coronavirus pandemic has upended the routines of millions of Americans who head to the office every day. Buildings across the country are being reconfigured to accommodate social distancing measures. And then we also have this mental shift underway taking place for those whose future includes working from home. So Akiko is looking into this story for us. And Akiko, the big question is, what is that post-pandemic office space going to look like?
Yeah, Shauna, it's going to look a lot more fragmented. You know, we've talked so much about the Twitters and Facebooks of the world, sort of talking about a permanent work from home shift. But the reality is a majority of companies are looking at a much more fragmented space, a little bit of work from home, some working from the office. And then in case of those companies working from the office, we're looking at 25% capacity.
So the first thing when they step out of the lift is they're going to notice that the doors are open. So they're not going to have to touch a door to come in.
Americans returning to work face a dramatically new office experience.
You've got 3 chairs here. How many did you have before?
We would have had 6 before.
There's less furniture here and fewer desks.
What we do down these line of workstations is we take out every other workstation and then people will be able to maintain that safe distance.
And there's plenty of reminders to keep that distance, as we learned firsthand. Cushman & Wakefield calls this the 6 feet office.
2 of the areas we're really focused on is maintaining that social distance while we're in the office, also just reducing the number of touch points.
Employees here use keys instead of their fingers. They stand in marked corners. They're required to walk clockwise around the office to avoid congestion.
The overarching approach has been, how do we create these safe environments with a limited amount of time and a limited amount of capital to make them accessible for everybody?
Other offices are turning to tech, installing thermal imaging cameras to check temperatures and air filtration systems. WeWork expects employees to stay closer to home now. It's launching software to help clients find locations nearby.
This technology that we're putting that we put together and we're rolling it out gives enterprise companies the ability to map out their people to our various locations. If you have 4,000 people, they don't all have to be in 1 or 2 locations.
What does that mean from a business standpoint from WeWork? On the one hand, you're saying there's an opportunity of more businesses coming in, but just as equally, you've got to have a lot of businesses that may not have the same footprint they did pre-COVID.
Net, we have greater demand today than the members that we've lost. Enterprise is about 46% of our business today. We expect that number to grow to about 70 to 75% of our revenue over the next 12 months.
But companies like Facebook and Twitter see remote work as more permanent. That's altering the definition of the office. Do you think we're seeing a permanent shift in the way we actually look at the workplace?
I absolutely think we're never going back to exactly where we were. And in many ways, that's a good thing. I think there's going to be much more of a hybrid future of working from offices and working remote.
Huffington expects that to lead to a shakeup of C-suite roles. Mental health now a priority with employees working in isolation. Who takes on that role of ensuring that part of the equation?
The heads of HR departments are now the most important executive in the company other than the CEO. The health and wellness of employees has now been moved to the front burner.
The changes giving new meaning to business as usual, with our workplace changed forever.
Now, one of the interesting things I heard over and over is that this notion of having a headquarters in a big city may be sort of pushed aside for a while now, because a lot of employees are not going to want to commute in because of concerns about health. And picking up on that point that Hamid Hashemi made there from WeWork, that contrary to what we've heard, actually provides a huge opportunity for a lot of these co-working spaces who are a lot more flexible in the ways they can change the layout there, and they've seen a big bump on the back end of that.
Yeah, it's certainly going to be interesting. And I know in our conversations just about if or when we head back to the office, what exactly that is going to look like and whether or not we all will be there, if we're going to be operating at 25% capacity, like one of your guests said, in that package will be very, very interesting. So great story. Thanks so much, Akiko. We're going to take a quick break, but when we come back, we'll have a preview of what's shaping up to be another historic jobs report for the month of May. That's out tomorrow morning at 8:30. We're back with that in just 2 minutes. Welcome back to the final round. We had the jobless claims report out this morning. Another 1.8 million Americans filing for jobless claims last week. So the big question is what the big jobs report out for the month of May, that's out tomorrow morning at 8:30 a.m. Eastern time, what that is going to look like. And Miles, you and I have talked about this time and time again, but the expectations, another 8 million decline for jobs here for the month of May. That's what analysts are expecting. And then also an unemployment rate of over 20%.
Yeah, I mean, look, we're going to have the highest unemployment rate since the Great Depression as of tomorrow morning. Now, the interesting thing, and I'm writing about this for tomorrow morning, is that economists think the unemployment rate's probably closer to 25%. The expectations are for 19.4 tomorrow. And I think the question is, like, what matters next? And so folks that I've been reading are looking at things like participation, because if you, let's say, rough number of people in the workforce, 250 million, every 1% of participation, right? That's 2.5 million workers. If participation goes down 5 to 7 percentage points during this cycle, I mean, that means that you are looking at 12.5 million people potentially who are just gone from the workforce. They are not they're not even counted anymore. And this was such a big talking point after the Great Recession. And so I think it's those secondary readings. We talked about continuing claims earlier in the program. That's going to be closely watched. But participation, I think, is a real area that economists are going to focus on as we go through the summer, because there is so much noise in this BLS number other than the directional data, which just says things are bad.
And Miles, the gains since 2008, 2009 evaporated in the blink of an eye. I mean, the decline was stunning since coronavirus hit the United States, and how quickly all those jobs just went away. And so you have to wonder, are we at the bottom yet? Well, how long will it take to get back to the pre-corona level? I mean, years.
Can I take a stab at that, Andy? So IHS Markit put out a forecast this week saying they don't think we'll get back to pre-virus employment levels until 2024. That's 4 years from now. I mean, that is a long time, and Congress is having trouble figuring out if they can pass another stimulus bill this summer. They may have to do this for the next 3 summers.
I mean, I think there are some markers that we can look for, right, in the months ahead. I mean, if you look at all the timeline for the PPP loans, we're going to see in July whether the rehiring actually happens, whether these small businesses do, in fact, act on that. That may bring the number down, or that may give us an indication of whether these jobs are lost permanently, at which point I think the question is going to be, well, what are the skills that are needed there? And is there going to be this mismatch, as we saw even in in a tight labor market? And that's something I think certainly to watch for, because it could get a lot worse if we don't see that rehiring.
And, speaking of this big disconnect between the stock market and the real economy, and you guys are talking about these job losses, and, you have to wonder, well, how are we surviving? And it reminds me of a conversation I had with Buffett. And he said that we forget sometimes how much wealth has been created in this country. Cumulatively, but especially over the past 10 years. It's amazing. Now, it's not distributed equally, sure, but there is a giant cushion for a lot of people. For a lot of people, there's no cushion at all, to be completely clear, But if we didn't have this cushion right now for a lot of people, there would be complete chaos right now. I mean, we're already starting to see chaos connected to social injustice. There's a lot going on there, but there's still money around in our country, but who knows how long it can last.
Yeah, it certainly is. Well, we're going to get some of those numbers out, or the jobs report numbers out tomorrow morning. Yahoo Finance will have special coverage for that beginning at 8:30 a.m. Eastern time. Again, expectations for 8 million jobs lost and an unemployment rate of nearly 20%. We'll bring that live report to you tomorrow, 8:30 a.m. Eastern time. Thanks so much for watching Yahoo Finance today. Have a great night.